Good morning. It is Jobs Day in the United States. This is Yahoo Finance Live. I'm Julie Hyman. That is Brian Sozzi right next to me. We are about 5 minutes away from the jobs report for the month of February. And we, of course, have the backdrop of what's going on over in Russia and Ukraine. Russia, of course, its invasion of Ukraine ongoing. So that sort of very much on investors' minds this morning, even as we wait for these numbers. We are seeing futures indicate a lower open at the moment. That, of course, could change in a few minutes after we get the numbers. But overnight, Russia, its incursion into Ukraine, affecting the largest nuclear power plant in Europe. It does seem like there is no sort of leak there of radiation, but nonetheless, that raising some alarms overnight. Let's talk about the expectations for non-farm payrolls quickly here. 423,000 is the consensus estimate coming to us from economists. The unemployment rate forecast to fall 0.1% to 3.9%. We're watching that number closely. And as always, we are also watching average hourly earnings forecast to have risen 0.5% on a month-over-month basis and SAWS 5.8% on a year-over-year basis.
Yeah, I'm locking in, Julian, a couple things, but chief amongst all those here is dining activity in the month. And good chart out of Goldman Sachs. Jan Hatzius is here, their chief economist, looking at dining activity in the month of February. All signals point to that being a helpful boost to jobs in February. This chart noting here, the main takeaway is that activity at restaurants have reached back to pre-pandemic levels. And with that, of course, you need more servers, you need more people behind the bar serving up those well-liquored drinks and shots of tequila. So that may have helped jobs last month. And Julie, of course, look, the next thing to be on the lookout for is, of course, the market reaction. This report can essentially come in at 1 million jobs or more. I'm not saying it is, but it could, and you're still likely to get that rate hike of 25 basis points in a few weeks.
Yeah, and that maybe is part of the reason why you see such a disconnect right now in public opinion and public sentiment between the economic backdrop and the feeling around the economic backdrop, right? So Liz Ann Saunders over at Schwab this morning flagging the latest Gallup numbers on public sentiment surrounding how people are feeling about the U.S. economy, and they're feeling pretty much the worst that they felt since the beginning of the pandemic. So only 26% see the economic outlook as getting better, and 70% view it as getting worse. Now, you know, maybe the job growth is as good as it's going to get. We do hear from economists that economic growth is going to slow to some extent, but it's still going to be growing. Gasoline prices probably playing a role in all of this. You have been laser focused on that issue and its impact on sentiment, but I am struck by the idea that we are likely to get, economists forecast we're going to get a big addition in jobs in the United States at a time where people are feeling pretty lousy about the U.S. economy.
No, right, and you're starting to see in some of these retail earnings or these outlooks, Julie, but that's a discussion for a different day. The reality is, we talked a little bit about this yesterday. This is a market fixated on what is next from the Federal Reserve. Just think about it, Julie. We are waking up this morning here seeing images on Twitter, social media, and news of Russia overtaking a nuclear power plant in Ukraine, and the market is not even down that much here. So I think, you know, the market wants to see, of course, what this jobs number is, but what it means for interest rates. And as we heard from Jerome Powell this week, Julie, we're only likely to get 25 basis points later this week. So let's root for a good number here.
Yeah, and at the same time, Jerome Powell and the White House, for that matter, have been very clear about trying to control inflation. The White House, for its part, talking about being very cognizant of that rise in gasoline prices. So all of this sort of mixing into the sentiment surrounding this report today. Just want to quickly, again, bring you the setup here in terms of what we're seeing in the markets right now. We are seeing an indication for a lower open here this morning. Futures right now pointing to a decline of around 0.8% at least across the board. And we're watching the Treasury market as well as we have been in advance of this report. It's been very interesting, the action that we have seen in Treasuries, which have caught something of a bid over the course of the week. Because of being seen as a relatively safe place to park. But you can see right now the yield on the 10-year in particular at 1.84% as we head into this report, as Jerome Powell was so clear about what the direction of interest rate increases is going to be. And we should be getting the numbers out any second now as we're watching. I'm seeing the unemployment rate, 678,000 jobs added in the month of February. That is much higher than estimated. Again, the estimate 423,000 jobs added last month, 678,000. So a big beat here when it comes to the number of jobs added to the U.S. economy last month. The unemployment rate ticking down even more than expected, 3.8%, the unemployment rate in February versus the 3.9% estimated and 4% in January. Average hourly earnings, though, here's the fly in the ointment, remaining flat in the month of February. No growth in average hourly earnings on a month-over-month basis, and year-over-year up 5.1%. And P.S., that's not real average hourly earnings. That does not account for inflation. So one could argue if it was flat month over month, because of the changes we've seen in inflation, people actually earned less on a real effective basis last month, which I think is something that is important to note. I'm seeing here private payrolls as a portion of the total, 654,000 manufacturing payrolls growing by 36,000. Not huge revisions for the prior month, and Saz, so pretty remarkable increase here that we saw in jobs, and showing also perhaps the persistent difficulty for economists in predicting month to month what these jobs numbers are going to look like.
And look at that. You're seeing the futures here come back off the worst of the session. Interesting reaction here, Julie. A couple things caught my attention. Of course, we're still going through these numbers. First, you want to watch some retail stocks here. What you just highlighted, Julie, with wages not even growing in an environment where consumers are going to go out there this weekend, buy gas for their cars or SUVs, and it is likely over $5 a gallon. That is a red flag because that is essentially purchasing power on the parts of consumers going up in smoke. Next thing, telework. Lost in the shuffle of it, all the focus on Russia and Ukraine is that the pandemic is in fact easing. That showed up in this report, guys. 13% of the population teleworked in the month. That is down from 15.4% in the prior month.
And I just want to run through the sectors real quick before we get to more market reaction here. Leisure and hospitality jobs, that's what you were watching closely, up 179,000 in February. Food and drinking places up 124,000. Accommodation up 28,000. Professional and business services also strong, up 95,000 there. Healthcare up 64,000. Construction up 60,000. Transportation and warehousing continue to show strength there, 48,000. Retail, 37,000. I mean, I'm just seeing a lot of different areas of strength here, pretty much across the board. We saw information and government. Those were the two areas where there was little change in the gains in jobs, Saz.
And Julie, we got some upper revisions here. December revised up 78,000. January revised up by 14,000. And this is going to be a question put to every guest on here. Julie, the Fed is in a very tough spot. Clearly, the economy is gaining steam. And clearly, the Fed is behind the curve on fighting inflation here. It's a big pickle, a huge pickle for Jerome Powell to be in. And for the markets, ultimately, I think.
Well, he said he's 25. It sounds like it's going to be the number in March, no matter what, at this point. Let's bring in Jared Blickery, who's been watching the market reaction to all of this. As Saz noted, we saw stocks, the futures come off the lows a little bit. Jared, what are you seeing?
That's right. Let's go to the Wi-Fi Interactive. And indeed, stock futures are just heading a little bit higher, but have to keep in mind that usually the first move is a little bit of a false move. A lot of time that is reversed. And just looking and contemplating some of these numbers here, I'm reading some of the analyst commentary and reporter commentary on Twitter. 678,000. That number is higher than all but two of the economic forecasts. And that was the S&P 500. We're looking at the Nasdaq futures right now, very similar chart. Also, the unemployment rate with a 3 handle, 3.8%. The expectation was for 3.9%. Very important to remember that in December, the last time we got the summary of economic projections from the Fed, no one expected anything sub 4%. So really twisting those expectations there. And as you said, Jules, 25 basis points in the month of March for the Federal Reserve in just a couple weeks here. That's pretty much in the bag. Also want to check out 10-year T-note futures. Now, this moves inversely to yields. So we see this heading higher. That means yields are heading down a little bit. But not shown here is the 2s10 spread. That's the spread between the 2-year and the 10-year. That has been plummeting. That's a contraction of and flattening of the yield curve. It is down to 29 basis points right now. It's up a little bit off of the lows of the day, 27 to 26 basis points. But nevertheless, when that thing inverts and when it gets close to it, you know there's going to be a lot of headlines generated from that. Now, let's get to some of the other markets here. I want to check out the US dollar versus the euro. So here's the euro, and you can see that's sinking a little bit. That move began prior to the announcement here. Also going to take a look at the euro yen as an appetite for risk. Again, that had been moving, but not really seeing much right there now. And WTI crude futures. You don't really always expect a market like crude futures to react to a payrolls report unless there's something completely out of whack. But nevertheless, we're seeing oil. Let's check out the high here. It was 115, 116 yesterday, high of 112, almost 113 today. Not a lot of movement there. And then finally, gold futures saw a little bit of a spike here. I think the market is going to have to figure out what is up with this average hourly earnings of zero. Monthly growth of zero was not priced in. That brings the year-over-year number down to 5.1. I think that's the only thing holding back this from being a very, very bullish report. And in fact, if there's any consternation over it, I think it could be in that number. But reading some of the commentary early on, it might just be a compositional issue. So we'll have to get some clarity on that. We're looking at the sectors here. So energy is the only one in the green. That's up 0.7%. To the downside, we're seeing financials, materials, consumer discretionary, and communication services all off nearly 1% or just a little bit more. Also want to take a look at the Nasdaq and see who the leaders are there, see if we can discern any patterns. Lots of red on the screen. It looks like some of the tech names, particularly some of the software and chip names, those are flagging in the red here. So all in all, a seemingly good report, but with a couple of head scratchers here, particularly those average hourly earnings, guys.
Yes, definitely. That's going to be something we are also going to ask our folks about today, in addition to the big pickle that the Fed is in the immortal words of Brian Sozzi. Thanks so much, Jared. Appreciate it. And we want to bring in some folks for some outside perspective now. Nathan Sheets is with us. He's Citi Global Chief Economist, as well as Seema Shah, Principal Global Investors Chief Strategist. Thank you both for being here. Nathan, I want to start with you and just kind of get your first blush reaction to this report, and in particular, that average hourly earnings number that didn't show any change month over month.
Well, I think that this confirms yet again that we have a red-hot labor market. There is an extraordinary bid for labor out there, and that the big question is, where is the supply going to come from? And, that reserve of folks who are not in the labor force as a result, are not working as a result of the pandemic, that is rapidly diminishing, and the labor market's tightening. Now, how do I reconcile the softness in the average hourly earnings number? Kind of my instinct there is that there's likely a pretty big compositional effect, that there were some folks who didn't work during January because of Omicron. They came back into the numbers in February, and it pulled it down a little bit. I'd very much want to see where things land in March.
Seema, Nathan notes correctly, I would say, we have a red hot labor market in this country. Is that good or bad for stocks?
So I think it's good to some extent. The market is already priced in Fed hiking. We know that's coming, whatever comes through in the next couple of weeks. So, this is, I think, just affirmation that the economy is strong, and hopefully it's going to be strong enough to digest the rate hikes that are coming, as well as some of the potential downside effects to growth.
And what about the pickle of the Fed, Nathan? That's to put another way, a lot of our guests have been saying to us, the Fed's ability to engineer a so-called soft landing, it's going to be tough. Do you think that they are going to be able to do it, given that red hot employment market and given what we're seeing on the inflation side, wages aside, I suppose?
the Fed's got a first order challenge in front of it. Speaking bluntly here, we've got a hot labor market as we've described. We've got 7.5% headline inflation. We've got a solid economy, and they're still at zero. And getting policy back even to something that we might call remotely neutral is still a goodly distance away. Now, given the near-term uncertainties, and even apart from those near-term uncertainties, the center of the Fed's leadership has been signaling that they prefer to move very incrementally and to see how the economy and the markets respond. But make no mistake, they have 7 meetings this year, and the possibility of 725s, which would add up to a substantial step toward neutrality, is very much on the table. In addition, Jay Powell has left open the possibility that maybe a little bit on down the road, there could be some 50-point moves. So Fed clearly behind the curve, but they're swinging into action. And I think that what we see over the course of this year is likely to be significant.
Seema, what do you think the market is likely to take its cue off of over the next few weeks? Is it a better than expected jobs report like this, or what is happening with Ukraine and Russia?
I think it needs to take both of them into consideration. I think in the immediate future, it's about the economic data. Where is it today? What is the urgency for the Fed to move? And clearly from today's number, as well as probably from the CPI number coming next week, it's going to be very clear that the Fed has to move. And as Nathan just said, they are very, very behind the curve. They need to get going. Now, fast forward kind of 3 or 4 months, then the market needs to start looking at financial conditions. What has happened to them? Are they already tightening? And then maybe financial conditions are already doing some of the job for the Fed, taking a little bit of heat out of the economy. So those are the things that we need to be watching. But I think as of today, and whatever happens in the next couple of weeks, I think Powell has made it very, very clear inflation is the top priority, and that is what they have to respond to, and they need to respond immediately.
And given that, it seems to me that the jobs report today, Seema, doesn't change anything from a strategic point of view for you in terms of what you're doing with asset allocation, et cetera, or am I wrong?
No, you're absolutely right. It doesn't change anything. I think this is in line with what people are expecting. We were expecting to have a strong report. Maybe many weren't expecting it to be this strong, but it's still in a similar ballpark. So we continue to think that the US economy is a place to be focused on right now. If we talk about the Fed's dilemma, well, the ECB's dilemma is considerably worse. They're potentially looking at a more significant economic slowdown, as well as very elevated inflation pressures. So no, from our perspective, it's still US over Europe, but still risk on. This is fundamentally a strong economy. So through all of the things that we may or may not see over the coming months, we would still expect the US fundamentals should drive market returns.
Nathan, I want to just think about this in layman's terms. Do you just find it crazy that we have a Federal Reserve here that is going to let inflation continue to run close to double digits? More companies have come out in recent weeks, warn that inflation is far from transitory. It remains very high. People are going to go out this weekend, spend close to $5, if not more, dollars a gallon to fill up their cars. Doesn't the Fed have to step in here with something more aggressive? Can't they not? They can't afford to move gradually, like you mentioned.
This is, make no mistake, the most significant inflation challenge that the United States has seen in decades. And as you suggest, the underlying drivers of that inflation are profound and deep. They are the strength of US demand, and especially the US consumer, but also a whole host of underlying global issues. If you look at global producer price indexes around the world, they're posting double-digit gains. And it is incumbent on the Fed to respond. Now, that's happening against a backdrop of a generation of central bankers that have learned that gradualism is the right approach. And they have strong preferences for 25 basis point moves. And I think we're going to see in this instance as you suggest, whether that's sufficient and whether over the course of this year they get traction on inflation. If they don't, then I think that the Fed's DNA is that it's empirical, they'll move more. But I think up front, they have strongly signaled that at least for now, it's 25. Could that change as quickly as the May meeting? Absolutely. And that's something that's very much on our radar screen. It could be 50 as early as May. But in any event, they may need to do more than those 25s that I described before.
Yeah, a lot of the market participants are probably pushing in that direction. We're going to take a quick break, but we are going to ask you to stick around. Nathan Sheets of Citi and Seema Shah of Principal Global Investors. Just to recap the numbers before we take you to break, big beat on the non-farm payroll, 678,000 jobs added last month versus the 423,000 that were estimated. Unemployment rate ticking down to 3.8%. Average hourly wages on a year-over-year basis coming up short of expectations, rising by 5.1%. And futures remain in the red. We'll be right back.
Non-farm payrolls clocked in at an increase of 678,000 in February, really pounding estimates into the ground. The unemployment rate ticked down to 3.8%. Nathan Sheets and Seema Shah are still with us. Nathan, I want to go over to you on the health of the consumer here, because we did have flat wages in the month of February at a time where inflation continues to rip higher. What's your read on the consumer? Are they about to head into a very dark place this spring?
I'm watching that real wage number very closely. So how much are these average hourly earnings and other measures of compensation rising relative to inflation? And it feels like that wages are losing a little bit of ground here. And that is likely to be a headwind for the economy
Why do you think they're losing ground? Wages.
They're
in this
losing
environment
ground
where labor's so short.
They're losing ground in the sense that wages are rising less than inflation is rising. So they, headline inflation's at 7.5, and these average hourly earnings are at 5. And that's suggesting the real wages are, falling some. Now, there are some offsets, and I would say the major offset is the fact that the labor market is so hot. So yeah, real wages diminished a bit, but lots of folks are working, and many others know that they want a job, they can get one. So household incomes are holding in pretty well. So all in all, I'd say some risk from real wages, but I still stay relatively optimistic on the consumer, and that the consumer can continue to drive the recovery. But the risks around that are a little bit broader if we don't see strong performance in real wages, at least kind of a break even.
I mean, Nathan, it's interesting because even if you allow for the compositional effects that you talked about and the sort of hangover, if you will, from January, to see a flat month over month change or no change is still relatively alarming. And I wonder if, anecdotally at least, even if the unemployment picture is very tight right now, you still hear about people who can't find a job, right? They say, well, the employment market's supposed to be so good. Why can't I find a job? And so that makes me wonder if there are still some pretty profound mismatches here that are still putting a cap on wage growth.
This is a very important point, and let me call it the disjuncture between the macro and the micro. Then when I look at the macro data in terms of labor market, I say, wow, this is a hot labor report that we're seeing this morning. It's a hot labor market. And when I look at other indicators, there's lots of demand for labor. But then when we go out there, there are many people who are still looking around. Now, I would ask, well, are they looking for any job, or are they looking for the job that they've kind of desired or wanted for a long time? Or another way to put it is, how selective are they being? So I think that there is, even within a strong labor market, there are micro issues of matching, and they're creating problems for workers who can't find that job or one that they want to take, and they're making it difficult for firms, particularly like in the services sector and restaurants, to find the workers that they need. So lots of complexities underneath this. And I agree that can create challenges for broad swaths of the household sector. It seems we need more unskilled labor in this economy.
If we're going to get a gradual move on rates like Nathan suggests, you have that hot labor market here. Isn't one of the best places to be tech? This appears to be something of a similar environment to what we saw in the latter part of last year, and tech worked well.
Yeah, I have to say we continue to be fans of tech. It's had a challenged month or two. From here, given the conflict that we're seeing, it's very unlikely to see very significant upward pressure on bond yields, despite that move in the Fed. And part of the reason is the market is already pricing it in. Now, as you have a challenging macro conditions, and because of the inflation pressures that we're expecting to see, companies are going to be challenged with regards to their profit margins. So this is the time that you want quality. This is the time you want big balance sheets, positive cash flow, and really a very, very strong business model which has pricing power. And where do you typically find a lot of that? It's within technology. And of course, now that the FANGs have lost pretty much all of their gains from 2021, valuations are a lot more reasonable. Now, it's not going to be the top choice, but I do think that having an element, an allocation towards big tech at this stage probably does make some sense.
Seema, how are you thinking about energy stocks right now? I mean, this group is up some 30% thus far year to date because of the surge that we've seen in oil prices. How much further do you think that, and I guess the commensurate rise in oil prices, can still go?
Look, it's really difficult to give any kind of prediction on energy prices and commodity prices because it's currently being driven very much so by the geopolitical risk. When we look at commodities, they're so elevated. A lot of that is because it's got geopolitical premium priced in. So given that uncertainty, and given the fact that we have got surging inflation in the US and globally, To us, we look at it and we say, look, if you are concerned about geopolitical risk, which of course most of us are, if you're concerned about inflation, then commodities, energy, it serves pretty well as a hedge. So we do look at it as it's not putting a forecast out there on all prices of commodity or where everything's going, but we do consider it as a pretty good hedge in this very, very uncertain environment.
Nathan, isn't the only thing that's going to likely slow inflation demand destruction? So when that consumer or that shopper goes to the mall and says, I'm not paying $90 for a pair of jeans, they go to the gas station, I'm not paying close to $6 for gas, or I'm going to drive less. Does that help bring down inflation? And do you see demand destruction on the horizon?
Well, the answer to that is absolutely yes. And as prices rise, you're on the demand curve, and people demand less. I think what the Fed is hoping is that there are some other channels in the global economy that will manifest themselves and help bring inflation down. And some of the factors that the Fed has pointed to in its minutes, one is some further progress on supply chain disruptions. Another one is further progress on a reduction in commodity prices. And I have to say, given what I'm seeing at the moment, both of those seem quite remote. Now, a third one that maybe is a little more hopeful is as we make progress in better managing the pandemic, and it feels like maybe we're getting to a better place there, and that situation's better, it will allow a rebalancing from this red hot commodity intensive goods sector more into the services sector, and allow some of these goods prices that have been so elevated and rising so quickly, like autos, for example, to kind of come off the boil a bit. Of course, that may raise other issues about services inflation, what that might look like. But I think these are some of the kind of, let me call them exogenous or outside processes that the Fed, again, is hopeful. The Fed has its fingers crossed that these things are going to come through and be supportive of lower inflation, in addition to that demand destruction channel that you described.
Incredibly helpful insights here to the Yahoo Finance universe. Thank you to you both. Nathan Sheets, Citi Global Chief Economist, Seema Shah, Principal Global Investors Chief Strategist. Have a great weekend. All right, coming up, we'll reset the show and, of course, stay on all things jobs in America. Non-farm payrolls, again, rose by 678,000 in February, smashing economist estimates. Big focus point, though, here on those flat wages and what it might mean to the consumer, which is getting beat over the head with inflation at the gas pump and at the local mall. We'll be right back.
Good morning and welcome back. It is Friday, March 4th. This is Yahoo Finance Live. I'm Julie Hyman. That is Brian Sazi. Let's take a quick look at the futures here this morning. We are seeing a bit of a pullback here in the futures and lower than where we were when we started the show before the jobs report. The Dow indicating a drop of almost 1% at the opening bell this morning. Here are the three things you need to know on this Friday. First up, the jobs report coming in much better than estimated in terms of the headline number. Non-farm payrolls rising 678,000 last month versus the 423,000 that was expected. Unemployment rate ticking down to 3.8%. That's better than estimated. But average hourly earnings on a monthly basis not changing at all. The number was zero from January to February, year over year rising by 5.1%. And economist Nathan Sheets, who we just spoke to, as well as Carl Riccadonna over at Bloomberg, pointing out it was a compositional effect, perhaps. That is, more lower wage jobs were added during the month. In fact, the biggest gain came from leisure and hospitality. That is perhaps responsible for that number. We're going to talk more about the numbers in just a moment. Also want to bring you, as thing number two, the latest headlines out of Russia and Ukraine. There were dramatic scenes overnight. You see them there as Russian troops attacked and then seized Europe's largest nuclear power plant. It's located in southeastern Ukraine. International Monitor said there's no indication that reactors have been compromised. There was a fire there from the attack that was then extinguished. Radiation detectors showed no early signs of leakage, but we did see futures drop sharply overnight as that attack was ongoing. Meantime, late yesterday, a group of U.S. lawmakers introduced a bill to ban imports of Russian crude oil and other petroleum products. It was the first bipartisan-backed effort to do so, but the White House has pushed back against a ban, arguing it would further exacerbate the spike in gasoline prices. And just quickly wanted to mention what's going on with Russian assets as well. We continue to see sharp weakness in the Russian ruble. That's the dollar-ruble trade you're seeing there, which means that the ruble has fallen 31.5% over the course of the week. Russian stock markets remain closed and will remain closed at least through March 8th, according to Russian authorities. We continue to watch the proxy for Russian stocks here in the U.S. That is an ETF that tracks them, the RSX, and that has remained sharply lower. Saz?
Yeah, Julian, as for me, I'm on inflation watch, most notably gas price inflation. Woke up this morning, Google searched gas prices. One of the top stories out there on the internet is gas prices nearing an all-time record in Pittsburgh, $4 a gallon unleaded. Also, too, one of the best performing stories right now on the Yahoo Finance platform is from our very own Danny Romero, who did a lot of original reporting, getting a sense on the ground on how consumers are responding to these higher gas prices. One person in California told Danny they have been blown away by higher gas prices. And then lastly, I've been blown away by higher gas prices. I tweeted a photo yesterday looking at that captured a photo from Oregon with gas prices approaching $7 a gallon. I've never seen that in my lifetime, Julie.
No, neither have most Americans.
I don't want to see it.
Yeah. Well, I wonder if we're going to see a hastening of a switch over to our electric vehicle future as a result of all of this, something that was already well underway, and we've seen the big automakers do a big push in that direction. Let's get back to jobs for a moment, because that was a surprising jobs report on a number of fronts. Our Brian Chung has been sifting through the numbers to try to sort of tease out some additional themes, and he joins us now. Good morning, Brian.
Good morning, Julia. I've had a luxurious 34 minutes to look over the jobs report, and obviously a lot going on when you consider that blockbuster number that we got on the top line, 678,000 non-farm payroll ads and another 92,000 jobs in terms of revisions to December and the January reports. But what's really important is what you noted earlier at the top of the show, Julie, which is the compositional effects that have really benefited a lot of those low-wage workers as employment in leisure and hospitality remains in focus. And this is specifically benefiting some of these more marginalized groups, which have historically taken longer to recover out of previous recessions. And I want to cast the light specifically on Black employment. Now, when you take a look at the unemployment rate, it actually ticked down to 6.6%. That's down from 6.9% in the month of January. But important to note that the unemployment rate can decline for not good reasons sometimes. One example being people being discouraged from work or searching for work, and that could drop out of the denominator. That would bring unemployment in a different direction. But what we actually saw was that the employment to population ratio ticked up 58.1%. That's 0.4% of a month-over-month improvement. And that shows you a more raw look at just the amount of people that are Black that are working against the whole total Black population. So that number ticking up shows you that this is very much good for that group. And then the same story in the Hispanic and Latino group, which has also historically had a tough time in economic recoveries. Unemployment rate at 4.4%, a marked decline from the 4.9% that we saw in the month of January. And again, same story. Employment to population ratio actually ticking up to 63.6% compared to 63.2%. So again, this is a very important story within the context of a full labor market recovery. It was worried in previous cycles that if you start to hike interest rates or pull the plug on monetary stimulus too early, you'll leave a lot of these Black, Hispanic, in many cases, low-wage workers on the sidelines. But guys, I just want to note it's not all good across the board when you consider, for example, female unemployment rate remaining unchanged at 3.6%. You didn't see the same trend in the employment to population ratio, actually declining between January and February at 55.9%. Something very important to remember as we continue to watch jobs reports in the months to come, guys.
Yes, thank you so much for that additional context. Really helpful stuff, Brian. Appreciate it. Let's talk about how people should and are trading this report, as well as, of course, the backdrop with Russia, Ukraine. Amanda Agati is joining us now, Chief Investment Officer of PNC Asset Management Group. Good morning, Amanda. It's good to see you, as always. So looking at this jobs report, seems like we're still on track for 25 basis points. But when you look at this economic backdrop, what does it tell you about where people should be looking in the stock market right now?
Well, there's so many dynamics at play here, but it does feel as if we are on track, as you said, for a 25 basis point hike. Powell all but confirmed that in his testimony with Congress. We think that's the right first step. We felt right along that 50 was way too aggressive right out of the gate. And then when you layer on the Russia and Ukraine conflict on top of that, there's just too many moving parts here to move that aggressively. I think net from our perspective, we're telling our clients that we prefer U.S. over international in terms of equity exposure, larger over small, and really a growth tilt over value. And it's really reflective of the very shifting macro backdrop that we're seeing. Larger tends to be a bit more defensive. Certainly, we're seeing that play out on a year-to-date basis. Growth is really somewhat of a contrarian point of view here, as everybody has sort of felt like that got way overextended from a trading perspective. But we actually think there's a lot of defense and quality and fundamental characteristics that continue to power through despite this shifting backdrop. So nothing is table pounding cheap out there despite the reset that we've seen, but there are definitely pockets of opportunity.
Man, I would say this was an inflationary jobs report. Upward revisions to the prior 2 months, a little under 100,000, I believe, and a better than expected print. Why does this market continue to just, I would say, laugh in the face of these higher inflation readings?
Well, the market, I think, is much more focused at the moment on what's happening with Russia and Ukraine. The market's really focused more on the headlines and headline risk related to that. And so there is a bit of looking past some of these near-term indicators. I think from our perspective, the report today clearly is positive. It's a step in the right direction, but it's been a very uneven recovery as it relates to the labor market. And so, again, I come back to this idea that the Fed does need to take action, certainly needs to take a step in the right direction here, but I don't see anything in today's report that suggests they need to move that aggressively right out of the gate. And so I think the market is able to kind of work through some of what we're seeing in terms of the headlines because we're starting to get some clarity on how far and how fast the Fed is going to move. But the wild card still continues to be, I think, what happens with the energy market as it relates to Russia and Ukraine. Historically speaking, geopolitical disruptions do tend to create pretty volatile backdrops in the short run for markets. We're definitely seeing that right now. But that's been a theme really since the onset of the pandemic. The wild card always tends to be what happens with energy. Are we going to see structural disruptions to the energy markets? When that starts to come into the narrative in a significant way, that's where markets tend to struggle for a more significant period of time.
I hear you on all that, Amanda. But if the market is focused on Russia and Ukraine, that event is really the reason why you've seen Brent crude almost at $120 a barrel this week. And maybe I'm reading too much out of my dusty old CFA textbooks, but doesn't that mean a company like a FedEx here is at risk? And I'm not to single out FedEx, but a company like that, multinational transport company, they're at risk from an earnings warning in the first quarter, just not delivering up to Wall Street estimates because of the inflation they are in fact seeing.
That is absolutely a key risk. Let me just step back for a second and say Q4 earnings season, while clearly prior to all of what we're seeing right now, came in well ahead of expectations, and we saw really strong positive revisions and positive guidance for 2022. Q1 is definitely going to be a wild card. We're going to have to watch very, very carefully what happens with rising input costs, wage pressure, certainly. Now we have the energy story coming into the equation. So I do think that there is an element of risk to it, but I also think that the underlying fundamental story is pretty strong. We have margins and profitability sitting at all-time highs, cyclical highs, even relative to prior cycles. And so there is a little bit of room, I think, and headroom, shock absorber, however you want to describe it, for companies in the short run to absorb some of these increasing pressures. Wildcard, again, the longer this continues, obviously, the more that potentially erodes profitability and earnings growth. But I think over a quarter or so, companies can manage through it okay. It's not going to be pretty, but I think companies can handle it all right.
Well, and it does seem like at some point this will be resolved. And to be grim, I mean, short of nuclear annihilation, life goes on. These, eventually you will see some sort of resolution, obviously acknowledging the terrible human toll that this is already taking. But given that, how do you look past, right? And how do you perhaps put this in the context of other geopolitical events that we've seen in the past and how they've affected the market?
Well, we spent a lot of time looking at geopolitical disruptions through history, going all the way back to the 1960s, a number of scenarios that we can tie some similarities to. In most cases, over a week, a month, a quarter or so, the markets have been able to shrug off those tensions and disruptions and forge a path higher, at least forge some stability, and then ultimately a path higher. The two scenarios going back to the 1960s where the market continued to struggle was really the oil embargo of 73 and when Iraq invaded Kuwait in 1990. Those led to fairly significant extended periods of pressure for markets. And so that's why I said earlier, we're very fixated on what ultimately happens with energy markets here, because that really tends to be the key variable and key driver. We haven't seen meaningful disruptions, even though prices have responded very significantly, acute spiking, right? Acute signs of stress building here. But we haven't necessarily seen structural impairments in energy markets yet. And I think it's also very indicative of why policymakers have really been very careful to thread a needle with rhetoric, policy implementation, sanctions, et cetera, to be very targeted so that they're going after, the financial aspects of Russia as opposed to shutting off Russian oil production to the globe. That will have very significant sweeping effects. That hasn't been on the table as of yet. It's obviously a tool in the toolbox, and while that is not our forecast necessarily, that is where we might start to see meaningful structural impairment in energy.
Do you think the Fed has a freak out moment later this year where they finally realize that, despite what's going on with Russia and Ukraine, I'm just assuming that the event goes on for some time, that they are well behind the curve on inflation and they're going to have to drop the hammer with a 50 basis point rate hike?
Well, I think a 50 basis point rate hike is certainly a possibility. That being said, I'm not necessarily convinced that the Fed is fully behind the curve. I know I'm sticking my neck out in a big way and saying that relative to where the consensus view is, but coming into this year, we actually felt like comparisons were going to take some of the inflationary fire out of the backdrop, all else equal. We thought supply chain normalization will also help. And so there were a number of factors in the fundamental backdrop. Also, that shift from durable goods buying like crazy to potentially more of an emergence from the pandemic and the lockdowns and a shift to more services. Leisure, hospitality, travel, et cetera, might also be a key to helping take some of the inflationary fire out of the backdrop. I definitely think that the Fed needs to act. Our economics team thinks that we'll get about 5 rate hikes this year, all else equal. So I think 50 is certainly a possibility, but I'm not necessarily convinced that the Fed is really that far behind the curve because we were coming into this year thinking that some of this was going to settle on its own. And so we were actually concerned when there were, a lot of conversations, even a month ago about an intra meeting hike and that it needs to be 50 or more right out of the gate. We thought that was way too aggressive given the backdrop. And so we're not thinking that the Fed is necessarily behind the curve, but they are going to have to continue to chip away at it. The wild card, of course, is what's happening with Russia and Ukraine. And so I think that is going to slow down this potential for supply chain normalization. And so the inflationary fire may certainly linger with us a lot longer than anybody would like. But I think the Fed can take systematic action here to get it under control.
We all hope that you're correct, Amanda. Amanda, good to see you on this Friday morning. Amanda Agati is Chief Investment Officer at PNC Asset Management Group. Thanks as always for your perspective. Appreciate it. And what Amanda was just talking about, let's look at the effect here in terms of supply chain dynamics, what's happening in Russia, Ukraine. WTI crude today, $112 a barrel. That's not the highest it's been this week, but it's still pretty darn high. And Brent crude is almost at $114 a barrel. Wheat futures continue to rise. They have not taken a break, still at the highest since about 2008. And aluminum, well, it just keeps rising to new records. It's up another 2% today. Coming up, we're going to discuss whether tech companies are benefiting from taking on Russia. We'll be right back.
Silicon Valley's tech giants are joining the rest of the business world in pulling their products and services from Russia. Yahoo Finance tech editor Dan Halley has been tracking this story for us. Dan.
That's right, Brian. They're pulling out, and it could help them in the long run. We actually just got news from Microsoft's president, Brad Smith, that they are pulling sales of their products and services within Russia. And that follows news from Apple that they are pulling sales of their products within the country, as well as cutting off things like the ability to download RT and Sputnik from the App Store within Europe. They're still allowing that within Russia, though, and the turning off of Apple Maps live traffic in Ukraine so that residents are safe in Russia, can't see where residents may be gathering or where there may be traffic jams. But when I say that they may be benefiting here, it's, obviously the humanitarian act of cutting off the ability to sell to Russia, but it also does give them a boost when it comes to their moral standing in the business community and for potential customers as well as employees and potential employees. Really, if you look at something like an Apple, they've been kind of pushing things like civil rights, the ability to protect customers. They famously went against the Justice Department when it came to creating a backdoor for iPhones because they said that would have created a backdoor that hackers could have exploited for every iPhone on Earth. So they do things like this because, yes, it's the right thing to do, but also because it benefits them. People see that, so they're more willing to shop those brands. And then employees who are currently at those companies say, well, my company does a moral thing or the moral thing in situations like this. So I'm proud to work there. And then prospective employees, especially in a market like this, where it's so hard to get a handle on new employees, they look at businesses and say, look, they're going against Russia. I think that that's the right thing to do, so I'm going to go with them. Versus if a company does not go against Russia, these employees and potential employees would say, this really isn't the place for me. Maybe I got to go somewhere else.
All right, Dan Halley, thanks so much. All right, coming up, Gap stock isn't getting crushed on an earnings day for once. We'll have more analysis of that company's quarter and results out of Costco and Sweetgreen. Stick around.
Just about 5 minutes from the opening bell on this Friday morning on this jobs report Friday. And let's just quickly recap some of the jobs numbers for you if you're just joining us. 678,000 jobs were added to the U.S. economy last month, well ahead of estimates, more than 200,000 above what economists had estimated. Unemployment rate falling to 3.8%, and average hourly wages rising by 5.1% year over year. That is worse than expected. A lot of leisure and hospitality jobs added, retail, warehousing, and transportation. A lot of different areas of growth here. There you see them sector by sector. Construction jobs also seeing a big boost along with healthcare. So a lot of different healthy segments here in terms of job additions. Saz, all of this, though, still equaling lower futures. And it seems like investors are kind of like, okay, next, that this does not change the outlook for what the Fed's going to do. And therefore, investors can move on to continuing to focus on the rise in commodity prices and what's going on in Russia.
Julia, look, by 5 o'clock today, I'm probably going to be sucking down some tequila shots and trying to figure out what in the world is this market thinking here. Just this outward focus on rate hikes, at least to me, it's not the right way to think about it. I remain very fixated on inflation, and even too, and we'll talk about this in a little bit, the ongoing supply chain challenges around the world and getting products to shelves for consumers. I didn't like what Costco told me about this last night on its earnings call. It remains a very big problem. Even Gap, too, warning about supply chain challenges.
My hope for you, my profound and fervent hope for you, is that while you are sucking down tequila shots, you are thinking about anything but what the market thinks of rate hikes.
Not going to happen.
I'm going to continue to hope. I'm going to continue. Hope springs eternal. That is my hope for you. I appreciate it. Let's talk about some of the movers here this morning because it all fits together in terms of the outlook for inflation and rate hikes. I want to start with Broadcom here because Broadcom came out with a strong quarter last quarter and a relatively strong forecast. You see the numbers there, earnings per share and revenue beating estimates. And the company said in its fiscal second quarter, revenue is going to be about $7.9 billion, $7.4 billion is what analysts had been predicting. What's interesting is Hock Tan, the CEO, talking about the outlook for the chip industry generally. And he is saying that those in the industry who are projecting that it can continue to grow at the current rate are mistaken, deluded even. That they think that we could see this kind of hot growth continue here. So very interesting. He said demand for Broadcom's electrical components up about 20% last year and is on pace to continue at that same rate this year. He said, but eventually the industry will decelerate to historical rates of about 5%. I think this is really interesting stuff, Saz.
Very interesting. And we're learning yet again, Julie, this is likely to be the year of AMD, NVIDIA, Qualcomm, and Broadcom. And by that, I mean another year of very strong results from companies that are already expected to post very strong results. Broadcom coming out here today, $3.4 billion in free cash flow. That is up from $3 billion last year. It is a very good time to be the likes of any of those companies I, in fact, mentioned. And then secondarily, the supply chain and chip shortage remains very much intact. Heard a little bit about that this week from Ford on its live stream call with investors here. Supply chain chip challenges remain continued. Costco called this out. Chip shortages impacting its availability of TVs in its stores. That ultimately is a good environment for AMD, NVIDIA, Broadcom, and Qualcomm.
Indeed. All right, we are just about a minute from the opening bell right now. And as we take a look at what's going on in the futures market this morning, we are continuing to see weakness there as we continue to see strength in commodities across the board. So it's been interesting sort of day by day because the gains in commodities have been relatively stable this week. Crude oil having a little bit of back and forth, but the reactions in stocks have not remained consistent to that. Some days we've seen increases, some days we've seen decreases. I also just want to mention the Treasury market. We are seeing yields actually fall back in the wake of the jobs report, which is quite interesting here. The 10-year yield currently well below 1.8%. So even though we had a strong jobs report, not seeing ratcheted up expectations for the Federal Reserve. And there you have the opening bell on this Friday morning. S&P Global at long last completing its acquisition of IHS Markit. That was something that had been in the works for quite some time. So interesting to see that finally close, given some of the regulatory hurdles some big acquisitions have had to go through as of late. Let's move on to some other movers, shall we? And let's talk about Gap. Oh, Brian Sazzi's favorite.
I don't want to.
Gap didn't do, so here's a little fodder for you. Gap didn't do great last quarter, right? Same store sales were up 3%. That was below estimates. Margins, 33.7% was below estimates. But the company is thinking things are looking up here. The current fiscal year, it projects earnings per share will be $1.95 to $2.15. That's better than estimated. And operating margin should be as high as 6.8%. That is also better than estimated. Brian Sazzi, I yield the floor.
No, I was looking back, Julie, to my commentary last time. I think I was a little too aggressive on Gap here, just in terms of hot takes. So I'll go a little easy on them today. In short, I don't think it was a good quarter. Don't even think it was a good earnings call from Gap. You had Banana Republic sales down 11%. You had Old Navy sales up 2% versus 2019. Here's a company that is comparing most of their numbers in their earnings release to 2019 as if 2020 didn't even exactly exist. Really, one of the only retailers to be doing nonsense like that. Nonetheless, I did not like what they said about inflation continuing in the first half of this year. Secondarily, also did not like them acknowledging they're seeing style changes at the likes of Old Navy. A lot more fashion-oriented items, Julie, as more people go back out into the wild, go to parties, go to the bars and have their own tequila shots. That is likely to impact Old Navy, which is a very basic-focused business. And then lastly, too, at what point does Gap come up here and just finally spin off this Athleta division? They called out the potential for that brand, which still has been on fire, to hit $2 billion in sales by 2023. That would be a great publicly traded company.
As a consumer, I have to admit, I'm an Athleta fan. So
great brand.
I'll leave the analysis of whether it should be a spinoff to you. But just anecdotally, that's the only Gap thing I have bought anything from in quite some time. Yeah, I guess I'm not, as these numbers definitely showed. Let's also talk about Costco as we talk about inflation, as we talk about what's going on with retailers here. Costco came out ahead of estimates, as Costco tends to do, right? The company's earnings per share beating estimates, sales beating estimates as well. Margin, it looks like, coming out ahead of estimates as well, because Costco just tends to, it's a consistent outperformer, I think it is fair to say. And analysts are coming out and commenting on this and saying that the company's market share should be able to grab market share in this environment. It also seems as though Costco is not alone, or in other words, in this price-raising environment, Costco is participating in that, Saz.
Yeah, I have a couple of thoughts here. One, this was another inflationary earnings call from a retailer. Costco talked at length about how its margins are under siege from various parts of inflation. Secondarily, I would be concerned if you're the likes of Kroger or other traditional supermarkets. Costco operates many hundreds of gas stations at its stores here, and environments with high gas price inflation, they tend to benefit. They are usually one of the last gas chains to raise prices, and in many parts of the country, their gas prices are cheap. The cheapest in town. So they tend to see a lot of traffic go there, and then those folks park in the parking lot, go into the store and buy oversized steak and mustard. So it's a good model for a Costco, of course. But lastly, the only thing you really want to care about if you're a Costco shareholder here is what they said as it pertains to potential membership price increase on the call last night. They strongly tease that this is coming. Usually they do it every 5 years. That would make it June of this year that they hike fees for members. Now, if you just do a simple Yahoo search for Brian Sazzi Costco membership fees, I wrote about this a couple months ago, and you can get a good sense of how much of a profit tailwind it could be if they do that. It's likely coming in June.
I love that you're giving people advice on Google searches today.
I'm here to help.
I wonder how many people are searching salad right now, and sweet green salad in particular. If you look at their numbers, maybe a lot. I don't know. The company is surging this morning. Revenue coming in ahead of estimates, $96.4 million versus the $84.7 million that was estimated. Same-store sales up 36%. The company did post a net loss here of about $66,000, a loss per share $1.14. But the forecast, it's opening at least 35 restaurants this year. 2022 revenue going to be at least $515 million. $513 million is what analysts have been predicting. And this year it says same-store sales will rise 20 to 26%. It's still looking to be cash flow negative for the year, but it looks like those losses are shrinking to some extent.
Cool looking restaurants, good locations, really good food. If this company cannot do something with all three of those things, just shame on them. I think it is a very good management team over there. It's a good business model. It makes sense that they could do pretty well this year and going forward.
It's just incredible to me that you have like a growth story that's a salad chain, right? It's just,
it's more than salad, Julie. Sweetgreen is you get, I believe, like baby Brussels sprouts with shaved Parmesan on it. Get some sweet potatoes chopped up. I mean, it's not just salad. I mean, there's more going on with Sweetgreen. I mean, the stock is not ripping 20% because they just sell salads. I mean, come on here.
Wow, you just tossed my whole perception of Sweetgreen.
Oh, wow. Wow, I don't have any quick pun on that one. I'll come back to you later.
Our producer asked for a pun. That was the best I could come up with on the spur of the moment. Oh, another producer says Sweetgreen's more than salad. It's a way of life. There you go. We have some passionate Sweetgreen advocates up here. All right, we got to take a quick break on that note. We'll be right back with more market reaction to what's going on in terms of the jobs report backdrop and Ukraine.
Check in with Yahoo Finance's Jared Blickery, who is manning the Wi-Fi Interactive. Jared.
That's right. A little bit of a negative price action to end the week after that big jobs report. Let's take a look right here. We can see the Dow off 1%. That is the biggest laggard of the majors. The Russell 2000 off a little bit more, that minor. But also the Nasdaq, that's off the least here. And not surprisingly, we do have bond yields heading down and in a big way. We've seen this before. This is the VIX, and we'll look at that maybe in a second. But I want to check out the lower end of the yield curve, and we can see the 5-year note is heading down 9 basis points, just continuing these big moves that we've seen in the bond market. 10-year is down 9 basis points, and the 30-year, that's down 8 basis points. That should be favoring the growth trade and hurting, I would say, the value and cyclical trade a bit. So we'll have to see what the sector action looks like. And in terms of the VIX, just kind of holding above 30 here. It doesn't look like any big price action that's going to reveal anything here. So let's get straight to the sector action, where we see energy is the least bad off. It's almost green there. You can see, and then following the downside action, we do have financials. That's off the most, over 2% to the downside, followed by consumer staples and also materials. But indeed, those lower yields are hurting some of the value and cyclical trades right now. Also checking in on travel, we have Carnival Cruise Lines in the upper right. That's down 2%, Delta down 3%. And you have to wonder what the calculus is at the Fed as well. So we're going to check out the Nasdaq, and not a whole lot of dark green or dark red. I just see ASML, that's down 4%. That's semiconductors looking a little weak. Micron off a bit, and Costco talking about their earnings. That's down 3%, guys.
I also want to talk to you about Bitcoin. There was an interesting story on Bloomberg yesterday that talked about that Russian volumes of crypto have actually been falling, which maybe disrupts the narrative that people have been trying to park assets. Russians have been trying to park assets in Bitcoin. But I'm curious what we're seeing here this morning, especially on the latest in Russia and Ukraine and the jobs report.
Well, let's get to the interactive again, and we can see Bitcoin indeed is off about 5%. And I'm glad you framed the question that way, because I think it brings up an interesting point with regard to the recent price action. This is a 6-month chart. I'm going to put on the candlesticks here. And this latest spike up, it's hard to see, but on the upper right, or excuse me, on the right side, we do have that spike up. And that's in reaction to all these events with respect to Russia. And so we do have this W bottom here. It's a technical consideration or a technical pattern. But some of the analysts I'm talking to think that the market might have read too much into the situation, that the big spike up that we've seen over the last 14 days, that would be this one right here, was simply the market getting ahead and thinking, well, the Russians are going to have to park money in Bitcoin. We're going to need to see all these volumes. And I think the evidence, and it's hard to get a track on exactly who's doing what in Bitcoin world, because there is a lot of anonymity in the ledger, of course. So it's difficult to figure these things out, but it looks like there's really not as much movement as people had anticipated. So maybe this spike was a little bit overdone. I'm still bullish long-term on crypto, but very much aware of the possibility of heading down to much lower prices. 28,000, 30,000 still my land in the sand here, guys.
And we are always aware of what you're watching in the markets. Jared Blickery, thanks so much. Okay, gas prices are spiraling higher across the United States as the Russia-Ukraine crisis casts a shadow over production. We'll be right back with a look at what higher pump prices could mean to your portfolio. Stick around.
We have been watching the spike in commodities prices pretty much across the board, from energy to metals to agriculture, because of what's been going on in Russia, the sanctions against it after it invaded Ukraine, and Russia, a big supplier, Ukraine as well, of many of these commodities. Let's talk to someone who trades these commodities, knows a lot about them. That's Scott Bauer, Prosper Trading Academy CEO. Scott, it's good to see you this morning. I want to start with energy and oil prices in particular. Are oil markets at this point pricing in the likelihood that we will see a ratcheting up of sanctions to include energy?
They are, Julie, but you know what I think when you break it down, it may be a little misguided, if you will, because the bottom line is if we sanction all of the Russian imports to here, okay, it actually is not that much. You're talking about maybe 6 to 7% of our total imports if we completely shut off the Russian imports. So while it sounds, like that's something politically we should do, for the overall amount of oil that we use here and that we import, it's actually not that much. But I think what the market is looking at is, okay, if we sanction that and the Iranian talks don't go through, that's where the problem could be. Because if the Iranian talks, if the Iranian deal does go through and we start getting oil from them, that's almost as much to offset what we would potentially lose of the imports from Russia.
Scott, we've had some folks tell us this week that oil prices have a clear shot to $150 a barrel. Let's say it hits there. Is that recessionary for the U.S.?
It all depends. Is it a shock for a week or two? Is it something that's going to sustain through the summer? And that's where I think the problem comes in, is because we're coming into the high driving season. So if the demand that we have seen even just stays the same, not only accelerates, yes, that can be absolutely recessionary, which, you bring that to the Fed and they are really behind the eight ball. Their hands are tied to what they can do. We know they're going to raise rates, but they have got to be thinking here that if this sustains, if this conflict sustains out, all these expectations that we've seen over the last few weeks from many of the big banks of maybe 7, 8, 9, 10 interest rate hikes over the next 12 months, that's got to be ratcheted down pretty severely.
Scott, what are we looking at in terms of a potential peak in gasoline at the pump prices with this kind of action that we're seeing in oil?
Well, we saw yesterday, I think San Francisco just topped $5 a gallon, and the overall U.S. average, the high over the last, 20 years was about $4.50, maybe $4.40. I think we're gonna hit that, but it's all on speculation. It's all on volatility right now. So I don't think that's going to be sustained, Julie. I really don't. I think we can see that very easily just because of the volatility, because that nature out there is, oh my God, what happens? We see that when the market gets unsettled, whether it's the equity market, whether it's the commodity space. So I think we can reach that. I don't think it's sustainable.
What's the best trade, just given everything coming at investors, what's the best trade one could put on right now to make money?
Trade or an investment?
Trade.
Okay, so I honestly, I have been shorting oil on every rip higher. I just got stopped out on my first trade for the first, over the last 6 weeks. I just got stopped out on the first one on the move the other day. I think that is for a trade, for a trader, what you want to do here is sell these rips higher with a very tight stop, buy it back. We've seen that pattern. Can oil go to 140, 150? Absolutely. That's why I use my tight stops. But that has been a pattern that has worked incredibly well. Again, this is for a trader, not as an investment.
So then we quickly have to ask you, what's your top investment right now then from a longer time horizon?
Yeah, in the commodity space, I would probably go more to the grain side, just because, as you mentioned at the top here, Russia and Ukraine, they provide 30, 35% of all wheat to the entire world. So I think that's something that is not going to pull back anytime soon. That's a space I'd want to be in at least over the next 2 to 3 months.
Bad news for bread, good news, I guess, if you're buying those wheat prices. Scott Bauer, thank you so much. Prosper Trading Academy CEO. It's great to see you. Be well, Scott. Well, coming up next, writers of stock newsletters are feeling some kind of way, I guess, about the markets right now. Brian Sozzi's back with the look of the bulls are outweighing the bears among this group. That's next. Well, one of the many ways that we tap into sentiment around the markets is by looking at an index of sentiment amongst newsletter writers. This is something that's been around on the street for a long time. Brian Sozzi, you are looking at it right now. What is it telling us?
That's right. I'm indeed looking at it right now here, Julie. So for the first time in almost 2 years, the Investors Intelligence Survey of newsletter writers showed more bears than bulls. That, in fact, ends the 6th longest streak in history, according to the folks over at Sundial Capital Research. So what does this exactly mean? And there I am right there in the middle of this chart in the thick of the action, like always. Essentially, this means that more newsletter writers expect stocks to decline than rally in the months ahead. This was the first week with fewer bulls than bears in nearly 2 years. Now, there is some interesting data here. Sundial is pointing out that when bears have outnumbered bulls, the S&P 500 has gone on to rally 11 out of 13 times the following 2 months, going back to 1970. And some of the indices that have led here during those periods, of course, it is the Nasdaq, clocking in with an almost 10% gain 2 months after. So the overall takeaway is when you're seeing this much pessimism in newsletters, perhaps that is just overdone, and it perhaps sets the groundwork for companies to come out here and just really surprise everyone with their corporate profits. Now, Julie, unclear if my morning brief newsletter on Mondays was included in this because I've been pretty bearish here, a little bearish in recent weeks, but I'll email them and find out.
Yeah, I don't know how they decide what, because it's sort of qualitative versus quantitative, right? In terms of who's bearish and bullish, unless they just send out a survey and say, how you feeling, rated on a scale of bearish to not bearish. I don't know.
Maybe it's headline driven, Julie, in part. You could say, here, stocks are going to plunge. Click here for more. That's probably a pretty bearish take. Yeah.
Yeah, I think that they asked them directly, though, but I don't know. We got to get more details on that. But there definitely has been a proliferation of newsletters, so they have more to choose from, presumably, than they used to. All right, we're gonna take a break, but before we do, I want to bring you one more mover that we are watching. It's an interesting one. Smith and Wesson. The shares are down sharply today, and that's because gun sales are down. They're getting back to more normalized levels. They had gone up during the pandemic. The CEO of Mark Smith saying in a release, the firearms market has cooled significantly from the height of the pandemic surge and seems to now be following pre-pandemic historical demand patterns. That means that sales fell 31% for the gun maker last quarter, year over year. Gross margin shrank as well, 39.6%, and earnings per share came in well below what analysts had been predicting. So Smith & Wesson shares down quite a bit. All right, before we take you to break as well, I just want to look at stocks overall and where we stand right now. We are seeing losses accelerate here. Now all three major averages down about 1 1/3%. We're going to talk much more about that, as well as get more analysis of the jobs report. Labor Secretary Marty Walsh will join us in the next hour. Coming up on 10 a.m. on this Friday, March 4th, Jobs Day here in the United States. This is Yahoo Finance Live. I'm Julie Hyman along with Brian Sozzi, and we are seeing stocks pull back on this Friday morning, although quite a lot of bouncing around within this range. Just a moment ago, we looked and all three major averages were down 1 1/3%. Now they've backed off of that just a little bit. So a lot of things that traders are throwing in the pot this morning. You've got a jobs report, you've got Russia's invasion of Ukraine and the continued essentially freezing of Russian assets, spike in commodities. There's a lot to sift through. You are seeing there the jobs report numbers. 678,000 was the growth in jobs last month, much better than estimated. Unemployment falling to 3.8%. Average hourly wages rising a little less than estimated, up by 5.1% on a year-over-year basis. Let's talk more about the jobs report. I want to bring in the Labor Secretary of the United States. That's Marty Walsh. Good morning, Mr. Secretary. I want to ask you about this jobs report, but not just the jobs report, but about the perception of the jobs report. I was struck this morning. A frequent guest on the show tweeted out a Gallup poll that just came out a few days ago that showed that Americans' perception of how the economy is going to go, not current conditions, but how they're looking for the remainder of the year, is the lowest since it's been since the beginning of the pandemic. And I just wonder, from your perspective, trying to message about the seeming strength that we're seeing in the job market, how you're sort of coping with that disconnect and how you're trying to get the message out there.
Well, I think first and foremost, it's a very good economic recovery that the president is leading. But in all reality, for the last 2 years, we're coming upon the 2-year anniversary, actually 2 years now. We've been living within a global pandemic. There's been loss of life. There's been people sick, people fearful of their health. A lot of uncertainty. Then we had the mask debate and the vaccines debates. So I think we just need to continue to. The president has stayed focused on not getting necessarily caught up in what poll numbers talk about, but actually moving our economy forward. And I think we have to continue to do that. You've talked to the financial experts. They'll tell you, aside from inflation, we have a really strong economy right now in the United States of America. We just need to continue to move forward, but also let people know to speak. The president spoke about this on Tuesday when he talked about mental health and substance use and our veterans and creating opportunities and making investments in spaces. A lot of people in our country are still fearful of this virus, so we have work to do there. So I'm not blaming them, and I don't think you can take much into the polling right now, but I think we just need to continue to do our job, and the next thing up is bringing down inflation.
And to that point, Mr. Secretary, what's your message to folks that do in fact have a job and they're getting paid pretty well, but they're going to fill up their gas tanks this week, and depending where they are, it might be over $5 a gallon. What's the message to those folks?
Well, I think right now, I think that the message today is that we're working to bring those down, but unfortunately, with what's happening in Ukraine and Russia, that could even compound it even more. I think right now on a worldwide stage, we have some issues. And obviously, we're a country that's in transition from fossil fuel to clean energy, and we're in the process of doing that. So in some cases, production supply chains have been reduced a little bit. So we just need to continue to move forward. Certainly, gas is a big issue. I filled up my car last weekend as well, although I don't drive that much. But I did fill it up, but we just need to continue to work to bring prices down. The president addressed this too, not necessarily the oil. He talked a little bit about it, but he talked about all costs of goods for the American people. And his number one bullet point was bringing the cost of goods and services down for the American people by creating more opportunities, making more in America, doing better on our supply chains, easing the supply chain burden, working with small businesses, helping small businesses, and asking companies to bring their costs down as well.
So people are being faced with those higher costs, and as we saw in this report, on a month-over-month basis, average hourly earnings didn't go up, which was a bit of a surprise here. So how do you sort of deal with that side of the equation?
Well, they've gone up 5.1, as you said earlier, 5.1% year over year. This month we saw, I think it was a 2-cent increase, something to that effect. Certainly, under normal circumstances where we wouldn't have high inflation, 5.1% is a large gain, and I think it's the biggest in quite some time in our country in a year. So we just need to continue to encourage companies to pay their workers more, work more. And on the other side, I mean, again, I can't sugarcoat this. We definitely, the president has been focused on it, and we as administration who work for the president need to work to bring these costs down. What we're doing at the Department of Labor is working on supply chain. We're working on trucking apprenticeships. We're working on other apprenticeships, on workforce development opportunities. I was at Durham Community College with the vice president on Wednesday. We were at a workforce development program. We sat down with apprentice electricians about creating pathways. Every single one of them said the reason why they went to their apprenticeship in their union is because they wanted a better job, better paying wages. We need to continue to amplify that message, but also continue to do that work.
Mr. Secretary, you've been a champion of labor for many, many years. I'm sure you saw what Elon Musk put out there regarding a potential UAW vote over at Tesla. I mean, should Tesla be unionized here?
I mean, if the workers in Tesla want to get unionized, they should be, and I would hope that Elon Musk would respect their right. Again, the way I feel when it comes to organizing, everyone should have the right to organize, and it's their call. And if workers decide to organize, then they should be recognized as a union. If workers decide not to organize in a free and fair election, then they don't have to be unionized. I think that's certainly that's been my pretty much my position my whole life, coming out of the rank and file of being a labor person and a union member. But again, I've worked with both sides of the aisle, and as labor secretary, I work with both sides. I shouldn't say both sides of the aisle. I work with workers all across America, whether they're covered by collective bargaining or not.
And just to follow up on this, Secretary Walsh, as we have been watching this sort of Tesla versus the White House, I mean, Elon Musk has been tweeting as he does. That seems to be the preferred mode of communication. But I am curious if you guys have talked to him directly about this, about the unionization effort, and just more broadly about the hiring that Tesla has been doing and the expansion of its factories.
I have not personally had a conversation with Elon or the company, but I can't speak to the fact if anyone at the White House has spoken, the president or anyone in the administration has spoken to him. I don't know the answer to that question.
Mr. Secretary,
let me put it this way.
Yeah.
I would absolutely love to. I would love to have a conversation with Mr. Musk and talk about anything that he'd like to talk about. Certainly, a big company in the United States of America. Very innovative company in the United States of America, and I'm willing to have conversations with anyone.
Well, that's great to hear. I know Elon's a big fan of Yahoo Finance, so I'm sure he's tuning in here. Mr. Secretary, you've offered your services to the MLB, which is just locked in this nasty lockout. Is there likely that we're just not going to have a baseball season this year?
No, I don't know. I just, what I want to do is encourage both sides to get back to the table. You can't get an agreement if you're not talking. And I think it's important for the fans of the United States and all across the world that watch baseball. I just encourage both sides to get back to the table and talk. And, I offered services informally, formally, whatever they want. But I do think that there's an agreement to be made there. They just need to sit down and continue dialogue.
And Secretary, I know that you've offered your services. Have you heard from them? Have you actually been talking to them about maybe being some kind of go-between there in the negotiations?
As I said earlier, I've talked to both sides at one point in this, but there's been pretty frequent negotiations up until this week. At least that's what I've been reading in the newspaper. They've been meeting, the players and the owners have been meeting. And again, I know that last week that seems to have a bit of a breakdown. But again, you can't get to an agreement if you're not having a conversation. So I just encourage both sides to get back to the table.
So true. All right, we'll leave it there. Always appreciate you giving us some time on Jobs Day. U.S. Labor Secretary Marty Walsh, have a great weekend. We'll talk to you soon.
Thank you.
All right, let's give it to Inez Ferre for a look at the markets. Inez.
And Brian, we're near the lows of the session right now. We're looking at the Dow that's down more than 400 points, the Nasdaq down more than 1%. We're looking at the S&P 500 that's also lower right now. I do want to point out Treasury yields because those have been ticking lower. We're watching the 10-year Treasury down now 12 basis points at 1.73%. The 30-year is down 9 basis points, and the 5-year is down 11 basis points. Taking a look at how financials are getting hit, well, those Treasury yields that are lower are having an effect on financials. Those are down right now, the financial sector being the laggard. We're watching the energy, which is in the green. In fact, I am going to pull up a 5-day chart just so you can see how this week we fared, and financials have been the laggard for the week, energy being the winners for the week. Looking also at the auto space, I do want to mention we are watching Tesla. Well, that's a 5-day chart, but Tesla is in the green. You've got the other automakers that are in red territory. Lucid is in the green. Tesla, by the way, just got its final approval for production at its Berlin plant. And then the travel space is heavily under pressure. Earlier this week, you'll remember Russia banned its airspace for Western airlines. You're seeing oil prices that are remaining high. So all of this is having an effect on the airlines. A 5-day chart you can see here, Delta down 15% over the last 5 days. You've got UAL United down 18% over the last 5 days. And finally, just mentioning oil, because we are seeing crude oil chugging higher, up more than 5% at over $113 per barrel. Brent crude above $115 a barrel. Brian, Julie.
Thanks for flying onto the show, Ines Ferre. We'll talk to you later. All right, let's look at a stock that we continue to watch very closely, and that is shares of hair care products maker Olaplex. The stock tanked about 6% on Thursday as a new TikTok video surfaced about a now banned ingredient in Europe being used in Olaplex products. The ingredient allegedly causes infertility. Olaplex has responded that it will tweak its formula. Good thing my hair is short. Don't go anywhere. We'll be right back. Welcome back to Yahoo Finance Live. We're seeing really the losses accelerate here in the wake of that much better than expected jobs report. The Dow now was down more than 500 points, now down about 488 points. The S&P 500 Nasdaq also deeply in the red. Again, the economy created 678,000 jobs last month. Perhaps the market sell-off reflecting just concerns around inflation and the Fed perhaps being very behind the curve in controlling those high levels of inflation. All right, let's get right to Bill Rogers, Vice President and Director of the Institute for Economic Equity at the Federal Reserve Bank of St. Louis. Bill, always nice to get some time with you. Your take on the jobs report this morning.
Well, the payroll number clearly did not disappoint. February, we saw the nice strong growth above what we were expecting. And then the previous months revised upwards. So that's good news. The other good news about it is that these increases in payroll seem to be supported by increases in participation. That is the labor force participation rate and also the employment population ratio. So that's a nice combine. You know, the one concern I do have in it is the wage number, the year over number that the secretary talked about, the 5.1% increase. compare it to what's been doing, what the CPI or Consumer Price Index has been doing, a little bit lower. So that's putting a pinch on families that are on fixed incomes, and then just in general, right? It's putting a pinch on people's disposable income because of their wage increases are being eroded by cost of living increases. But overall, for where we are in the recovery, nice strong number.
And I know, Bill, good morning, by the way. It's Julie here. I know that you focus
Hey,
on that you focus on equity in particular. And so we're hearing from economists that the reason that wage growth was flat over month was largely compositional effects. That is, more lower wage workers were added during the month, so you didn't necessarily get the lift in that number. What does that tell us about how lower wage workers, more diverse workers in some cases, are weathering this particular period of higher costs if they're not getting that wage growth?
Yeah, it's a challenge, and as you said, at the Institute for Economic Equity, we focus on the distributional issues. We focus on how the pie, so to speak, is being divided, and the way I guess I think about your question is we have to sort of step back to the conversation of where were we just before the pandemic started, right? A lot of folks thought we had the best economy since World War II, but at that time, prior to the pandemic, we had families who, if they had an unexpected bill of $400, couldn't make it. That was about 12% of, I think, households that were surveyed, and then that number is even higher if you include people who are having just difficulty meeting their pay. Wealth inequality was at an all-time high. There's a concept called ALICE, where ALICE stands for Asset Limited Income Constrained and Employed, that I helped United Way of Northern New Jersey create. And it's basically a living wage calculation. And in many communities, prior to the pandemic, you were looking at about 35, 36, 37% of households being at or below ALICE. That is not having enough resources or income to make ends meet. The pandemic then really exposed these fragilities amongst these families, particularly for women, particularly for families of color, and what's happened is all the groups took a major hit in their employment and wages, and if everybody has recovered. But the problem I have, or a concern I have, is we don't want to use pre-pandemic as our benchmark. Let's get back to the pre-pandemic level, because pre-pandemic level, the economy or many households were in fragile or very, month to month sort of movements or experiences in terms of, and then thus having the potential challenge of being resilient. So, it's great for us to get back to the pre-pandemic, but it also means that we need to look at a whole menu of choices or solutions that can help to restore resiliency, that can help to restore economic security in a broader based sense.
Despite the wage gains, Bill, over the past year, are these high levels of inflation pushing more families into poverty?
That's a great question. At this stage, we don't know just yet. But my intuition would be that that the sustained increases in cost of living, and particularly because they're broad based. It's not just energy. It's been childcare, it's healthcare, right? It's food and clothing. And so when those numbers do come out, we probably will see a potential uptick in poverty. But the other thing is, when I mentioned this concept called ALICE, right? ALICE includes people who are, by definition, from the government, in poverty. But more importantly, it includes middle income families, right? And that's the big problem that the secretary, I think he alluded to, is that particularly because of the decline in unions and other practices, right? We've seen more middle income families, instead of their incomes and earnings tracking the top fifth of the economy of workers and families over the last few decades, their incomes have been tracking the bottom fifth of the wage ladder, and that's again what we are focusing on at the Institute, to try to help people understand that the pre-pandemic level is great to get us back, but it's not where we want to be.
And Bill, I'm curious too, when rates start to go higher, obviously inflation is pinching everyone, particularly these folks you're talking about. What will higher rates do? Because I should know this. I don't know what level of debt, for example, these folks carry. So what effect is that going to have?
When you're saying higher rates, higher interest rates?
Yes.
Yeah, that's the question why you're starting to move into FOMC policy, and I really need to sort of leave that to my bank president Jim Bullard and Mr. Powell, Chairman Powell, and his colleagues to really be able to answer that question best for you. But from our perspective, as Institute for Equity, we just published something we called the State of Economic Equity. It was a 6-blog series. And one of the big takeaways for us is that 2022 is going to be a period of transition, that we're thinking that the economy is going to stay strong enough to provide opportunity for those lower and middle income communities such that they can restore resiliency, they can restore their emergency savings, they can restore their wealth, their ability to access affordable housing. Because if we don't do these kind of reimagination approaches for helping families and communities, we're just setting ourselves up for the next shock, which could be another COVID-19. It could be a shock from abroad, but the bottom line is we can make the choices to do so, and that's what we're trying to do to help people understand those choices.
Always great to get some time with you. Bill Rogers, Vice President and Director of the Institute for Economic Equity at the Federal Reserve Bank of St. Louis. Good to see you. Have a great weekend.
You too. Thanks.
All right, we'll have more of today's top business headlines on the other side of the break. But before we go, take a look at some of the stocks weighing on the Dow right now, seeing really American Express shares taking a hit after that better than expected jobs report. Visa not too far behind. We'll be right back.
Some other business headlines we're watching right now. Purdue Pharma has agreed to an updated settlement over its role in the opioid crisis. The Sackler family will pay as much as $6 billion in cash to settle lawsuits against them. As part of that deal, the family will also relinquish control of Purdue Pharma, which will be converted into an entity whose profits can be used to help fight the opioid crisis. The new settlement marks an increase of the original $4.5 billion offered by the family, whose wealth is estimated to total about $11 billion. The new deal still has to be approved by a federal bankruptcy judge. The Federal Trade Commission is approaching a deadline this month for making a decision on whether or not to approve Amazon's acquisition of movie studio MGM for $8.5 billion. Amazon said it's provided the FTC with all the necessary documents to move the deal forward. That's according to the Wall Street Journal. The company hopes to force the FTC to make a decision. Amazon originally announced interest in MGM last May. And Pete Davidson might be going to space. The Saturday Night Live comedian reportedly close to signing a deal to go on a Blue Origin flight with Jeff Bezos. If Davidson takes the flight, he will follow in the footsteps of other celebrities like Michael Strahan and William Shatner. Blue Origin flights reach 62 miles above Earth, which is widely considered to be outer space. We shall see. And another story that we're watching this morning has to do with Splunk, which is a buzzy software company. It's software that are used by companies' information technology and security operations. It recently very recently, earlier this week, announced it was getting a new CEO, Gary Steele. And now a private equity firm, Hellman & Friedman, according to the Wall Street Journal, is taking a 7.5% stake in the company. So yet another perhaps activist getting involved. And we've had a lot of these situations. And it feels like they're ratcheting up, Saz.
Yeah, say that name 5 times fast, Julie. Splunk, 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 Splunk. Wow, that's not bad, doing on live T. Pretty good. But nonetheless, look, this might be just a play in terms of looking at it from a private equity perspective on Splunk ultimately getting sold. Keep in mind, 3 weeks ago, it was rumored that Cisco has made an overture to Splunk. Now, Cisco declined to comment to Yahoo Finance on that report, as did Splunk. But nonetheless, you have a new CEO in here named Gary Steele. He was the founding CEO over at Proofpoint, another software maker. So theoretically, you have someone here that knows what they're doing, understands the software space. At the end of the day, Julie, who would you want? Do you want anyone else running your company than someone with the last name of Steele? Steele is going to turn this company around, start delivering better results, because they haven't delivered the past 2 years. That's why the old CEO got the boot.
Is this what our criteria is now, I guess?
Analysis you can use. Analysis you can trust.
Indeed. All right. We're going to take a break. Coming up, the CEO of payroll services giant Paychex is going to join us with his take on today's jobs report, as well as the latest data from the company on small businesses. Keep it right here.
The economy created 678,000 jobs in February, but how is job creation doing among small businesses? Paycheck's Chairman and CEO Marty Mucci joins us now. Marty, always nice to see you here. So let's get your take on the jobs report, and then, what are you seeing from the small business perspective, which I know is very important to your business?
Yeah, Brian, very consistent, really. I mean, this was a great jobs number this morning. And small business, we saw in our Paycheck Small Business Index was very similar. While there wasn't much growth in the job rate from January to February, we're up about just under 8% over last year from a job growth perspective. And wages continue to be very strong, 4.8% wage growth over last year. And in some regions of the country and in some jobs, well over 5%. So we're really seeing really strong wage growth as well as job growth.
Marty, it's Julie here. I wonder if you can give us even more color on that wage growth in particular, because obviously the headline number there within the jobs report was disappointing, right? It didn't show any growth from January to February. So I'm wondering what you're seeing in your numbers in terms of where that strength is coming from.
Yeah, that was surprising. And, you never know if there'll be some adjustments there because we saw continued growth. It's been about 4.5%. It jumped up to about 4.8% for our index. So we're seeing good, strong wage growth. And I think still overall, even though there wasn't month-to-month change in the national BLS numbers, I do think that you'll probably continue to see that. There is just, as you know, it's one of the toughest things out there right now for small and mid-sized businesses. Trying to find people, wages are going up. You're attracting them with upfront bonuses. The only other thing is maybe, leisure and hospitality took a big jump in the month in the BLS numbers and in ours. And, that could be bringing lower wages in. So overall, you're not seeing as much of a change from month to month. That could also be impacting it is the distribution of where the jobs are coming from.
When you're out there talking to small and medium-sized businesses right now, how concerned are they about inflation? And then more importantly, how are they responding to inflation?
Yeah, it's putting a lot of pressure on them. Supply chain, the inflation, the prices of all of their goods that are coming in. The good news is they have strong demand. So they are going to have to be raising prices. And some are already doing that. When you look at the leisure and hospitality and, in particular, they're raising their prices. They're paying higher wages, higher costs for their food and supplies and so forth. And they're going to have to react in price. Now, those that can't are really having tighter margins right now in the short term and hoping that that's going to alleviate over the next few months.
Marty, I'm curious if you guys have been raising your prices at all. What kind of input cost pressures you've been seeing and whether you feel limited by the fact that many of your clients are also under such pressure?
Yeah, we've held our price increase pretty tightly. We look at prices for different services. If there's higher demand and from a competitive standpoint, it makes sense. Particularly our HR outsourcing services right now, seeing tremendous growth in need from our client set. But we're trying to be very careful with the prices, knowing that the over 700,000 businesses that we serve, are feeling the effects. And so we're trying to be very tight on those increases. We typically keep our price increases somewhere in the 2 to 3% range on an annual basis. And we'll continue to look at that and try to cut costs where we can. Mostly our costs are labor costs, but we've done a good job of bringing people in now and getting them trained and up to speed to help our clients.
As someone leading a very large and significant company, Marty, how concerned are you about rising interest rates? There's just the threat of the Fed raising 25 basis points in March, whatever it might be. Does that change how you think about investing in your business for the next couple of years?
Well, the investments, especially in a technology business like ours, really are critical that you continue to invest in the business. And we have been very good at finding ways to cut costs in other places to be able to make sure that those tech investments continue to happen. On the flip side of it, as interest rates go up, frankly, Paychex is one of those companies because we carry about $4 billion in float, basically, as we withhold our clients' money to then pay for them. We pay the taxes for them. In between that time, we have about $4 billion in float. So an increase in interest rates actually helps our business in some ways. We just don't want it to damage the overall business climate and hurt our clients and the startup of new businesses.
Before I let you go, Marty, I do want to highlight, or maybe you could perhaps highlight some of the efforts your employees are taking to help those in Ukraine right now.
Yeah, Paychex, our foundation has stepped up to make a donation to Ukraine to help. And we also offered our employees paycheck deductions from their pay if they'd like to make a donation as well. And that has gone up significantly. We just began offering this yesterday to our employees. We've already reached over $30,000 from our employees. There's such great connections to Ukraine. And even if there isn't a direct family or friend connection, they're really just horrified by what they're watching, and they want to give and support as much as they can in money and in goods and services. We're very proud of our employees and how they've stepped up, and we'll stick together and help them on this as well.
Real great to see efforts like that. Paychex Chairman and CEO Marty Mucci, always good to see you. Have a great weekend.
Thanks, Brian.
All right, coming up, toy maker Funko is out with a better than expected outlook, and the stock is ripping higher. We'll be right back with the company's CEO on the other side of the break. Funko isn't playing games with its profit outlook for this year. The toy maker issued guidance that was notably above analyst estimates despite various inflationary pressures. Joining us for more is Funko CEO Andrew Perlmutter. Andrew, nice to see you again here. Good quarter from Funko here, but I have to start with the outlook because that is what the stock is trading off here. By my estimates, 30 cents more than some of the analyst estimates out there for this year. What gives you the confidence in hitting this outlook?
Well, thanks for having me on today. Coming off of a great 2021, the continued momentum in all of our initiatives across the board, from growing internationally to furthering our direct consumer business, growing the core business is one of the major pillars, and then continued product innovation that leads to revenue diversification. These are all elements that gives me the confidence with our current team to build for the future. And we're really excited about where this brand is heading.
Within that outlook, Andrew, are there certain new content releases that you see as very, very important to you hitting those numbers?
That's an interesting question. So as the company continues to evolve, we're still, very pop culture whether it's video game releases or tentpole movie releases. Now we've really moved the focus or part of our focus to music and sports. These are all various elements that go into creating the special output that Funko has. And so while we're always excited about various new content coming out, whether it's the Mandalorian or the new Jurassic Park movie or Batman, these are all things that we love as a company and as a culture. That being said, that we're pretty well diversified across all of our properties, so there's not really any one specific one that's going to drive incrementality. Right now, we're looking at basically growing all elements of our business.
Andrew, it's Julie here. I want to ask you about input costs. I know you guys are planning to raise prices. I think some of that is already sort of in progress. And your collectibles are made with resins that I believe are made from petroleum, which, as we have all been watching on our screens, keeps going up and up and up. And so how are you guys sort of thinking about that and controlling for that?
Yeah, so we've got our eye on that as well. We did do a price increase in Q4 of last year, which will largely start to take effect in Q1 of this year. And we're keeping a close eye on that. We think we're well positioned for the near term to help control against whether it's the increase in petroleum or the continued freight headwinds that we have on shipping and logistics issues that we're running into. Everybody's running into. So we think we're pretty well positioned to account for some of those inflationary issues that are popping up.
And Andrew, you're very much an international business with a presence in Europe. I'm not too familiar if you ship products to Russia, but if you do, have you halted them? And how are you thinking about your European expansion in light of what we've been seeing between Russia and Ukraine?
Yeah, we have a keen interest in Europe. We do business in both Ukraine and in Russia. Currently, we have put a pause on the situation and shipping into Russia for the time being. That doesn't talk to the love that we have for our fans globally. We love our fans. That being said, we are ingesting what's happening, and we're going to keep a close eye on any regulatory issues that come down the pike that we need to really follow. But for right now, we've just taken a little bit of a pause.
Andrew, I believe you guys did a. Oh, sorry. Go ahead, Saz.
Go ahead, Julie. Go ahead.
I was just going to ask about your restructuring that you guys did. I believe internally you sort of rejiggered things. For investors, what do they need to know about that and what it's going to do for execution for you guys?
That's a great question. We are organizing for the future growth that I talked about on yesterday's call. We are excited about the opportunities ahead, and we are building an organization to reflect the company that will drive us to those goals, those both 3 5-year goals that we talked about, specifically the 3-year goals. And so the work that we've done to help organize how we think about our brands, whether it's the Pop brand or the Loungefly brand or some of our more emerging brands like toys and games and the digital brand with digital Pop NFTs, we are building out a organization to deliver against our expectations for those verticals as we move forward.
Andrew, have you, just given what Julie was mentioning on the all front, have you had to re-engineer how you make a Funko figurine?
No, we haven't. We're always looking at ways to innovate, within the product line for the Pop brand specifically. That's one of the key things that we're focused on when we talk about maximizing the core business. Innovation is at the key of that. And so we are always looking at different ways to, whether it's, grow the Pop brand through innovative products that maybe look and feel a little bit different. But yeah, we're always focused on innovation on how we continue to evolve the brand.
Hey, lastly, how many of these do you have in your house?
That's a great question. So, I actually have quite a few. I'm a collector. And so my wife asks me to keep most of it at the office because, I'm a toy nerd. I've got, a lot of action figures that aren't taken out of the package, can't take them out of the package. And I also collect skateboard decks, and I, collect Funko. So, my collection is ever growing to the point where, yeah, a lot of it has to be put into the office.
I appreciate your measured response. We'll leave it there. CEO Andrew Perlmutter, good to see you again. Have a great weekend.
Thank you so much. Good to see you as well.
All right, let's do a quick check of the markets here. Really seeing the markets under a lot more pressure since that jobs report, which feels like 12 hours ago. It really wasn't. It was around 8:30 this morning. I think the Dow down close to 500 points, the S&P 500 and Nasdaq in the red. Really interesting action over there in the Nasdaq in light of that hotter than expected jobs report. All right, if you are headed to the gas station this weekend, you may be in for some sticker shock. We'll have some final thoughts on the rise in gas prices when we come back.
We continue to see stocks under pressure this morning in the wake of a jobs report that was largely better than estimated. Our Jared Blickery has been digging into the action here. So, Jared, what's sort of the big picture takeaway? Let's start there. Is it that investors are more focused on Russia, Ukraine, and commodities price spiking than they are on the jobs report? What's going on here?
I think it's both at this point. And you take a look at the market action, or the market reaction to the jobs report. The first move, usually a little bit of misdirection here. And you're looking at the Nasdaq Composite. This is a 2-month chart. And you can see at the very right edge of it, we have broken down out of the prior 5-day range. Now, if you take a look at the S&P 500, you can see we are still in this range. So we've basically been tracing out the same pattern for 6 days now. Is the next direction? What is that going to be? Well, we've been here before. Here's another period of consolidation. In this case, we broke to the downside, came back up, and here we are. So is it going to repeat? Are we going to break to the downside like this? Or are we going to break out, maybe come back a little, and who knows? Why not? To the moon. We'll have to see what comes of that. But Also want to check out the Russell 2000. Small caps looks pretty much the same as the S&P 500. Just back to the jobs report, I think the headline numbers came in stronger than anticipated, with the exception of that labor wage growth number, which could be due to those compositional effects that we were talking about. If you just kind of take that out of the equation, it might require a Fed that's a little bit more hawkish than people had anticipated. But that's not being reflected in the federal funds futures markets right now. We're looking at the 30-year on our screen, but I'm talking about the benchmark rate and the futures for it, because there is now a 6% chance of no rate hike in March. Does anybody think that's really going to happen? No, but the fact that it's becoming more probable and coming off zero, I think is quite relevant to the situation. So let's take a look at some of our heat maps here. Here's the travel and reopening phase. This is a 5-day look. We can see lots of downside action here. In fact, this is the worst week for travel if it ends this way since what, mid-2020. So really taking the wind out of the sails. And I think this is really more the Russia-Ukraine situation than it is the Federal Reserve situation with respect to this particular group. But let's take a look at the sector action for the entire week. And we see energy, not surprisingly, with crude touching $116 per barrel. That's WTI. Energy up 7.7%, followed by utilities, real estate, and industrials. But the fact that utilities and real estate playing so prominently in this list just tells me it's more defensive than offensive here, more bearish than bullish. And financials just getting whacked to the downside with the depressed yields and that fall down in yields that we saw because of the Russia situation. After that, tech and then consumer discretionary. Those are the sectors that house things like Amazon, as well, of course, Apple. So a lot of the mega caps in there. Overall, let's take a look at the Nasdaq 100. So there you see it. Amazon down 6% for the week. NVIDIA down 5%. Facebook down nearly 5%. Only green among the mega caps is Tesla. But even EV, which was faltering yesterday, having a pretty bad week here. We can see GM down 10%. Lucid Motors, I believe they announced earnings this week. They're down 14%. So list goes on, but you kind of get the idea here. Not exactly risk on.
Yeah, Lucid had announced a price increase and then changed its mind, which didn't help its shares. Jared, can we go back to travel for just a second here? Because I think we should really emphasize the sort of carnage that we're seeing within that group. And it feels like, say if you look at, I don't know, take any of these, take whatever you want to use as representative, and the sort of fits and starts over the longer term that we have had. I mean, like, it was like, okay, each wave of the pandemic obviously hit these guys anew. We're recovering a little bit, no, then we're pulling back. Then we're recovering a little bit, then we're pulling back. And now you have Russia's invasion of Ukraine as the latest hit, right? And this latest concern, not only the concern that European travel is not going to recover, you know, that was something investors have been waiting for, international travel. But obviously, fuel prices, what is that going to do to margins for these companies? Yes, they hedge, they buy in advance, but nonetheless, this has got to hurt. So it's just remarkable, the moves that we are seeing in those travel stocks.
I agree. And you take any one of these charts, they all pretty much look the same. You have this pandemic low right here, and then you have a rise into early 2021, but then it's just a series of lower highs and lower lows here. So that's a downtrend. You could make the case that maybe this is a flag of some sort, but you brought up an interesting point. Europe is going to get hard and is getting hit harder, much harder than the US because of their proximity, because of their exposure. And I read a report yesterday that the surging fuel prices are going to add $20 to the average ticket price of an airline, $80 for some of the longer haul flights. So you add that up and you wonder, do the airlines have this kind of pricing power? I think in the short term, yeah, because if people want to go somewhere, they're going to go there. But it's going to start creeping up in people's minds that travel is more expensive. They don't want to necessarily do that.
Yeah, we already know that driving is more expensive. I mean, that's in your face when you go and fill up at the pump. And size, another stock that you've been watching that's been trending for us. What, are you toasting us with your energy drink? Is Gap. The shares are now down after they had been higher earlier.
I'm recaffeinating. I got stories to write to you guys after I get off this show. But look, Gap, right move here. That stock popped double digits after the earnings last night. This morning was up close to 8%. We did our live analysis of Gap's quarter around 927. Quarter made no sense. Old Navy wasn't good. Conference call wasn't that good. Still battling inflationary pressures. Still seeing pressures in the supply chain. So I think the market has it right here. And of course, Julie, not helping matters, that flat wage number in today's jobs report. Perhaps you don't go out there and buy the new Kanye West $100 jacket, or is it 100? I don't know, but it's still very inflation.
Whatever it is. Well, that kind of fuel prices have been going up. I think Monster Beverage is up on Jared Blickery's Interactive, Yahoo Finance Interactive right now. But gasoline, as I mentioned, is going up. I mean, you've been taking pictures when you fill up at the pump, I know, Saz, and this is something that is, top of mind for people right now. Look at that Monster Beverage chart.
I'm terrified. Terrified going. They just a new 7-Eleven just opened by my house last week. I paid $4.50 a gallon for premium because that's what my car needs. I'm looking probably over $5 a gallon this week. It's a big bite out of my budget, Julie. I have a lot of fixed costs. My margins are going down.
All of your inputs, all of your fuels are going up. It's unfortunate here. Maybe you should cut back on the energy beverages.
I said something. I think I misspoke the other day because Sazi was asking me about my scooter, and I said it only takes 50 cents to charge it. But electricity price has tripled in my neighborhood over the winter, especially in January. So it was $1.50 is my bottom.
Guys, walking to work now. Walking to work.
Cool $1.50. All right. Thank you so much, Jared. Appreciate it. That does it for Mr. Sazi and I. He's going to go drink some more caffeine and write a bunch of stories. And then he's going to have his tequila at 5 p.m. We know about the full consumption trajectory of Brian Sazi's day. Brian Chung.
I want our audience to know everything about me. I'm here to share.
All right. We gotta go. All right. Brian and Akiko will be up next.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. We are 90 minutes into the trading day on this Friday, and we are seeing a sell-off on Wall Street. Those losses accelerating here with all three major indices deep in the red. We're looking at the Dow down more than 500 points, the Nasdaq down 268, and the S&P 500 down 71. The war in Ukraine continuing to weigh on investors. A Russian attack on Europe's largest nuclear power plant, heightening fears that the worst is yet to come. Those concerns are outweighing a strong jobs report, with the U.S. economy adding 678,000 jobs in February. We are breaking down the numbers and the implications for Fed policy up ahead. And resolve in the face of war. We are talking to the CEO of one Ukrainian tech company about the challenges he faces in keeping business going. Employees at software developer Makpa are hunkering down amid the fighting, and we've got CEO and founder Alexander Kosovan joining us later this hour. We are beginning, though, this hour with the market actions. And Brian, we have seen the losses accelerate here in the session, off of the session lows, but the Dow still down about 500 points. We saw the stocks pare back some of those losses right after that, as we saw investors trying to digest that jobs report. It did come in stronger than expected, but it feels like this is really all about the war in Ukraine. And we've seen commodity prices spiking as well, with Brent crude futures trading at $115 a barrel, Brian.
Yeah, Nikiko, this is just one of those days where it's impossible to parse out exactly what is driving the market action, with so much news around Ukraine, Russia, the jobs report this morning, and then, of course, all the earnings that we're still getting. But if we take a look at the Wi-Fi Interactive, you can see really just the massive amount of market movements that we've seen with the Nasdaq Composite. Watch the big tech stocks today down about 2%. But I'm really looking at the fear index as well, the VIX up to about a 34 handle. When you take a look at a 5-day, this is an interesting reversal that we've seen towards the end of the week, when you consider the fact that we had seen the volatility index, again also known as the fear index, decline to about 30 in the middle of the week. But really, where we're seeing a lot of volatility, not just in equities markets, but take a look at bond markets as well. It's been a very, very rocky round trip in many cases for those in the longer end of the yield curve, with the 10-year yield bouncing up and down over the course of this week. And it was about 200 basis points as of the beginning of this week. On Monday, it went down to below 180 basis points, went back up yesterday, and now we're back down 13 basis points to 1.71% on the 10-year. Of course, a lot of fixation on Russia itself. And when we take a look at the heat map, the big story of the day does remain the Russian ruble, with devaluation against the U.S. dollar continuing. Now one U.S. dollar getting you about 104 Russian rubles. Again, we had seen it as high as about almost 120 in terms of Russian rubles to U.S. dollars. But again, interesting to see as the developments over the weekend continue, whether or not this trend will continue. But again, Akiko, so much market action and that volatility in the VIX index really underscoring just how uncertain the picture is overall for investors.
Yeah, I mean, those charts say it all, of course. But Brian, we haven't even talked about the jobs report. That is, if there is a silver lining today, kind of the positive news on the day. We did get that report this morning, 678,000 jobs added in the month of February. The unemployment rate edged lower to 3.8%. Hourly wages, though, remained flat. Let's bring in our first guest for the hour. We've got Annetta Markowska. She's Jefferies' chief financial economist. Annetta, walk me through your thoughts here. What stood out to you in the report we got out this morning?
Well, of course, the big shocker was the wage number. But look, first, I mean, I think just to see that there is really no loss of momentum in employment data, I think that's very reassuring. You know, we've averaged about 550,000 jobs this year, which is right in line with last year's average. So, you know, for a lot of the concern about growth really slowing materially this year, certainly not seeing any evidence of that in the employment data. So that's very reassuring. The wage number certainly was a curveball. And, you know, at face value, this really does look like a Goldilocks report, right, where you're getting a lot of jobs and potentially moderating wage inflation. The question is, should we be extrapolating from this wage number? Is this really some kind of a structural shift and departure from what we've seen last year? And I don't really think that we can conclude that. You know, I am inclined to look through this number for a few reasons. One, if you look under the hood, there was a lot of dispersion in wage growth. The numbers were really all over the place. You had a 1% decline in financial services. You had big increases in other sectors. So there's no evidence of a broad-based slowdown in wages. Non-supervisory wages actually rose by 0.3, and they were up 6.7% on a year-over-year basis. So if anything, the weakness was skewed toward white-collar workers, and people at the sort of in the bottom half of the income distribution still have a lot of pricing power. And then finally, even if you take the 5.1 wage inflation at face value, it's still consistent with the steepest Phillips curve that we've seen in 3 decades. So, it's really just too early to conclude that, that the Phillips curve is flattening or normalizing and sort of we're going back to normal.
Hey, it's Brian Chung here. I mean, that's kind of a good economics 101 viewpoint of the jobs report. But from a kind of anecdotal standpoint, what we know is that we're heading into the warmer months of the year, and people are going to go out. There's going to be a lot of seasonal hiring and hopefully a lot more leisure travel, especially now that we're over the Omicron wave. So just off of that storyline there, what does this jobs report tell you about the strength that we should expect or could expect in the months to come?
Look, there's obviously a lot of concern about real wages, right? Because we know that inflation is going to accelerate pretty significantly here in the next 2 months. We're probably on track to hit 8% inflation by March, just given what we've seen in energy and commodity markets. So in the very near term, consumers are certainly going to get squeezed. The question for the second half is still wide open because I still think there are a lot of reasons for inflation to slow later this year. Even commodity curves are projecting that this is sort of short-lived spike that will be followed by price declines. And there are a lot of reasons to believe that wage inflation will actually continue to accelerate. Look, we're 4 months from basically exhausting all remaining labor market slack. And as I mentioned, we're still on a very steep Phillips curve. And, if I were at the Fed, I would actually worry that as energy prices and food prices spike in the coming months, that will actually start to feed into wages and inflation expectations. And rather than turning into a stagflationary shock, which is what a lot of people are concerned about, that this could easily sort of amplify the inflationary pressures that we've seen to date. So I think, from the Fed standpoint, this just means that they have to keep normalizing. That's the number one priority right now.
So let's talk a bit more about what the implications are for the Fed, Annetta, because we're looking at a jobs report, the last one before this next meeting. And it feels like there is a new risk that has been injected into the thinking here, which is the Russian invasion of Ukraine. Certainly elevated concerns around inflation with commodity prices spiking. How do you think the jobs picture we're seeing today factors into the decision making come 2 weeks?
I really don't think it changes anything. The Fed, basically told us that, again, their priority is just normalizing policy, getting away from neutral. If we were sitting at neutral rates today, I think it would be a very different conversation. And I think the Fed would have to be more attuned to the downside risks to growth, emanating from this crisis. But we're sitting well below, where rates should be. And so the Fed, that sort of changes everything. That's why the Fed really doesn't have the luxury of potentially helping to, offset some of these financial shocks. And again, I think there is a risk that this doesn't actually turn into a sort of a disinflationary shock, which if we were sitting here 3 years ago and energy went up, 30-40%, this would absolutely have been a stagflationary shock and the Fed would be talking about cutting rates. But we're starting from a position of very high inflation, elevated inflation expectations, a very steep Phillips curve, and a very tight labor market, and that changes everything. And I think the Fed's concern has to continue to be for inflation. So they're unfortunately really not in a position to, to help support markets here, unless this really turns into a sort of a massive tail scenario.
So on that point, we're going to get another really important data point from the Consumer Price Index next week, which is going to be very interesting because that's during that Fed blackout period leading up to their next meeting on March 16, which means this print will come out and then we'll hear nothing from the Fed until they make their abrupt announcement on the Wednesday afterwards. So the Federal Reserve Chair, Jay Powell, already told Congress, though, that he's expecting a 25 basis point increase, which is a bit unusual for a Fed chairman to say outright, especially with data points having not come out yet when he said that earlier this week. So are we all set and done? We can just pack up and go home. We already know exactly what's going to happen March 16?
I think pretty much. And it was interesting that he was so forthcoming in terms of essentially pre-announcing the hike. And I think it really underscores, the Fed does not want to be adding to the uncertainty. They recognize that there's tremendous uncertainty out there in the market. They can obviously, help by cutting rates, but at the very least that they can do is to try not to contribute to that uncertainty. And I think that was the reason he decided to go ahead and essentially pre-announce what they're going to do in March. He also told us that they're going to announce not the timing of balance sheet reduction, but that they are going to make a decision about the pace of runoff subject to caps. So presumably we'll get, some idea, pretty good idea of what that pace is going to be once they start. So he's given us an unusual amount of information, and I think, there's sort of very few surprises left for this meeting.
Famous last words, Annetta. We'll see if it does, in fact, play out that way. Annetta Markowska, Jefferies' chief financial economist. Good to have you on today. Well, let's now turn to the very latest on the conflict in Ukraine. Russian troops have now taken Europe's largest nuclear power plant hours after rocket attacks sparked a fire at the site. That sent alarms across the world about a potential nuclear disaster overnight. Now, firefighters have extinguished the flames, but Ukrainian officials say several people were killed in the attack. Russian forces continue to advance in southern Ukraine, with Kherson now firmly in their control. The military has its sights set on Mykolaiv in an attempt to take control of the coast along the Black Sea. Over in Brussels, NATO members today rejected Ukrainian calls for a no-fly zone over their airspace, saying the alliance is not a part of this conflict. Secretary General Jens Stoltenberg stressing that NATO is a defensive military alliance. Take a listen.
And of course, the only way to implement a no-fly zone is to send NATO planes, fighter planes, into Ukrainian airspace, and then impose that no-fly zone by shooting down Russian planes. And our assessment is that we understand the desperation, but we also believe that if we did that, we'll end up with something that could end in a full-fledged war in Europe, involving many more countries, and causing much more human suffering.
EU members are now considering additional sanctions, including cutting more Russian banks out of the SWIFT financial payment system. Let's bring in our guest, Brian Whitmore, Atlantic Council Eurasia Center non-resident senior fellow. And Brian, I think a lot of people are trying to process what played out, at least overnight, here in the U.S. with that attack on the nuclear power plant. What does that tell you in terms of the strategy for Vladimir Putin and how far he's willing to go in this conflict?
Thank you, Kika. It tells me that Vladimir Putin is willing to escalate this conflict. If he's willing to try to risk a nuclear disaster by taking a nuclear power plant, I'm expecting Mr. Putin to only escalate farther. He's been genuinely surprised by the fierce resistance that the Ukrainian armed forces and Ukrainian citizens have put up. This should not have come as a surprise to him. Anybody that knows that country knows that Ukrainians are fiercely patriotic and we're going to fight for their independence and their sovereignty. But nevertheless, the Putin is increasingly frustrated, and he's going to be resorting to increasingly aggressive tactics. I expect carpet bombings of major cities, including Kyiv and Kharkiv. And then I think we're looking at a long, protracted war here.
Brian, what do you see as a possible resolution here? I mean, there were discussions last week that maybe China was going to try to broker a conversation. We know that there was a meeting in Belarus between Russia and Ukraine that didn't yield anything. I mean, what could bring both these parties back to the negotiating table, or do you really not see any sort of short-term resolution here?
Well, Brian, this is the issue. This is the problem. I mean, myself and a lot of other analysts that have been following this, it's hard to imagine the end game here, because Putin believes he is on a messianic mission to put pieces of the Soviet Union back together again. There isn't really a compromise to broker here. Either Ukraine is going to be a sovereign, independent state, or it's not. So I every time there is talk of negotiations, I just have a problem envisioning a negotiated settlement here. I don't see what that could possibly be. Putin wants Ukraine back under his thumb or under Russia's thumb, and Ukraine wants to remain an independent country. I don't see a middle ground there.
But is it ultimately about regime change? Is it about securing that coast along the Black Sea, which is strategically important for Russia? Or is it about taking all of Ukraine?
Well, I mean, the ultimate goal is regime change. The ultimate goal, and Putin has not really kept this ambiguous. The ultimate goal is to overthrow the Volodymyr Zelensky's government in Kyiv and put a pro-Moscow puppet government in place. The problem with that is that government is not going to last an hour without a Russian occupation to prop it up. And you're going to need troops in Ukraine in an order of magnitude much higher than they already have there now in order to prop up a pro-Russian government. So regardless of how this plays out, even if Russia is successful, yes, seizing the Black Sea coast is a tactic toward that aim of overthrowing the government in Kyiv. But even if Russia is successful, we're looking at because the Ukrainian insurgency is going to continue. As I said, Ukrainians are fiercely patriotic, tough and resilient, and they're going to fight for their country until the last Ukrainian is standing. And so even if Russia is successful, we're looking at a protracted insurgency that could last for years.
So when we talk about the economic sanctions that have been imposed on Russia, I mean, how long can they keep this going? They only have so much money they can burn through to not only actually finance the operations here that they're doing in Ukraine, but also just to defend their own ruble. Do you see the West as having used up all of its bullets in terms of clamping down economically on Russia, or do you see them kind of capitulating sometime soon?
Well, Brian, you hit on the central issue here. We're kind of in a race against time. Can the Ukrainians hold out long enough for the sanctions to really start to bite where they begin to threaten Vladimir Putin's ability to wage war and ultimately possibly his rule? We still have a little bit we can ratchet up on. We have not we have not imposed energy sanctions for very obvious reasons. The effect those are going to have on the world market, the effect they're going to have on European supply. So that's one area where we could still escalate on the sanctions. More banks could be added could be excluded from the SWIFT payment system. That's another area we can escalate. Another is putting more banks on Treasury's SDN sanctions list. There's several banks were placed on the SDN sanctions list. More can be placed on the SDN sanctions list. So there is still a little bit of room to escalate, but it's really a race against time right now. Can the Ukrainians hold out long enough for those sanctions to really begin to bite and really begin to affect the internal domestic political situation in Russia? We're also seeing more opposition inside Russia to this invasion, certainly than I had expected. We're seeing not just protests on the street, but we're seeing senior oligarchs speaking out against the war. Now, I think it's kind of misguided to hope that the oligarchs are somehow going to overthrow Putin. The oligarchs are where they are. They're billionaires because they've been appointed billionaires. It's not like they're an independent force. They are there at the pleasure of Vladimir Putin and can be removed at the pleasure of Vladimir Putin as much. But nevertheless, there can be more pressure on the Russian economy that is going to hit ordinary Russians in their pockets, that are going to hit the Russian oligarchs in their pockets, and are going to hopefully cause people close to Vladimir Putin to have pause about whether this should be continued. That's really what I'm keeping an eye on right now.
Brian, going back to the military action, though, we're now entering our second weekend since this invasion began. We've been talking about this Russian military convoy that's headed towards Kyiv for many days now. Last we heard yesterday, it was about 18 miles out from the city, but it sounds like that has slowed. What do we read into that? There is so much speculation around why it has taken so long. Is it the equipment? Is it resistance within the military? I mean, what do you read from that advance?
I mean, I think all of those things are possible in terms of why this convoy is slowing. I mean, the fact of the matter is we really just don't know, but we could speculate based on the data points that we can see. And there have been reports that Russian soldiers are surrendering en masse and even sabotaging their vehicles to avoid conflict. Remember, these are 18-year-old kids who, some of whom, if you can believe the videos from captured soldiers speaking to Ukrainians, that they didn't even really know they were going into a war. They were told they were having military training exercises. So that's one thing. The other is that the logistics were really poorly planned out. There have been food and fuel shortages. So that seems to be slowing it down. What this convoy illustrates to me is I am literally shocked at the poor performance of the Russian armed forces in this conflict. It's literally shocking. But those are the main data points I see that explain the slowness of this convoy in approaching Kyiv. What they apparently are trying to do here is encircle Kyiv. And that's going to get extremely ugly if they manage to do that. But the fact of the matter is that we're a week in, and Russia's only seized one major city, Kherson. It's remarkable. I would have thought all major cities would have fallen by this point, and they haven't.
Yeah, it seems like the Russians
attribute to the fighting spirit of the Ukrainian armed forces.
I was going to say that it seems like they vastly underestimated the power of the Ukrainian forces. But again, Brian Whitmore, Atlantic Council Eurasia Center non-resident senior fellow, thanks so much for stopping by Yahoo Finance this morning. And again, watching markets right now across the board in the red as the Dow down almost 500 points. That's about 1.5%. Again, not only on the heels of that development out of Ukraine, but also on the heels of that job support that we had gotten this morning as well. We'll have a deeper dive into all of the market action and maybe where to put your money, especially as oil continues to rise. We'll have a conversation with Sam Stovall over at CFRA on the other side of this break. Welcome back to Yahoo Finance. Again, keeping an eye on markets as we do see red across the board. The Nasdaq down 2% and the S&P 500 down 1.6%. But something that is not down is crude oil, which is continuing its surge higher when you consider that one barrel of crude oil now at $112. Brent crude oil up to $114, up almost $4 just today. So let's get an eye on all of the market action with Sam Stovall, CFRA Chief Investment Strategist. And Sam, obviously, crude oil has been a big fixation for investors over the last few weeks, really over the last few months with this rip higher. Just wondering how you're viewing the movement in crude oil and given all the developments that we've seen out of Russia and Ukraine, whether or not you expect that to continue to be a story in the weeks to come.
Well, yes, Brian, I do think that higher oil prices are going to be the main focus for investors, not only because of the drag that it will impose on our economic growth, but also what is it going to do to the Fed and their change in monetary policy. We got earlier this week a hint from Fed Chair Powell that he at least would recommend a 25 basis point increase at the mid-March meeting. But you never know. If we find that inflation does come in much stronger, we're going to get the CPI numbers, as you had mentioned, next week. And if we do find oil continues to work its way higher, maybe he'll be overruled by other Fed members and raise rates by 50 basis points. So I don't think the fundamentals support the $112 oil because it's in backwardation. If you look 12 months down the road, it's trading in the low $80 per barrel area. So companies can lock in much lower oil prices a year from now.
Sam, specifically on oil, there are a number of dynamics at play. Obviously, the concerns around exports out of Russia, but also negotiations around the Iran nuclear deal. We had a guest on yesterday who said that if that deal comes through, there's more than enough to support the demand right now. Maybe not on the level that it should be, but certainly bringing us back to where things were before the Russian invasion. What does that suggest in terms of where oil is likely to trade? I mean, what's the range that you're looking at right now?
Well, I mean, we started the year at $75 a barrel for WTI, and now we're at 112. As I had mentioned, a year out from now, it's in the mid to low $80 per barrel area. So our belief is, yes, it could be coming down if we come to an agreement with Iran. We get more from them. Then the feeling is that we probably should be seeing prices come down. But right now, the prices are reacting much more to the uncertainty that's taking place in Ukraine, and hearing that the Russians have no problem attacking a nuclear site that could cause a meltdown. You realize that the Russians are not going to stop at anything unless, as the earlier guest had said, we have time on our side for the sanctions to really start to strangle Russia and have them to cause to stop on their own.
Sam, I want to shift over to the equity side of things. I mean, lost in all of the headlines has been the fact that we're in the middle of earnings season. I mean, when you look at the S&P 500, the macro backdrop has obviously taken quite a hit when you consider it's down 10% year to date. What do you see as the big story for the S&P 500 based off of the earnings reports that you've seen covering the last quarter of 2021?
Well, it was the last hurrah, if you will, because we are now on the leeward side of this earnings cycle. Last year, we were up 47%, yet we're expected to show a 6.5% rise in 2022. 6.5% is still good, not as good as the 7.9% that we normally would see in earnings, but still it's pretty good. But when we see slowing earnings, and then on top of that, you take oil prices and the potential pressure that they could put on the economy. There's an old adage that for every $10 increase in the price of oil, with that prolonged $10 increase, it takes off 20 basis points of real GDP growth. So the longer, the higher we go with energy, the greater the pressure that it places on GDP growth. So we're not calling for a recession, but we certainly think that the economy could slow from the current 4% expected rise this year to something lower, and ditto for earnings.
Sam Stovall, CFRA Chief Investment Strategist. We always enjoy having you on the show. Appreciate the time today. Want to get to some breaking news right here in New York City. Mayor Eric Adams announcing this morning that the city will no longer require people to show proof of vaccination at restaurants, theaters, or gyms starting Monday, March 7th. Schools will also lift their indoor mask mandates on the same day. All this comes as cases for COVID-19 continue to decline from their January peak during the surge of the Omicron variant. And of course, New York City following the lead of other major cities like Washington, D.C. and Philadelphia that have already scrapped some of those restrictions. Well, coming up, Switzerland is breaking away from its historical decision to remain neutral, slapping new sanctions against Russia. We're going to explain why banning transactions with the Russian central bank is putting the country's economy in a free fall. That's up ahead. Well, the Russian ruble hit a record low against the dollar this week. It's come back a little here, but the currency plummeted on the back of an unprecedented move by Western countries to sanction the Russian central bank, sending the economy into free fall. But what exactly do those sanctions mean? Got to turn to Brian for a little Yahoo U. Brian.
Well, Kiko, class is in session, and you'll recall those headlines that we had seen about the Russian ruble crashing after sanctions imposed by the West. And in many ways, it's pretty amazing that the United States and these other nations can just zap an entire country's currency. But the way that they do it is really important and has implications to our own US dollar as well. So let me show you just kind of exactly what this looks like when we talk about the Bank of Russia being frozen in terms of their international reserves. This has to do with the $630.2 billion of what is essentially Russia's version of the Federal Reserve to stabilize their currency. And the way that they do this is basically when their currency, which is the ruble, takes a dip, what the Bank of Russia has to do is they have to buy their devaluing currency to save their value. So they'll do this by buying those Russian rubles back via US dollars or gold or whatever they have stuffed in their coffers, which raises the question, well, what exactly is in the Bank of Russia's coffers? And this is one way to look at it. So about a third of it is in euros, the purple bit of this bar here. 2021 figures are on the bottom. And about a fifth of it is in gold, which we've put in blue. I guess it maybe would have been easier if we put that in yellow. But what we need to see here that's really important is the 16.4% in the orange of their FX and gold holdings that are in US dollars. That's, again, as of 2021. You notice that in 2020, it was actually a lot larger of a share, about 22%. But the Bank of Russia has been actively shrinking its US dollar holdings for years, perhaps anticipating someday these types of sanctions. So the US sanctions essentially freeze that 16.4%. It means the Bank of Russia cannot use that orange chunk to save their ruble. So instead, what can they do? Well, they can turn to the yuan, which is the red bit here. That's about 13% that they have, or gold, that 21.7%. Now, for those that are saying, well, yeah, but the US dollar is only about 16% of the Bank of Russia's holdings, the power is really in the team, and a number of other jurisdictions are piling on as well. So this is the Bank of Russia's holdings separated out into different view here. Really, this is where the assets are parked. So take a look at France, Japan, Germany. These are among the countries that are saying they will likely help out the United States in freezing the Bank of Russia's assets that are located in their jurisdiction. So that's a big deal. That would X out their third, fourth, and fifth largest jurisdictions holding Bank of Russia assets as of 2021, which again is in the purple here. The blue bars are as of 2020. It's just kind of showing you the change. Now, the UK, the European Union, and Canada are also piling on. So even though these jurisdictions are not holding as much in terms of percentage of the Bank of Russia's assets, this is still a big deal as well. That would X out the UK, Austria, Canada. That would mean that essentially a majority of the Bank of Russia's assets in its reserves are frozen. They're stuck. So in the absence of being able to defend the currency, the ruble is really falling fast against the US dollar. In fact, this chart, which we pulled last night, is a bit outdated now. The Russian ruble has devalued even further than that. And that's really important because it's devastating for the country. It makes it more expensive to buy imports. It's had many lining up at banks to pull their money out of concerns over the stability of their currency. And all of this underscores just the power that Western nations have against Russia, but any other country that could be a bad actor in the future. But again, the story for Russia seems to be, instead of using this, they're using this. And the story is very much still unfolding as the war continues. We'll see if the Russian ruble continues to take a hit. A big notice out there for any dictators that are watching this Yahoo U episode. But again, that wraps up this week's lesson on why the Russian ruble is crashing. And that with that, class is dismissed.
Brian, can we confirm that's a real block of gold? I'm going to say no, right?
I can't confirm about this, but this is fake. This is fake dollars. It's just
fake dollars. Maybe real gold. We're going to
Yeah.
have people coming out here for Yahoo Finance. All right, Brian Chung, thanks so much for that. Coming up on the other side, Sweet Green is surging following its first quarterly results since going public. The details as the salad chain forecasts strong sales for the year. Welcome back to Yahoo Finance Live. We are seeing all three major indices paring back some of their losses, but still deep in the red. The Nasdaq, the biggest laggard on the day so far, down nearly 2%. Let's bring in Yahoo Finance's Inez Ferre, who's tracking some of our trending tickers for us today. And Inez, Gap, one of those big movers.
Yeah, that's right, Akiko. And Gap actually had opened in green territory. It was up 13% at the beginning of the session, but now it's down almost 3%. The company reporting its quarterly results are the retailer's full-year profit forecast beat estimates. So you did have some bullish commentary from BMO and Wells Fargo based off of that guidance. But then you had Morgan Stanley's Kimberly Greenberger, who has an underweight rating on the stock, basically saying that she was disappointed Gap wasn't profitable during the holiday quarter, and saying that the guidance was overly optimistic. Taking a look at Sweetgreen, this stock is soaring up more than 17%. The salad chain's results beat estimates. Its sales guidance came in better than expected. Cowen said the first quarterly results since the company went public are impressive. And finally, just mentioning our top trending ticker right now being Broadcom, up more than 3% after the company beat on the top and the bottom line. Its results last quarter were driven by strong enterprise demand. Its current quarter revenue forecast came in above expectations. Keep in mind, the stock was up more than 50% last year. Year to date, it's down about 9%. Akiko, Brian?
Yahoo Finance's Inez Ferre, thanks so much for the breakdown there. We'll also want to highlight one company, Microsoft, being the latest to announce that they'll be stepping back from their business in Russia. Shares down 2.6%. The tech giant announced that it is pausing product sales and services in the country. That's in response to the widening sanctions from countries like the United States and also the United Kingdom. The company's president, Brad Smith, wrote today that it's also working to support Ukrainian infrastructure to prevent cyber attacks. That's alongside expressing concerns that Russia's moves violate the Geneva Convention, something you don't usually expect to hear tech companies opine on. The company does have employees in Ukraine, and it says they are offering support as some flee the country. And just ahead on the other side of the break, we will speak with a tech entrepreneur that's based in Kyiv about what it's like running his business during these times. That conversation on the other side. Well, as we continue to cover the Russia-Ukraine crisis, we turn our attention to MacPaw. It's a tech company based out of Kyiv in Ukraine that, despite everything, is doing their best to not only support their country, but raise awareness to the world about what's happening there on the ground. We now welcome in the founder and CEO of MacPaw, Alexander Kosovan, alongside Yahoo Finance's Inez Ferre. Alexander, thanks so much for jumping on the show, especially during these times. You're a software developer. We'll get into that shortly, but just wanted to kind of ask, first of all, at a human level, how are things there on the ground? You've been providing a lot of updates through your Twitter account, on social media. Just wondering, how are you and your family and your team members as well doing right now?
Yes, hello, everyone. Well, I'm currently in the shelter in the basement of the building in my Tesla. It turned out to be a very convenient place. My family is abroad, and they are safe, and this is very good. So I can stay here and help our army, help our people to fight with this crisis. Well, I'm extremely grateful to Joe Biden for his early warnings of this upcoming crisis. We definitely use that time to prepare and get ready for the events like this. Definitely, we didn't expect, we couldn't ever imagine that they are possible and how it will be happening in the real life. But yet we were prepared very, very well. So
Alexander,
the team
you're
relatively safe. Yeah, sorry.
Well, I was going to ask you, you're right in the middle of this war, and yet you're also trying to run this company. What is your day-to-day like right now?
Well, we were ready to prepare the company in the way that it can work completely autonomously, so we don't contribute much to the code changes in the products. Our main job right now is to bring the awareness to the Russian people as much as possible in order to help them realize the horrible truths and maybe come out to the streets to stop Putin, because without this, I think it will be very, very difficult for the whole world.
Alexander, Inez here. You've seen the Western sanctions that have been put forth against Russia. You've seen Western companies also and their responses. Do you think that this is enough? Do you think that more can be done? What else can businesses and governments do?
Well, definitely this will hit the Russian economy hard, and the ordinary people will start feeling that something is going wrong. And I hope when they will see that they are not able to buy ordinary things, they were not able to buy ordinary food, something will click in their minds and to say that, hey, maybe they are wrong, maybe Putin should go out of this place.
And for foreigners that are watching this, people that are watching this, what message do you want to put out there? What do Ukrainians need, and how are you personally and your company also helping Ukrainians?
Well, definitely the air defense would be great, but we already heard today that NATO is not planning to be involved in this war and will not help us to cover the air. Unfortunately, this is the weakest point our army at the moment has, and all of these destructions that you see for the last several days, they are caused by airstrikes bombing our cities.
Now, you're a tech company. You work on apps that can plug into Mac computers. But what's interesting is that you have used the platform that the company has on Twitter to kind of share anecdotes about what's happening on the ground, how your employees are feeling right now, but also interestingly about the cyber angle of all of this. We know that there's been NFTs that have been used to try to offer a little bit of financial support to those in Ukraine. I mean, how important is the tech community to what's happening there on the ground in the age of a war in 2022?
Well, actually, it is extremely helpful because all of the tech community are currently united to help Ukraine. So the tech community are making so much efforts to bring down the Russian propaganda websites, to bring down some state Russian websites, to highlight the events, how they are happening in real life on the TV, etc., etc. So we try to use our tech capabilities as much as possible to break through the Russian truth firewall.
Yeah, it feels like there's a number of wars that are playing out here. Obviously, the military war, but also the disinformation war, which many tech companies have stepped in to try and curb. With that said, we have seen Russian forces go after critical infrastructure. We saw that attack on the nuclear power plant overnight. How are you preparing for a potential of an internet blackout, for example? Are there any thoughts here about moving operations outside of the country in the anticipation that there could be a potential power outage, internet blackout, other critical infrastructure being pulled?
Well, definitely part of our team are already outside of Ukraine, so they're working to maintain our products and stability of our services. But I'm here by choice, not by accident. I came here to protect my country, and I feel like this is my duty to do. The way I can do it, I'm not a military man, I don't know how to shoot, but still I can use my brain and technology in order to try to stop the war in any way possible.
Alexander, you said that you're there by choice. I saw in one of your Twitter messages that Ukrainians throughout Europe, you want them to have a shelter. You're there by choice. If the situation gets worse, will you continue to stay there? And lastly, what gives you sort of strength and hope and to keep going?
Well, Ukrainians are a very creative nation. We use a lot of humor to support the things we do to support our little but strong victories against the Russian military. And we try to encourage and help each other every day. And we feel finally as a huge one nation. So we are really united. There are all the people in the city, around Ukraine, are trying to support us, to bring us whatever is needed. So in these times, if you have some crazy request, consider it done. So you can request, I need several cars to that location, and volunteers are trying to find available cars and bring that in a few hours. So it's a really, really exciting move.
Well, we hope you certainly stay safe there, Alexander Kosovan. Really appreciate you taking the time today. Please do stay in touch. We look forward to talking to you again. The founder and CEO of MacPa, and our thanks to Yahoo Finance's Inez Ferre as well. Well, coming up on the other side, chip manufacturing woes may get worse. We're going to explain why a shortening of rare gas supplies could add to COVID-related disruptions. That's up ahead. Welcome back to Yahoo Finance Live. We are continuing to see a sell-off on Wall Street on this Friday, although we are seeing stocks coming off of their lows. The Dow down at 420 points, the S&P 500 down 63, and the Nasdaq, the biggest laggard on the day, down about 2%. We're also watching the spike in commodity prices. This, of course, coming as we continue to see the fighting escalate over in Ukraine. Taking a look at where Brent crude is, it was as much up as much as $114 a barrel there, but still well above that $100 a barrel mark, and certainly raising concerns about further increases. Well, the Russian invasion of Ukraine is threatening to add even more pressure on global chip supply. Ukraine supplies about 50% of rare gas used in the chip manufacturing process. With that supply limited, chip makers are warning that there could be more supply shortages ahead. Let's bring in Yahoo Finance's Dan Halley, who's following that side of the story. And Dan, of course, even before this invasion, there was a global supply shortage because of what happened during the pandemic. How much worse are things going to get?
That's right, Akiko. This is an issue with, believe it or not, neon gas. It being Ukraine is one of the largest exporters of neon gas, about 50% of the world's supply. And so the reason why that gas is so important is because it's actually used in the lasers that help to etch the important pieces of a chip onto the actual silicon. So they're a critical part of the building process of the chips that we use on everything from vehicles to smartphones. It's, the hyper advanced chips, those are the ones that don't necessarily need neon, but the ones that most consumers use and need are what use neon. Now, they being companies, did do some stockpiling of neon ahead of this conflict, realizing that Russia was amassing troops on Ukraine's border, and so they needed to do something about this. And I think one of the lessons there is that perhaps the stockpiling wasn't enough. They have about 6 to 8 weeks, is what some analysts are saying, and then they're going to run dry unless there are some exports from Ukraine to the West being able to get these companies the neon that they need to start building chips. Now, there are some other companies that aren't necessarily going to be impacted in Japan. There are some, some companies that are saying they're still able to get neon from China. Texas has a purification plant down there, but it really is going to be an issue going forward. And, as you said, this kind of just adds to the pressure that we've already been seeing out of the chip industry, which is shutting down plans for making cars, making lead times for getting access to different types of electronics longer. Apple recently said that they had to cut down on the sale of iPads to boost their iPhone availability. So this is going to continue to be a problem. And, I don't know if it's going to push out that date of 2023 when we were expected to see chips back in stock. But, you got to imagine if the process that you need to build them is now being impacted because of neon, then it could really push it out.
Really interesting story there. You don't hear too much about the neon crunch, but very much an integral part of this story. Yahoo Finance's Dan Halley, thanks so much. Well, again, we're watching the market action as markets remain in the red despite that strong February jobs report. Again, stocks down, Nasdaq down over 2%. We'll have more on the market action on the other side of this break. Welcome back to Yahoo Finance Live. Again, keeping an eye on markets as we do continue to see red across the board. The Dow down 1.25%, the S&P 500 down 1.5%, and big tech stocks getting a little bit more of an accelerated sell-off today, down about 2%. Again, we'll be watching all of the market action as we do get deeper into the trading session as we start off the noon hour here on the East Coast. But let's head right to Yahoo Finance's Jared Blickery for all of the updates on the market action. Again, Jared, red across the board, watching a lot of volatility in bond markets as well, with the 10-year moving down about 12 basis points, 13 basis points today. It's been a real round trip this week.
It really has. It's been a choppy week, and most of the markets we're covering, except crude oil. We'll get to that in a minute. But first, I want to break down the job numbers that we got this morning. 678,000. That is the headline payrolls number, and that handily beat expectations, all but two of the highest expectations on the street. Also, the unemployment rate ticking down to 3.8% from 4%. You can see lower than expected as well. And curiously, those average hourly wages, not strong at all. There was zero monthly growth. So the year-over-year number is 5.1%. That's been explained away partly from compositional effects as well as unskilled, lower-paid workers just entering the workforce in mass. That's according to Carl Riccadonna over at Bloomberg. So we have the Wi-Fi Interactive up here so we can chart the week's price action. And as I've been saying, and as you said, Brian, very, very choppy action. You can see up and down, kind of a whirlwind here. Now, Nasdaq has fallen off today. So Nasdaq bucking the trend, S&P 500 kind of looking like the Dow. All of the major indices plus the Russell 2000 expected to close in the red for today. And speaking of the bond market, we got the 5-year, that is down 13 basis points. The 10-year, that is down 14 basis points. And the 30-year, that is down 9 basis points. So the yield curve flattening here overall. The 2s, 10s spread, if you follow that, that's under 30 basis points, indicating a flattening yield curve. Not going to say the R word just yet, but that's going to be on people's minds in the coming months and quarters. And guess what? Interest rate differentials spooking investors into the US dollar. And this is heavily weighted against the euro, and euro having more troubles and probably going to have a less active and hawkish response from the ECB. What does that mean? Probably going to see the US dollar head higher here. All right, let's take a look at our sector action before we leave here. We've seen utilities now in the forefront, followed by energy. Those are the only two sectors in the red. Financials are the worst performing sector, off almost 3%, guys.
Yeah, no surprise. You know who doesn't like a flattening yield curve? That being the banks. Yahoo Finance's Jared Blickery. Thanks so much. Let's get a deeper dive into the jobs report. It was only a few hours ago that we got those numbers, but Yahoo Finance's Emily McCormick is here with the breakdown of what we heard from the Bureau of Labor Statistics at 8:30 this morning. Emily?
Well, Brian, this was a blowout jobs report for February, really underscoring this continued progress we're still seeing in the labor market, especially as Omicron-related cases in the U.S. came down from a January peak. Now, we just heard Jared Blickery break down some of those headline numbers, but it is worth reiterating again that main headline payrolls figure, because that did come in much better than expected. 678,000, that was the number of non-farm payrolls brought back across the U.S. economy in February, much better than the 423,000 expected, and the upwardly revised 481,000 we saw for January. Now, we also got another upward revision to December's payrolls numbers. So all told, this was good for a 14th consecutive month of payroll gains, as well as for February, the most that we've seen since July 2021. But looking at where the jobs actually were last month, the hard-hit services sector posted a notable increase in jobs. Leisure and hospitality employers specifically added back nearly 180,000 payrolls to build on a jump of 167,000 that we saw from January. Now, in education and health services, jobs were also up sharply during the month. Transportation and warehousing job growth came in at nearly 50,000 to nearly match January's gains. So definitely seeing some much needed growth happening in some of these supply chain related industries as well. Now, turning to the goods producing sector, strength was also seen across manufacturing, construction, and non-durable goods industries. And we also saw job growth in each of these accelerating in February. February compared to January. The one area of weakness that I do want to point out is in motor vehicles and parts manufacturing, where employers did shed jobs on net during February to the tune of about 18,000. Then finally, ticking through some of these other main numbers from this report, the unemployment rate coming in at a new February 2020 low of 3.8%. That's down from 4% in January. And as Jared was mentioning as well, that average hourly wage number coming down and decelerating compared to January and rising by 5.1% on a year-over-year basis. And then finally, do want to highlight what some economists have been saying about this report, and specifically a note here from Bank of America economist Stephen Juneau, who said, quote, momentum in the labor market remains remarkable, with payroll growth averaging 583,000 per month over the last 6 months, with little signs of slowing. We expect labor demand to continue to outpace growth in labor supply, which should drive the unemployment rate to 3.2% by year end. So overall, yet another very solid print on the state of the labor market. Again, that drop in Omicron cases, likely a big contributor to what we saw in February, guys.
Yeah, it's so jarring to see the unemployment rate number. If you had told people after the 2008 financial crisis that we would be able to recover unemployment that fast, I think people would have said you're probably a liar. But Yahoo Finance's Emily McCormick, thanks so much for the breakdown there. Well, let's continue to get some more commentary on that February jobs report. And for that, we've got Dana Peterson, the Conference Board chief economist, here with us. Dana, it's great to have you on the program this afternoon. You know, I caught your note that said the outsized gain we saw today may not be sustainable. That's a pretty notable comment, especially when you consider we got two back-to-back blowout reports in January and February. Why might the momentum not continue?
Sure. Well, I mean, certainly we expected that we were going to have big gains in employment, even without COVID, Omicron cropping up. And when we did see that, we saw a little bit of slowing. And so we could still see a few more months of, half a million job gains. But certainly we're getting closer and closer to full employment if we're not already there. Imagine a bathtub filling up with water. You can only put so much water in there before you spill over. And so it's likely that we're going to see smaller, but still healthy payroll job gains as we get deeper into the year. There's also a lot of risk around what's going on with respect to the Fed is going to start hiking interest rates, which will slow growth, and then also the crisis in Eastern Europe and how that will influence not only inflation, but global growth and thereby U.S. growth, and subsequently, or rather consequently, employment.
Dana, looking at wage growth or lack thereof, I should say, I mean, that seems to run counter to what we've heard from so many of these companies who are saying that they are having to pay up more because of their inability to be able to fill some of these roles. Can you explain a bit of that disconnect? And what does that data today that we saw suggest that things are starting to moderate?
Well, it's one data point where you had zero increase in the month-on-month rate. But when you look at the year-on-year pace, wages are up 5%, 5.1%. That is a lot. When in the past, before the pandemic, we were looking at wage growth that we were trying to at least get to 2.5%, 3%. And so wages are still rising very rapidly, even though you had 1 month of month-on-month change that was unchanged. So I think the story is still consistent. Businesses are looking at very expensive labor costs. And certainly as you have more people who are willing to switch jobs, who are going to bid up their wages as much as they can, you're still going to see those pressures. So even if say like in the next few months, we see wages, and this is not a forecast, just kind of tossing this out there, wage growth slow, we're still well above the average that we saw over the last 10 years.
Yeah, and when we talk about wages, I mean, I've always kind of been of the opinion that that conversation or that argument is a bit moot for the people that don't have jobs, right? Wage increases and wage trends don't matter for the people that aren't employed. So when we talk about these more kind of marginalized groups historically in recoveries, when you talk about low wage, Black, oftentimes Hispanic workers, did you see anything in this report that kind of tells you about the picture for them? Because it was interesting to me that the unemployment rate did tick down for some of these groups as the employment to population ratio increased, which would be good things.
Right. And unfortunately, even before the pandemic, we had these gaps between racial groups relative to the aggregate in terms of unemployment rates, where it is true for Hispanic and also Black workers that their unemployment rates are higher. But we have seen throughout the recovery from the pandemic, and now we're in an expansion in the U.S., and even leading up to today's data, the unemployment rates for those other groups are still falling. And still in all, many people are still working. And so certainly when you talk about wage increases, that is certainly for the people who are working, but we are seeing conditions improve for these other groups.
Dana Peterson, chief economist at the Conference Board. It's good to talk to you today. Really appreciate the time. Coming up on the other side of the break, Bitcoin is hovering around $40,000 as crypto sanctions against Russia remain in the crosshairs. We've got the latest developments as Ukraine looks to NFTs ahead. And we are expecting President Biden to speak on that blowout jobs report shortly. We'll take that press conference for you live as soon as that begins. At that point. We are seeing Bitcoin prices falling here, still hovering, though, around that $40,000 level. This coming as lawmakers weigh sanctions to prevent Russia from accessing cryptocurrency. We also heard from the Justice Department this week, targeting efforts to use cryptocurrency to evade U.S. sanctions in a new task force. Joining us to discuss all of this, we've got Mark Lopresti, the Strategic Funds Managing Director. Mark, let's start with broad picture first, because, you know, the thinking has been, as we've seen, the Russian currency pretty much plummet, that there will be a move to cryptocurrency. There's also the school of thought that as you've got these millionaires, billionaires who are trying to evade sanctions, they're going to put their assets in crypto too. How much of that have you seen actually play out?
Well, first of all, thanks for having me back. And it's hard to tell specifically from what we see in the on-chain data who's moving money to evade sanctions and who's moving money because there are concerns about the reliability of the traditional banking system in that part of the world. But there's no doubt that the populace and the citizenry will and has turned to Bitcoin and other cryptocurrencies as a means to conduct financial transactions in light of mounting inflationary and currency devaluation scenarios occasioned by this kind of remarkable geopolitical activity that we see with Russia's invasion of the Ukraine. And it's really not a new story. We saw this happen in places like Turkey as well, with the ridiculous devaluation of the currency there.
Mark, this is really interesting, though, because even though a lot of these cryptocurrency exchanges are still operating in Russia, there's kind of the argument that because of the sanctions that have been imposed on the financial institutions, the traditional banks in Russia, that it's still very much difficult for people who do want to use cryptocurrency, for example, in that country, to ultimately get the money that they need to use on a day-to-day basis in the absence of the restaurant down the street or the grocery store taking cryptocurrency for the time being. So is the technology really mature enough yet that such that people can really go kind of offline here and avoid the sanctions? Or is there still kind of a good argument that the existing infrastructure does still kind of largely prevent people from freely using this?
That's a great question. And the existing infrastructure certainly doesn't make it easy. But there is technology. There have been advancements in wallet interoperability that allows folks to go from crypto to fiat, perhaps through an intermediate technology. And not to call out any particular companies or names here, but things like Venmo or Venmo-like technologies in that part of the world. So is it easy? No. But is it impossible? It's certainly not impossible. And folks will turn to alternative measures to transact. And I'm not talking about the bad guys here. I'm even talking about regular folks that in the wake of this kind of activity and destabilization of traditional banking systems, they will and are turning to crypto as an alternative.
Mark, let's talk price action. We're seeing it hover around the $40,000 level. Obviously, we never want to make too much of these correlations. They always prove to be wrong, right? But we have seen it lately kind of move in tandem with the equity space too. Do you expect it to kind of hover around this level? And if not, what do you think that next catalyst could be to move this to the upside?
Yeah. So two great questions in that question. One is, when will this decoupling that everybody's been expecting occur? When will Bitcoin, in particular, stop expressing significant correlation to the equity markets and even more precisely to the VIX? That process, we believe, has started. I said that before publicly. When you have catalysts like this, you saw actually 6 days ago, 5 days ago, Bitcoin start to decouple from equity market price action. That is a good thing. We think that's an initial indication of Bitcoin and crypto starting to fulfill its promise as being inflationary or flight to safety in situations like this. But when it comes to a general price action, you need to do really no more than look at where the main resistance and support levels are. We had a 38.6 resistance level about a week or so ago, just as this crisis was kicking off, and saw that as being, if we broke that resistance level, as an indication that we were going to move significantly to the upside. We did, but of course, to your point, this is a very volatile asset, Bitcoin and crypto generally. And I think we saw that price action spike up a few days ago on the increased use and adoption story. And now we're seeing a little bit of the FUD, the fear, uncertainty, and doubt that the crypto crowd likes to talk about when we hear this rhetoric around sanctions and calls for Binance and these other decentralized exchanges to somehow put a blanket ban on all holders of accounts in that part of the world.
Yeah, and their defense has really been, well, the whole point of cryptocurrency is to be agnostic. But at the same time, I mean, it's kind of a good, hinging point to note that the Ukrainian people are trying to use cryptocurrency as well to support their economy. Apparently, there have been a number of donations that have come in via cryptocurrencies. Yeah. And this is significant because even the vice prime minister has been tweeting about they were thinking about doing an airdrop. Now they want to do some sort of NFT to raise money. How have you seen the news headlines coming out of the Ukraine side of things on the cryptocurrency front?
Yeah, well, I'm really glad you bring that up, right? It's $46 million in crypto-related donations have flowed in to help support this incredibly brave and proud Ukrainian resistance, which you can't talk about this story without giving them props, frankly speaking. And it does show the good side of the coin. It's not all about bad guys using crypto to evade sanctions and move assets. There are good use cases for crypto, as we've seen with these donations. Going to be very interested to see how this NFT program plays out. We're watching that very carefully. And, you know, the one thing I want to mention that drives me a little bit crazy, I was watching the testimony in the congressional hearings this week where Chairman Powell was being beset by questions having absolutely nothing to do with things within his jurisdiction. And folks like Elizabeth Warren, you know, talking about how the whole point of crypto is for nefarious actors and characters. I'm pretty sure that bad guys were able to use fiat currency and traditional finance to do bad stuff before crypto. So it's very important to keep that in mind and to talk about the good uses for this new technology, as well as obviously the challenges from a regulatory perspective as it evolves.
Yeah, and some of that is just a lack of institutional knowledge on Capitol Hill. But even among the regulators over who's responsible for regulating cryptocurrency, it's like that Spider-Man meme where no one knows who's responsible for what. But Mark Lopresti, the Strategic Funds Managing Director, thanks so much for stopping by. Have a great weekend. Well, again, I want to take a look at markets right now, as it appears that the major indexes are actually pairing some of the losses that we had seen over the last hour. The Dow Jones now down only 0.9%, the Nasdaq down only 1.6%. Again, compare that to losses of about 2% that we had seen headed into the beginning of this hour. Well, coming up, the Great Resignation rolls on as employees quit their jobs at record rates. A recruitment strategist will join us to discuss why Americans have more choices than ever in this labor market and exactly what to do about it. We'll be right back. Well, again, we are watching all of the market action on this Friday, March 4th, as the Dow down 0.8%, the S&P 500 down 1%, and the Nasdaq down 1.5%, pairing a little bit of the losses that we had seen earlier in the session. But of course, we still have plenty of time to go, about 3.5 hours to go in this trading session on this day. So we'll see what happens from here. But all of this coming on the heels of that jobs report that we got this morning. And one thread that you can pull from that jobs report is the headhunter industry. Very interesting to see that as a possible leading indicator for future job gains. Employment services in February ticking up by about 44,000, and companies planning to hire extensively over the 12 months. 53% across 18 markets. That's according to Randstad SourceRight. And we have the CEO of Randstad SourceRight here joining us on Yahoo Finance. That's Mike Smith. Thanks so much for hopping on the program. Mike, tell us a little bit more about what there is to be gleaned from the headhunter industry and just those looking to hire up, especially now that we're over this Omicron wave, it appears.
Yeah, it's certainly a job seekers market at the moment. We see that really in the last 2 decades, we haven't seen this level of supply demand constraints, and that actual cost of not being able to fill critical roles for organizations at the moment has really forced them to rethink and reconsider their compensation packages, but also getting outside the box on transforming their traditional approaches to flexible work-life benefits and overall wealth packages for their particular candidates that they're trying to hire, as well as their existing workforce at the moment.
Yeah, let's talk a little bit more about some of those benefits that you've highlighted. And we've heard even before the pandemic of free education, for example, being offered. Obviously, standard health insurance too. But some of the things you point out here, I mean, cleaning services and meal delivery. What kind of jobs are we talking about that are getting those kind of benefits?
Look, we do a lot of work for some of the Fortune 500, the Fortune 500 organizations at the moment in terms of talent acquisition outsourcing. And what you see among those organizations is the difference in total compensation packages that they can offer is not that different. And as a result of that alignment, that's forced them to really think about, how can I offer a value proposition that really stands out in the market at the moment and helps me get those critical skills that are going to allow us to drive growth? And as a result of that, they're being forced to think about, okay, to address the needs of the workforce that I need in the future, there is not a silver bullet. I need to be able to offer a smorgasbord of choice. And we see this creation of flexible benefit buckets where organizations can say, it's up to you to decide on how you want to spend that bucket. But I recognize that each and every one of my employees is thinking about what work-life balance means for them, what flexibility means for them in a different way. And a silver bullet approach is not solving that, leading to the approaches that we're now starting to see.
You know, Mike, I mean, one client that you serve is obviously those that are looking for a job, but you're also serving the companies that are trying to hire. So when we talk about the labor shortage, I think there's this assumption that even though it's a laborer's market now, companies are still going to be choosy about who's going to be the best person for that job. I was talking to someone who works in hospital care that was saying, well, I mean, there's plenty of workers out there, but we are still trying to be choosy because we want to make sure we have the best offering in our business. So what do you think that looks like right now? Is that easing up as you see more people come back into the labor market?
Yeah, at the moment, we see organizations starting to wake up to the difficulty of not being more flexible about the thought processes that typically were how they hired people previously. So this understanding of minimum requirements that were applicable in the market 5 years ago are absolutely being challenged at the moment. And there's a heavy diversity, equity, and inclusion element to that, to understand how, by changing the minimum qualification requirements that we thought of for a certain role, does it give us access to new pools of talent that we haven't thought about previously? Albeit that's a very difficult balance to strike when you have a stakeholder or a hiring manager community that is still demanding skills relevancy in the current environment.
Fascinating to see all the shifts that are happening there. Mike Smith, good to talk to you today. Randstad SourceRight CEO. Coming up after this short break, we've got big bucks for the Batman. We'll explain why it could cost you extra to see the latest action installment in theaters this weekend.
Continues. It won't be long before you've nothing left.
I don't care what happens to me.
It's only going to get worse for you.
Whoa, take it easy, sweetheart.
That was a clip from Batman hitting theaters this weekend. The latest installment of the superhero franchise aims to get moviegoers back to the big screen, as the return to the theaters remains a little slow when you compare it to where things were pre-pandemic. Let's bring in our very own Ali Canal with the very latest here. And Ali, if Spider-Man is any indication, we know people like to show up for these superhero movies. What are the expectations for this one?
Expectations are really high. Many experts believe that this movie is going to outperform, surge above that $100 million mark when it comes to domestic ticket sales. Box Office Pro has an estimate between $130 million to $170 million. And Sean Robbins, the chief analyst there, told me that this film is going to heavily rely on that adult audience returning and showing up to the theater, because this is a very adult movie, but it could also be the new generation's Batman. It's been 10 years since the Christopher Nolan films, so this could be the next iteration of the franchise to make a very big splash. And historically speaking here, Batman films have performed very well, as most superhero films tend to do at the box office. According to ComScore, between 1989 and 2005, Batman movies averaged between 250 million to 400 million in global box office ticket sales. But fast forward to 2008, The Dark Knight just blew every other Batman film out of the water with more than $1 billion worldwide. Now, this movie, it's also going to be an experiment of sorts. AMC is charging more for the Batman tickets compared to other releases. Now, this is a new pricing model that the theater chain is going to be testing. It's unclear just how much more a ticket to see the Batman will be for new blockbuster releases, but sources tell me that this is already a model that's been employed in some international markets. So there is already a precedent set for this. And we have been seeing this trend, obviously accelerated by the pandemic, of the theater becoming a more premium experience. And that's where those higher ticket prices could come into play. Maybe certain show times are going to be more expensive. Where you sit could determine the level of the price. Premium screens could cost a little bit more. So it'll be interesting to see how consumers react to this, because it will test certain elements of the experience a bit, but we'll have to wait and see what the longer term impact will be for the industry if this experiment is successful.
Yeah, well, I heard that Zoe Kravitz is in it. So, for me personally, I will spend however much it takes to go see this movie. But I wanted to ask you about another thing on the media side of things. Disney Plus apparently is going to introduce an ad-supported subscription in 2022. Tell us a little bit more about that.
Yeah, Disney confirming that this new ad-supported subscription tier will kick off in the US in late 2022 and then rolling out internationally in 2023. Now, we don't have specifically the date of this. We also don't know what the pricing will be, but we do know that competitors that have gone with this ad-supported strategy have priced it at around $5 a month. The Disney Plus current plan is $8 a month. So I think that $5 pricing seems like a fair price point to me. And of course, this is just another example of how these streaming giants are trying to lure subscribers, keep up with the competition. I do think that offering various pricing tiers, ad-supported or not, is a good move. Personally, for me, I use the ad-supported tier for Hulu, so I do think that there is demand there. And Disney Plus is continuing to be an important asset to the Disney company. Disney plans to spend at least $8 billion per year on the platform by 2024. Disney Plus currently has well over 130 million subscribers, with the expectation to have between 230 million to 260 million by 2024. And the platform has only been in operations for 2 years and is already becoming a really strong leader in this space. So I don't think this was a decision that was taken lightly. And I do think it's going to set Disney up to just continue to be that leader in the streaming wars moving forward.
I mean, those ads are just so brutal, though. On Hulu, you watch like a 22-minute show, and you have to go through 4 or 5 rounds of ads. It's pretty ridiculous.
There's so many services out there. You got to pick and choose. Like, if you don't watch Disney Plus all the time, then maybe that's a good one to just have the content, but deal with the ads. I don't know. It's something that consumers are going to have to think about.
Exactly. And at that point, it all matters about whether or not that few extra dollars is worth it. But Yahoo Finance's Alexandra Canal, thanks so much for breaking all that down for us. Well, again, we are continuing to watch markets as we kick off the afternoon session here. We are seeing the S&P 500 down just a smidge over 1%, the Dow down 0.75%, and the Nasdaq down 1.5%. We'll have more market coverage on the other side of this break. Welcome back to Yahoo Finance Live. Again, markets in focus as the markets continue to be in the red, but not as deeply as they were earlier today. We are seeing the Dow down about 0.8%, the S&P 500 down 1%, and the Nasdaq down 1.6%. But really, a lot of the volatility that we've seen this week has also been in the fixed income space. When you take a look at the U.S. 10-year yield down pretty markedly, down 11 basis points to 1.73%. Keep in mind that we were at about 1.85% yesterday. And in fact, the levels that we have seen today, we haven't seen since, well, Monday. So it's been a very big up and down rocky road over the course of this week for fixed income markets. We'll see what that bodes as we get closer and closer to that Federal Reserve meeting on March 16. But let's take a deeper dive into the markets. And for that, we've got Yahoo Finance's Jared Blickery in our Getting Technical segment. And he's got a special guest joining us today to break down the graphs. Jared?
That's right. We got Michelle Schneider of MarketGauge.com, also a partner and director of trading research and education there. And Mish, we got to start with the general market. I'm going to pull up IWM. That's the iShares Russell 2000 ETF. And it's been pretty choppy lately. And if we go to a chart, I just want to kind of plot the week's price action. You can see a little bit of up and down there. But also, when you go back 3 years, and I go back 3 years because I want to catch the pandemic low, you notice that it's been trading sideways in a range with a little bit of an oops to the upside. But now maybe we're in a new range. What are you seeing in this chart?
I'd say that's exactly right, Jared. This has been a very range-bound instrument for a while, and it makes sense fundamentally because after COVID, we're still seeing some comeback in the manufacturing and industrial side of the economy, and that's why the IWM is so important to watch. So right now, we got that 188 to 190 level. It was the low in the early part of 2021, and now it's been the low twice here in 2022. So we're bouncing from that, but we can't seem to get back over key moving averages like the 50-day moving average, for example, which is coming in at around 207. So really, we have a range and with a lot of chop in between. So if it breaks 188, we'll probably see something like 175 next. We can get through 207. Maybe we can go back up to 220, but I wouldn't necessarily say new highs or necessarily new lows, range bound, which is very much a part of stagflation.
Yeah, and we can play the range too if you're a trader. But I want to move on to a sector that doesn't always get a lot of attention, but is important nonetheless. That's consumer staples. As you can see on your screen, I'm going to take out the moving average. And let's go back and take a 3-year view of this as well, because this has been in a steady uptrend for more than a year. It looks like going back 2 years to that pandemic low that we're about to lap on the 2-year basis. What are you seeing in here? And then we can also move on to Walmart whenever you're ready.
Well, XLP is definitely where you want to be in stagflation times because it's consumer staples, exactly that, people buying what they need. And so XLP right now, the chart, I think, is very, very strong. Still needs a little bit more work. I want to see it get through 75, 90, 76. That's where we'll enter. And of course, on the downside, you want to see it hold about 72.50. But I think that that can be a continuing trend because it's probably one of the safer places to park your money right now.
And then one of the biggest consumer staples of them all, big box retailer Walmart. This is another instrument that has been choppy. I'll pull back to 3 years and you can see basically you've been going sideways for a year and a half. Any kind of consolidation, or what do you want to see happen in Walmart?
Well, Walmart's having a nice move as we're speaking today, but again, it's stopped just short of a major moving average. So we want to see it get through the 200-day moving average. It's cleared the 50, but it looks like a nice base is forming. Again, as far as consumer staples, a stagflation environment, Walmart not only obviously is discounted, but is also getting into the medical space, which I think is an area to be looking at as well. So it's reflecting the fact that it could actually grow in that arena.
All right, we got time for GLD, gold. Gold has been on the move. Can you handle this in 1 minute or less? I like the bullishness of this chart.
Okay, 1 minute or less. One, momentum. The momentum is skyrocketing here. Two, it was incredibly undervalued compared to the equities for years and now is finally playing catch up. Three, it's a geopolitical and inflation hedge. And four, right now, the way the chart is looking, it looks like if we just take a look at GLD alone, we have an opportunity now to see it go up to about 186, 187 if it holds 179. And then through there, we have the 2020 high at 194-ish.
Got it. Really appreciate your insights here. As always, Ms. Schneider, MarketGauge.com partner, sending it back to you guys.
Finance Chair Blickery, thanks so much for bringing us that conversation. Coming up on the other side of the break, pain at the pump as gas prices surge. We asked Yahoo Finance's Twitter followers if you're trying to drive less with higher prices. We'll have those results next.
Thank you.
Yeah, maybe they should put it
people
in
can
liters.
feel better about it.
Well, there is growing momentum in Congress to sanction Russia's oil and gas imports as lawmakers look to punish the Kremlin for its invasion of Ukraine. Senators from both parties have introduced a bill to declare a national emergency and ban the imports of Russian energy. But the White House, at least publicly, remains opposed to the idea, saying it would hurt average Americans and European allies. Let's bring in Yahoo Finance's Rick Newman, who's following this story for us. And Rick, we should start by putting this all in context. We're talking about 700,000 barrels a day coming in from Russia. That is less than 4% of consumption here in the U.S.
Yeah, by my numbers, it's only about 2.5% of all the oil that we consume in the United States. So I've been hearing from a lot of people saying, why do we get any oil from Russia? And the reason is, I mean, oil markets are interdependent. Most of the oil that comes from Russia lands on the West Coast and goes into refineries there. And it's honestly, it's just more efficient to get it across the Pacific Ocean from Russia than it is to get it from some of the places in the United States, because you can't build pipelines over there. There's opposition to that. So I'm not sure this movement is going anywhere. Let's remember that these are members of Congress who are calling for Biden to do this, to ban Russian oil imports. But if Biden does it without European countries agreeing to do the same thing, it won't really make any difference. And it's a lot harder for European countries to ban Russian energy imports because they need them a lot more. They get a lot more oil from Russia than we do, and especially natural gas. They really need Russian natural gas. So I'm not sure this is going anywhere. There's also a political element to this because some of these lawmakers saying Biden should do this are Republicans, and they're trying to support the sanctions on Russia and defend Ukraine, while at the same time they're trying to say they're even more hawkish than the president is on this. So that's another reason I think it's an interesting idea, but not necessarily going anywhere.
Well, at the same time, though, I did think I saw Nancy Pelosi did support something like this, too. So some of that coming from both sides of the aisle. But I just want to shift to kind of the domestic view, because in lieu of all of this, it's still very much the case that Americans are paying more at the pump. And we actually put this up as a poll on our Twitter account. And we asked the question, are you trying to drive less because of higher gas prices? Wondering if this is kind of changing behavior because of how expensive it's getting. 54.3% said yes. 45.7% said no. And when we were talking about this in our meeting, I mean, this was a little bit closer than we had anticipated. Some comments, one person saying, I do want to get rid of my Nissan and buy a Tesla. And then one person posting a meme, I never pay attention to gas prices. TF, I'm a do, not get gas. And I think this does underscore that in many cases, guys, people don't have a choice, right, Akiko?
I mean, I need to choose my words carefully here. Obviously, yes, it depends. I mean, America's very big. We live in a city that has subways and other forms of public transportation. If you live in a rural area, you don't have an option. So that's not a choice there. But I would sort of step back and say, if you think about the major cities, there's always an alternative form of transportation. And it's surprising to me that even at these levels, that vote is still so split. I mean, that to me suggests that the pain point is not high enough for people to change their behavior.
I mean, Rick, you're the only one of the three of us that has a car.
And I've had a car for a long time. I think gas prices are particularly painful for Americans for two reasons. First, the price is advertised in mile-high numbers all over the country. I mean, there's nothing that we see the price of on a daily basis like gasoline. So everybody notices when the price goes up. But demand for gasoline is, Brian, as you know, is what economists would call relatively inelastic. If you need a car to drive to work, it's not like you can ride your bike if you're going 20 miles on a highway. Most people don't have access to public transportation, and people just need to pay gas. I mean, you can do a little bit to save money, like combine trips, instead of just doing one trip at a time. But this hurts people because they just have to fill the tank. And people also will buy automobiles when gas prices are low and not think about fuel efficiency and buy something big that doesn't get good mileage. And then they're paying $80, $90, $100 to fill it up when gas prices get high as they are now. So this is just a big deal in American politics, and it always has been.
That is an incredible price tag, right, Rick, when you think about it. I mean, I keep saying this. Everybody here at Yahoo Finance is probably sick of me talking about it, but EV makers are looking at this and seeing a huge opportunity, because the last time I filled up gas when I was in California, I paid more than $60. And I'm looking at a full charge of $18 to $20-something. I mean, it seems like a no-brainer. Not everybody has to drive a Tesla. There are more and more EV cars out there. And I wonder if this is kind of the tipping point where people start to say, maybe I need to think twice if the infrastructure for EVs are in place around me.
Yeah, and to that point, I mean, our very own Yahoo Finance's Jared Blicker uses an electric scooter, but even he noticed that electric costs are going up. He said it used to be about 50 cents. Now it's about $1.50, which isn't a lot in the span of things, but that's a tripling of prices. So I think that's an important note as well. And I do want to just kind of acknowledge here as well that when it comes to EVs, the barrier is still high when it comes to the price of an EV, and the lowest cost EV car is still going to be more expensive, especially with the absence of tax credits compared to the cheapest internal combustion engine car. So we'll leave that conversation there for right now. I know you guys have other comments, but we'll have to say that for another day. Thanks so much to Yahoo Finance's Rick Newman. But again, taking one last look at markets as we wrap up the show here, red across the board with the S&P 500 down 0.9%. The Nasdaq, those big tech stocks, continuing to have a worse day than other equities. 1.5% is the change downwards today. We'll have more coverage right here on Yahoo Finance for Akiko Fujita and Brian Chung for the last 2 hours. That does it for us. We'll have more on the other side of this break.
Non-farm payrolls posted staggering growth in February as 678,000 jobs were added to the economy, well ahead of estimates. The unemployment rate dipped to 3.8%. President Biden poised to speak on the report. The data further fuels red-hot inflation as oil and wheat prices soar with the war in Ukraine, reaching another high in tensions over a nuclear facility. Secretary of State Anthony Blinken engaging NATO talks in Europe, but the alliance making clear they will not impose a no-fly zone over Ukraine. Lawmakers here push to ban Russian energy. We speak to California-based software company Nutanix to break down their earnings and discuss the path to profitability ahead given rising inflation and a war within Eastern Europe. Plus, they say diamonds are a girl's best friend, but they could be harder to come by given sanctions slapped on one of the world's largest producers of rough diamonds. You guessed it. They're based in Russia. We speak with an expert based here at home. Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor, Jared Flickery. Happy Friday to you all. Thanks for stopping by and spending some time with us today. Jared, investors may be really happy it is Friday today because they've been whiplashed all week long. Markets lower despite that big jobs beat, although off session lows at the moment.
Yes, you have to think that sometimes good news is bad news and bad news is good news. And then you have the additional bad news with Ukraine thrown in there. So let's get a quick check of the markets here after that big payrolls beat on the headline number. You can see the Dow down about 170 points, the S&P 500 off about 2/3%, and the Nasdaq is the biggest loser off 1.25%. Also want to check in on the bond market where we have seen yields just crashing. The 5-year, the 10-year, all down 10, 11, 7 basis points respectively. You can see the 10-year yield down to 1.73%. And we also need to check the price of crude oil, which has surged this week to the highs that we haven't seen since 2014. We have WTI up $4 to 111.98. That's up 4%. Brent is up to 114. Natural gas also seeing gains of 4% along with gasoline. We know those prices at the pump that we've been covering. Those have been heading higher. And also heating oil up 6%. So energy just flying high today. And for more in the markets, we want to bring in Yahoo Finance's Ines Ferre, who's standing by at the Wi-Fi Interactive with some more of today's tickers that are moving. Ines.
Yeah, Jared, and just looking at the sector action, I mean, you just mentioned yields, falling yields. Well, take a look at financials right now. As far as the sectors are concerned, the worst performing sector for the day. In fact, I'm going to also pull up a 5-day chart so you can see where we would end the week with financials being the laggard, energy, of course, being the winner for the week. Financials going into their 3rd consecutive week of losses for banks. Also looking at travel stocks, we are watching a lot of red when it comes to the airlines. This is just a daily chart. If I pull up a 5-day chart, you can see some of these airlines down double digits percentages. You had earlier this week, at the beginning of the week, Russia banning airspace for Western airlines. You're seeing oil prices, which are surging. So all of this having an effect on the airline industry. I also want to mention Chinese ADRs. Those are trading lower today. Now, I do want to pull up defense stocks because we are seeing some defense stocks at or near record highs. We're looking at Lockheed Martin today up more than 2%. We're also checking out Northrop Grumman. That's also higher, up more than 4%. And General Dynamics also at highs. And finally, just checking out the commodity space. I know you mentioned just WTI and Brent crude, but also looking at some of the metals, the precious metals. We're watching gold futures, which are higher, up more than 1.5%. We've been watching palladium just absolutely on a tear, up more than 8%. Also, aluminum futures are also higher. Keep in mind that we're not just talking about disruptions from Russian supply of metals, but also when you have higher energy prices, remember that it takes energy to mine the metals. So that's also contributing to that upward pressure on prices as well. Jared, Karina.
Okay, yeah, those numbers, some of them are eye-popping. And as for thank you so much, and we'll see you a little bit later on in the show. I want to turn it back to the jobs report and bring in our next guest. David Dodson is a Stanford University business professor. Professor, thanks so much for joining us today. And just want to get your reaction to that jobs report. The number was big, 678,000 jobs added to the U.S. payrolls. The estimate was for 422,000, unemployment dipping to 3.8%. What are your big takeaways?
Well, let's sort of break it down, and let's start with taking the Russian invasion of Ukraine and put it to the side just for a second. So what does that number of jobs mean? Well, I think it's good to sort of imagine you work for a company that has 250 employees. That meant they added one job. So it's better than losing a job, and it's better than no jobs, but it's not sort of a remarkable change in the US economy if you think of it in the context of a company like that. To me, the number of jobs that were added was pretty consistent with what we've been seeing in this post-pandemic world, where people are returning to work, where employers are trying to meet consumer demand. It was no big surprise to me. And the difference between 400,000 and 600,000 on 150 million person workforce isn't really actually that big of a number. The second thing I would think about. Yeah.
Mm-hmm. Yes, go ahead. Go ahead.
Yeah. The second thing I would think about is the unemployment rate. And so, we're definitely at full employment. Everybody who, if you think about full employment is kind of in the 2 to 4 range, you could argue that everybody who wants a job can get a job. Now, when you think about the unemployment rate coming down, you have to think about two things: the number of jobs that are being added, which we just talked about. But there's another part too, which is the number of people who are looking for a job. And that's what's captured in the unemployment rate. And we've got kind of a remarkable thing happening now, which is the worker participation rate is down 4% compared to where it was pre-pandemic. A lot of people have retired. 1% more of the population is retired now than it was before. So we've got this kind of heated economy or semi-heated economy and fewer people to go take those jobs.
Okay, and then so I also want to ask you what you make of the hourly wages rate, because they were flat on the month, up 5.1% year over year. What signal does that send? And then how much is that hurting, consumers, where real wages are actually negative and we see these prices going astronomical at the moment?
Yeah, it is curious, isn't it? What's interesting is that there's two parts to the inflation. One is sort of we know what historical inflation is, and it's really high. But there's a second number, which is what consumers are anticipating inflation to be. And why that's so important is because consumers' anticipation of inflation can be a self-fulfilling prophecy. And curiously enough, consumers' expected inflation rate over the next 5 years is only about 3%, which is just a little bit higher than the Fed's target of 2%. So American consumers are sort of saying, yeah, prices are cranking up because people are going to work and we have a lot of money and there's some pent up demand, but we think it's going to settle back down. However, remember, I started this by saying we have taken sort of the Russian invasion of Ukraine and put it to the side. Well, oh boy, that none of that is captured in these numbers.
Yeah, absolutely. There is a great deal of uncertainty over what happens in Ukraine and if there is an escalation in tensions there. So I'm wondering, how does the Fed take the report that we saw? How much does it propel it on its course that it's laser focused on reining in high inflation amid this uncertainty that's going on? No one exactly knows which way it's going to go.
Yeah, so the Fed is supposed to work on two things: one, unemployment, and inflation. Well, unemployment's fine. There's nothing for them to do there. So now they need to shift their focus on inflation. And clearly, we have the potential for an inflationary environment, not just because of what we've already experienced before Russia's invasion into Ukraine, but also now you've got, because of this invasion, now you've got almost certainty that energy prices are going to go up and other commodities are going to be more expensive because Russia provides a lot of wheat and Russia provides a lot of gas and oil. And all of that is going to sort of ripple through the economy. Plus, when you have disruptions in the supply chain, like we've already had, and now you had Russia and China disrupting that supply chain, costs are going to go up. So Fed is going to have to raise interest rates, and they've said they're going to raise interest rates. And we sort of knew that. The second thing is that to get through the pandemic, everybody has to remember that the Fed artificially dropped interest rates very, very low because they wanted to sort of assist the economy through the pandemic. Well, we're largely through the pandemic, so it is time for the Fed to get the rates up to sort of normal interest rates that we would expect, where there is actually a price to the cost of capital. We've spent, pretty much the last couple of years where capital has been free.
Okay, and we do have the president set to speak shortly, so I may interrupt the next question, so bear with me. I apologize if I need to cut you short. But then how worried are you that the Fed doesn't achieve a soft landing? Powell said that is possible. And then what are your fears that a recession is on the horizon?
First of all, you can interrupt me for the President of the United States. That's okay. I think that the Fed has done a really good job, a remarkable job of signaling in advance of what they're going to do and doing it very gradually. So they are just adjusting the knob a little bit at a time, and they're telling us in advance they're going to adjust the knob a little bit at a time. That's an extraordinarily safe way to manage it. And so I don't expect the Fed to be doing any major disruptions in the economy. I'm more worried about, what's happening in the Ukraine than I would anything that the Fed would do.
And then tied to that, we're seeing oil and commodities soar. What sort of oil price are you looking at that could, make you sort of rethink where we are and that a recession is on the horizon?
Well, I don't think that the disruption to the energy markets is going to be medium or long term. We're going to make adjustments to that in the medium term. Obviously, when you affect the flow of natural gas and oil out of a country that supplies as much as Russia does, you're going to have an immediate pop. But Russia's, for example, Europe's liquid natural gas or LNG capacity is only at about 50%. So they have an opportunity to shift from Russia to other sources of natural gas. We also have a lot of places in the world that are not at capacity. The Middle East is not producing at capacity. So we're going to make those adjustments over time, and prices are going to come back down. We're just going to have to swallow hard for a while. I mean, let's face it, Europe's at war, and we can't have a war going on in Europe and expect, we want gas prices to be exactly the same. We're going to have to feel some pain, and we're going to have to feel some effect of that.
All right, we will leave it there. Thank you so much for your perspective, David Dodson, Stanford University business professor. And we want to help you step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. You can get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. Just check it out today at yahoofinance.com/plus. And I'll send it over to Jared. What's up next, Jared?
And coming up, as sanctions against Russia heat up, some crypto exchanges are saying, let them trade, saying no to financial bulwarks against Russian crypto traders. After this. Welcome back. We're following the latest development on the war in Ukraine. NATO allies meeting earlier and rejecting Ukraine's call for a no-fly zone over the country, saying it would amount to an escalation of the conflict. Meantime, the European Union is reportedly considering Russia's rights at the International Monetary Fund, which may be included another round of sanctions. All of this coming after Russia took over a Ukrainian nuclear power plant overnight, which is the largest in Europe. Well, we want to stick with the Russia-Ukraine crisis, but take a little bit of a different tack. The list of companies voluntarily cutting ties with Russia is ballooning. Apple, Microsoft, Intel, even FedEx today. But crypto exchanges, Coinbase and Binance, are taking a different tack for now, saying they won't kick Russians off their platform absent a government decree. And with all of this and more is Yahoo Finance's David Hollerith. And David, thanks for joining us here. What are the details? Because as I understand, a lot of mainstream traditional finance companies in the U.S. have been following the sanctions guidelines. Some of them have been going above and beyond what they had to do voluntarily, and making some voluntary adjustments, but not so in the crypto space.
That's right, Jared. So this has been legally cryptocurrency exchanges have sort of followed the mandates that have been set up by NATO allies since last week. But there's been generally sort of conversation, and it's not totally clear or proven out whether or not cryptocurrencies would be useful for evading sanctions. Technically speaking, it seems like it could be possible. There's been a lot of data that's come out about whether or not it could happen to a substantial degree, and that seems to be proven incorrect in terms of commerce between the two economies. But going back to the cryptocurrency exchanges, these companies are mostly large centralized cryptocurrency exchanges that have U.S. clients. And they have sort of come in over the past week and have sort of restated the fact that they will not block the accounts of non-sanctioned Russian individuals. So what the tack that they're taking right now is that cryptocurrency is acting as a lifeline for these people who might be in Russia, who might not necessarily agree with what's going on, but need some kind of safe haven. Given the Russian ruble situation, the general economy in Russia. Now, this is also followed by lawmakers' calls, Elizabeth Warren, one of them, who have been asking for corporate entities, especially cryptocurrencies, to sort of get behind the effort, so to speak. Now, so the Treasury Department hasn't laid down stricter sanctions, but the trend is obviously it's being bucked against what larger financial institutions are doing. I think that an interesting point to note here is the fact that cryptocurrency is kind of standing up and it's taking a larger role in this conflict, in the sense that on both sides it's being used, and the question is sort of remaining about what could potentially go wrong versus what is actually feasible.
Well, and you have to imagine eventually down the pike, if we get more conflict and if the tensions ratchet up, there could be some government decree that forces these exchanges to divest the Russian customers of their assets, or at least to kick their customers off the platform. I'm just wondering, what do you think it takes to get there? And then what would it take to get there for these companies like Coinbase and Binance to do this voluntarily?
Yeah, absolutely. Like I said before, for these cryptocurrency exchanges, like the background of which cryptocurrency was sort of created, this is not necessarily off par with where they've stood. Again, cryptocurrency's never been seen as an asset that's been used in a time of war like this, to this degree, I guess you could say. But things we would look to see if something would change would obviously be an announcement from the Treasury Department to sort of increase sanctions. Another thing that could happen would be that a cryptocurrency exchange, which they have the monitoring tools in place to sort of check transactions coming to their exchanges and to see where those transactions are coming from, the origination of funds. It would be for them to spot individual accounts that look nefarious or look tied to maybe some other accounts that are sanctioned, and they would, potentially halt them. And in that scenario, we're not really sure how that would work. all the exchanges have procedures for it, but obviously that could snowball and change the situation drastically. I think a very realistic situation is that there are cryptocurrency exchanges that are not the ones that we're hearing about, that are they don't have compliance. And those are likely to be sanctioned by the Treasury Department, given a certain matter of time. So those are exchanges we've never heard of and are not very large, and the volumes on there are not very high. But that's probably the most likely thing we can expect.
Yeah, and I should add that both Coinbase and Binance have released statements that they are abiding by the anti-money laundering guidelines and also the Know Your Customer rules in the U.S., including on all customers that they have around the globe. All right, thank you for that, Yahoo Finance's David Hollerith. And Karina, what are we checking on next?
Now, that was a great discussion, guys. There's much more Yahoo Finance Live ahead, including we're awaiting comments from President Biden on that blockbuster jobs report. Stay with us.
But if you hear Jared, that's what's going on.
Got it. I've never heard him even close.
Welcome back. Canadian cannabis company Curaleaf just reported record annual revenue in addition to adjusted EBITDA of $1.2 billion, up 93% from 2020. The results were a bit shy of expectations, stock down a little bit today, but we do have Curaleaf CEO Joe Bayern standing by with Yahoo Finance's Dave Briggs. Dave, I'm going to turn this over to you now.
Appreciate that, Jared. Yeah, always the highs and the lows of the cannabis industry evident in the numbers. Let's talk about it with the CEO of the biggest cannabis company on the planet, Joe Bayern from Curaleaf. Joe, good to see you, my friend. I have to disclose to our viewers, I am part of an ongoing Curaleaf PR campaign entitled iCannabis. Proud to be a part of that and an advocate for the industry as well. But let's talk about the numbers. You top $1 billion in revenue for the first time. But yet the stock still looks like swag, down $10 a share in the last year and down about 20% in recent days. What's your reaction to the latest numbers?
Yeah, obviously, we're very pleased with our performance. We felt we posted a very strong year in 2021. As you said, our revenue topped $1 billion to $1.2 billion, which was a 93% increase from prior year. And I think not only is it an important milestone for Curaleaf, but I think it's a really important milestone for the cannabis industry, that we're demonstrating that the key players in the industry, are becoming billion-dollar businesses capable of generating significant revenue, creating jobs and tax revenue in the industry, and also obviously creating margin. So we think it was a strong performance on the back of another strong performance in 2020.
$320 million in revenue in Q4. We're now legal. Cannabis is legal in 18 states plus DC, legal medically in 38 states. We have New Jersey, New York, and Connecticut coming online recreationally over the next year plus. When do you expect those sales to kick in, and how big a difference will it make for your bottom line?
Yeah, I think we, Curaleaf, we're well positioned to take advantage of the growth in the Northeast corridor with New Jersey coming online. We hope that's happening before the end of the first half. We expect it to be sometime around the beginning of May. And then, of course, Connecticut and New York coming online toward the back end of 22 and into 23. So these are our core states. We're well positioned in these states. We're number 1 or 2 in each of those states. And we're ready for adult use to commence. And we believe it could be a significant tailwind to the cannabis industry. So I think when we look at our position, we feel we have a strong position in the Northeast, but then other growth markets like Florida continue to grow, Arizona, and of course the West Coast.
And when you look at public opinion polls, it is soaring more so than maybe Tesla stock. 68% of Americans late last year, according to Gallup, are in favor of marijuana legalization, yet legislation federally really just stuck. I know there is a Republican in the House, Nancy Mace, now introducing legislation, as well as Jared Nadler, Democrat in the House, and Chuck Schumer, the Senate Majority Leader in New York. But why do you think federal legalization is stuck, and what's your message to Congress?
As you said, I think the American public has overwhelmingly voted in favor of legalization of cannabis. And, we believe that every American should have access to high quality legal cannabis as not only part of the health and wellness regimen, but adult use. And I think, it's time for legislators to catch up with the American public. They've overwhelmingly spoken in favor of this. And I think legislators have to respond by enacting law that is consistent with the wishes of their constituents, whether it's at the consumer level or at the state level. It's time to have legislation reform to reflect what the American people desire.
Joe, an interesting article in Politico points out that many thought this was a green light, Democratic control of the House, the Senate, and the White House. But this article in Politico points out that the Biden administration not only fired people early on for testing positive or admitting use of legal marijuana, but now it discourages people who want to apply for White House positions from even investing in legal marijuana companies. Why do you think the Biden administration has largely been a roadblock? And what's your message to the president?
Yeah, I think it just shows how out of touch some of our legislators are with the American public and what's going on in our country. I mean, the cannabis industry is a $25 billion industry. We expect to grow to over a $100 billion industry over the next 10 years. We've created hundreds of thousands of jobs. We've created over $10 billion of tax revenue over the last 5 years. And that growth is continuing. So candidly, it's a little bit bewildering to us why the legislative.
I'm sorry, we have to cut you off here, and we're going to go straight to President Biden, who is taking the podium.
What Johnny didn't tell you, he's a break dancer. But he's not going to do it on the stage right now. Before I begin officially today, I want to thank the Made in America director, Celeste Drake. I also want to acknowledge it's her birthday, and it's really tough turning 30, so be nice to her. Happy birthday, kid. And Johnny, thank you. Thanks to all your coworkers. I just had a chance to meet before you all came in. And I want to thank Barbara Humpton Siemens. Lonnie Stevenson, president of the IBEW, one of my closest buddies, and he's been my friend for a long, long time. Earlier this week in my State of the Union address, I said there was something happening in America, starting with historic economic recovery that we're seeing right now. And today, we've learned that in February, our economy created 678,000 new jobs. 678,000 new jobs. And over the course of my presidency, our economy has now created 7.4 million jobs. More jobs created in a 13-month period than any time ever before in our history. And we've learned that in February, the unemployment rate fell to 3.8%, down from 6.4% the day I took office, and beginning in 2021, which is the fastest decline in unemployment rate in recorded history because of all of you. And by the way, before the American Rescue Plan passed, the Congressional Budget Office didn't project our unemployment rate to hit 3.8% at any time over the entire decade. Americans are back to work. Yes, family budgets are still tight, but a lot of Americans are getting paychecks this year more than they got last year, and restoring the dignity of work so they can show up at work with some pride. You know, job gains in February were broad-based across sectors, from construction to retail to manufacturing to leisure and hospitality. The decline in unemployment rate was broad-based as well. The fact that unemployment rate among workers without high school degrees fell to 4.3%, the lowest on record since we've been keeping records, 4.3%. It's amazing. Workers' weekly earnings rose in February. The people in working class sectors like transportation, warehousing saw some of the strongest wage gains. This is what it looks like to grow an economy from the bottom up and the middle out. Because of the progress we've made in fighting COVID, Americans can not only get back to work, but they can go to the office and safely fill our great downtown cities again and gaining more commerce. With 75% of adult Americans fully vaccinated and hospitalizations down by 77%, most Americans can remove their mask, return to work, and move forward safely. Today's news is a welcome reminder that we're coming back stronger as a country and as a people. You know, we've been through two of the hardest years this nation has ever faced. The pandemic has been punishing, as many of you know, and some of you may know it from a personal standpoint. Maybe you lost someone in this process. You got up this morning and looked at an empty chair. Well, it's been punishing, but we're coming back. And so many families are still struggling, though, to make ends meet because of inflation. I understand our top priority must be getting prices under control. Look, our economy roared back faster than most predicted, but the pandemic meant that businesses had a hard time hiring enough workers to keep up and production in their factories. The pandemic also disrupted the global supply chains. When factories close, it takes longer to make goods and to get them to the warehouse and get them to the store, and prices go up. Just take a look at cars. Last year, there weren't enough semiconductors to make all the automobiles people wanted to buy. They had a lot more money in their savings accounts and in their paychecks, but they weren't able to go out and spend it on leisure because of COVID. So what happened? They decided that they were purchasing products like everything from homes to automobiles to hard products. And the price of automobiles, for example, went way up. More people seeking them and fewer being made. And we have a choice. We have a choice. The way to fight inflation is to drive down wages and make Americans poorer, or have a better plan to fight inflation, lower costs, and not your wages. The more semiconductors we make in America, and by the way, they were invented here in America. The semiconductor was invented in America when we went to the moon. And when we do that, when we focus on making sure that we make those again in the United States of America, so few are being made, we make a heck of a lot more cars. And you bring prices down. The supply chain is filled. investment in America, rebuilding roads, bridges, airports, ports. We invest in innovation in America. That's exactly what we're doing. Look, as a result, we're seeing more jobs, more hope, and we're also seeing something else, the rebirth of pride. The rebirth of pride that comes from stamping products made in America. And we're seeing the revitalization of American manufacturing. And that's what I want to talk a little bit about for the next few minutes. Today, companies are choosing to build new factories when just a few years ago they would have built them overseas. They're investing right here in America. On this very stage, we were standing before Intel. The chairman of the board of Intel was here. He announced a $20 billion.
You were just listening to President Biden discuss this morning's non-farm payrolls report that posted a nice beat of 678,000 on the top line number. Want to get a quick check of the markets here before we go to break here. And we're seeing the Dow down about 0.2% on the Wi-Fi Interactive, but the Nasdaq is the biggest loser of the day, down 1 1/3%. Just looking at some of the sector action, we see utilities in the lead. It is up the most, 1 3/4%, followed by energy, crude oil on the move as well. Also want to check some breaking news with respect to Facebook. This comes, it looks like, from Interfax. Facebook is being blocked in Russia by the country's communications regulator. Also getting reports that the BBC website has been blocked there. And also earlier today, a separate report from the Washington Post saying that Cogent Communications is preparing to sever relations with Russian customers. They are a major provider of one of the biggest backbones to the Russian Federation. And on that note, I'm going to send it over to you, Karina, to see what we're talking about after the break.
Yeah, there are a lot of fast-moving developments there, but we're going to switch gears. Coming up after the break, California-based infrastructure software company Nutanix just delivered fiscal earnings that beat the street, and the CEO will be here to discuss those results. Stay with us. Welcome back. Well, California-based infrastructure software company Nutanix just delivered fiscal earnings that beat the street. And here to help us break down those results is the company's CEO, Rajiv Ramaswamy. Rajiv, thanks so much for stopping by with us today. So congratulations. You had a nice beat. Revenue was up 66 million year over year. That's about 19%. EPS showed a narrower loss than the street expected, coming in at -3 cents versus a loss of 19 cents. So what helped drive those results and bring in the red, in your opinion?
Yes, I mean, we delivered a solid quarter, exceeding all our guided metrics. And we've been focused on strong execution here as we deliver our hybrid multi-cloud portfolio to our customers. Fundamentally, what's happening in the market is that companies are going digital. They're going to the cloud. They are looking at how to run their new applications and enabling a distributed workforce. At Nutanix, we provide a cloud platform that allows customers to run their applications wherever they'd like to run them. In some ways, we are like an Airbnb of the cloud, where we help our 21,000 plus customers run on the cloud of their choice. And with our cloud providers, we help them gain access to our 21,000 plus enterprise customers. And this fundamental trend continues, and it's helping drive our strong execution for the quarter. As you pointed out, I would also say that we grow our ACV billings, which is more of a measure of our subscription business, 37% year over year. We had positive free cash flow for the first time after we turned into our subscription model. And overall, we continue to execute and track above expectations.
And Rajiv, thank you for being here today. I want to take a step back and just try and figure out, for the average viewer, you might say the words hybrid multi-cloud, those eyes glaze over a little bit, but there are various cloud setups here. How does this work in particular?
Yes. I mean, I think fundamentally, if you look at what companies want to do, they are focusing on how to manage, run, and move their applications and data efficiently and effectively across multiple clouds. So applications and data are the two most critical things that companies care about. Now, most companies that we talk to, in fact, we've done a survey that shows that 83% of people that we talk to in IT will be running in a multi-cloud environment. They want the choice and flexibility of multi-cloud, but it can be very complex. So a hybrid multi-cloud environment can help them achieve that flexibility while addressing this complexity. And so this is where we help them. We provide this very simple single platform for helping these companies digitize their business and run the applications wherever they want and manage the data wherever they want. And fundamentally, our vision is all about making clouds invisible and delivering cloud as an operating model to these companies.
Rajiv, you've got some of the biggest names tied to your company and branding, including JetBlue, Nasdaq, L'Oreal, a host of names. And I'm wondering, what are some of the challenges using your service? Are they looking for things to be a little bit more streamlined?
No, actually, customers appreciate the simplicity of what we do. So in fact, if you look at the reason why customers adopt our products, I mean, we make complex enterprise infrastructure really simple. So simplicity is one. We provide them a lot of freedom and flexibility at every layer in the stack. They can run on the choice of their hardware, choice of their hypervisor, choice of public clouds, choice of cloud native stack, and choice in terms of how they do business with us with no lock-in, completely flexible licensing that allows them to port their licenses wherever they'd like to go. And fundamentally, the focus on customer delight. As an enterprise software company, we are one of the few companies that have a Net Promoter Score of 90, a customer NPS of 90, which is way off the charts for most companies. And it's a testimonial to how customers appreciate and help like using our products and want to do more with us.
Since you've taken the reins here, I understand that your path to profitability here, you're now targeting the second half of 2022. That's just a few months away, actually. I'm just wondering how that gels with your, for instance, growth strategy. And at the end of the day, you have to appease your investors, right?
Yes. In fact, it's a combination. What we said at our last Investor Day is that we would grow our top line ACV, annual contract value billings, at 25% through our fiscal 25. While at the same time delivering consistent free cash flow positive by the end of this year and continuing to deliver positive operating income starting the following year. So we are trying to blend both. And as you can see, our results reflect that. In fact, we were free cash flow positive this quarter, somewhat ahead of what we had said earlier. But again, we want to be there consistently while also continuing to drive 37% top line ACV growth. So it's a blend of both, and we're managing both.
All right. Thank you so much for that. We will leave it there. Rajiv Ramaswamy, Nutanix CEO. Thanks for your perspective today and breaking down your results.
Thank you very much.
Jared, over to you.
You're right, Karina. Guess what? You're going to love this one because we're going to be talking about your very best friend, Karina. That's right, the white hot diamond market. How it might be a little bit more difficult to get them out of the Russian Federation, which is a huge producer, by the way, after this. Welcome back. The white-hot diamond market is on fire, with jeweler sales up 29% in 2021, diamond cutters up 55%, and miner revenue up 62%. But new sanctions on Russia, which accounts for over a quarter of global diamond supply, may keep those stones forever in Russia. And for more on this, we want to talk to Fred Cuellar, a.k.a. the Diamond Guy, founder and president of Diamond Cutters International. Fred, great to see you here. And just break the situation. You bet. We'll get to your business in a second, but we want to talk about the breaking news here in Russia and exactly what they're doing to keep some of those stones off the market potentially.
Well, the idea is that about 1 in every 4 diamonds is coming out of Russia. And so the question becomes one of a solidarity in the diamond industry, to not allow these stones into the U.S. Markets so that you don't have somebody worried that they're somehow supporting the atrocities that are going on right now. And what's nice now is it's not like back in the old days. You can use blockchain technologies in order to track diamonds from mine all the way to an engagement ring finger. So it's not that difficult for somebody to walk into their jewelry store and say, hey, I don't support Russian diamonds, and I want to make sure my diamond is 100% not a Russian diamond. It's actually not that difficult.
Topic close to my heart because I have so many family in the jewelry business based in Antwerp and India as well. Nobody based in Russia. But I'm wondering, so mining, polishing, retail, all now above pre-pandemic levels. There's really been a remarkable recovery in the diamond business, since the worst of the pandemic. But I'm wondering, how does that impact now? The sort of recovery. How does Russia impact? How does a conflict impact that? And does it sort of turn the clock back on recovery, do you think?
Well, what's interesting is during the pandemic, or right at the beginning of March 2020, my original thought was, this can't be good for business. But what was interesting, we found that 2 rings showed up during COVID. Either you wanted to ring somebody's neck or you wanted to put a ring on it. There were literally women all over the world who said, if you're going to commit to me during a global pandemic, then you're never going to commit to me. So you're right. The demand actually skyrocketed when suddenly women all over the world said, enough's enough, Beyonce style, just put a ring on it. But no, I don't believe we're going to turn back. Just yesterday alone, Botswana has already said, hey, look, short-term wise, if we have to step up, work a little bit harder and mine a few more diamonds out of the ground so that we can meet what's being pulled from the marketplace, we'll do so. And we see this all the time with oil. When someone says, well, wait a second, there's a disruption in the market, then someone says, okay, it's time to go to some reserves.
Well, and let me ask you about the diamond industry in general. We've had artificial diamonds coming online in recent years over the last decade or 2 decades, getting better and being more difficult to discern from them. This takes away supply from the market, and De Beers is historically probably the most successful cartel over time. Is this in fact a boon for prices?
I think I hear 2 questions there. One question is, at least that I've heard, is it possible that diamond prices get so high in the natural market that some people may decide they're going to move towards a lab-grown stone? I'm really not seeing that. If anything, the prices keep dropping on the lab-grown stones to just a few $100s per carat. What we're seeing is people really want the real thing. They want something that's natural, something that has value to them. So as far as we can see, even with the overhang, we don't see there to be any issue with somebody saying, geez, I want something that was made in a lab in 3 weeks versus something that took 800 million years to grow.
There are so many seasons in the diamond industry, and we just came off engagement season. We're right in the middle of wedding season. So many weddings held off last year because of the pandemic. So I'm wondering, are you seeing demand sort of surge now for naturally mined diamonds? And then also wondering, when do those prices, the sanctions on Russia, start to hit the prices of naturally mined diamonds here in this country and drive prices up?
Yeah, I think it's a great good question. Because of the way the supply chain works, is in the short term, you don't see any fluctuation in prices. So that's not going to be an issue because it takes a while for them to come down the pipeline. The question becomes is what will the price range be midterm? Based on what it appears to be with Botswana, South Africa, other countries that are going to be filling in the gaps, it's very possible that you could see 5%, 10%, 12% price increases 6-8 months from now. But is Russia being off the market a disruptor? I don't see it.
All right, we'll have to leave it there. I still had so many questions for you, including which is the most popular cut of diamond that people are looking for, but we'll leave that round. Okay, thank you. Thank you so much for your time today. Fred Cuellar, founder and president of Diamond Cutters International. Jared, over to you.
I had some more questions too, but we're going to have to leave it there. Coming up after the break, we're going to get a check of the markets after this. Welcome back. We want to check the markets here, and we're seeing the Dow down about 86 basis points, S&P 500 down 1%, and the Nasdaq off the most, down 1.6% as we're looking at the Wi-Fi Interactive. Let's just chart today's price action here. You can see we started off in the red and we headed lower, but we are off those lows right now. And I also got to get a check of the bond market. We're seeing yields absolutely tank today. We have the 10-year yield down 10 basis points, and we got to check on the airline sector as well. Carnival Cruise Lines down 5%, but it's the airlines we're wondering about. Delta off 5%, American Airlines off 7%. Look at the 5-day totals here, not pretty. Having said that, we've got more market action after the break. Jobs, jobs, jobs. 678,000 Americans entered the workforce in February. The unemployment rate hit a pandemic low of 3.8%, but no wage growth. We got Keith Fitzgerald on deck to tell us why. Plus, in a minute, Siemens CEO Barbara Humpton just left a meeting with President Biden at the White House. She'll break down the $54 million Siemens is investing in infrastructure like EV charging stations. And cheers if you're boycotting Russian vodka for a time, but you probably won't even notice, as Russia is number 6 on the list of top vodka exporters to the U.S. Who's selling the most martini fuel to Americans? The surprising answer in a bit. I'm Jared Blickery, along with Karina Mitchell, and we got the next hour covered for you, and we want to talk about the markets right now and bring in Yahoo Finance's Ines Ferre, who's keeping an eye on some of the top trending tickers of the day. And it looks like we're going to start out with Gap, Ines, and that stock flipped into the red. That follows a Wall Street analyst that is downgrading the stock after their earnings report.
Yeah, Jared. So let's just start out with where we were first when the markets opened, and you saw a Gap up more than 13% at one point, and now it's in red territory. The company's adjusted full-year earnings per share forecast beat Wall Street estimates, and its net sales for its latest quarter was $4.5 billion. Adjusted loss per share came in at 2 cents. The street estimate was for a loss per share of 14 cents, and the company talked about supply chain issues that it had during the quarter, but Gap expects shipping issues to improve. Now, you did have some bullish commentary from BMO, from Wells Fargo on that guidance. However, then you had Morgan Stanley coming out with Kimberly Greenberger, and Morgan Stanley has an overweight rating, saying that she was disappointed with Gap's, the fact that Gap was not profitable during a holiday season. And she also said that the guidance was overly optimistic, that given the inventory challenges, freight headwinds, and inflation, she just felt that guidance was too optimistic. Jared, Karina?
And then Inez, Sweetgreen reporting quarterly results today. That's my daughter's favorite place to order from, but helped by suburban markets.
Yeah, that's right. I haven't tried it yet, but certainly Sweetgreen was helped by the suburban markets, which Sweetgreen said it went back to its 2019 level. Same-store sales rose 36%. Also, its revenue beat Wall Street expectations with a 63% year-over-year rise. Its loss per share for the quarter came in a little bit wider than expected, but still the company putting up a strong outlook. Some positive notes from the street. Oppenheimer noted impressive results, and especially saying that given the headwinds that peers have faced with respect to margins, that Sweetgreen's results were impressive. As far as the company, the salad chain company is concerned, though, you have to also keep in mind that Sweetgreen doesn't offer meat, so that has been something which has helped the company navigate rising commodity costs. There are currently 7 buy recommendations on this stock from Wall Street analysts, and one sell with an average price target of $37.
All right, Ines, I know you're also keeping an eye on Airbnb. They're looking at banning their customers from using Russian services in their country. What's the fallout from this on the charts? And I can kind of see it out of the corner of my eye here.
Yeah, that's right. Well, Airbnb right now is down 7%. In fact, I'm actually going to pull up a travel chart because you can really get sort of a better idea about what's going on with the travel sector in general. So you can see here Airbnb on the left corner, down 7% after CEO Brian Chesky put a Twitter post today saying that it was suspending operations in Russia and Belarus. Now, this is, of course, the latest Western company to stop operating in Russia. Chesky also said that Airbnb is going to be giving free temporary housing for up to 100,000 Ukrainians, refugees in neighboring countries. This is funded by Airbnb, also by donors and hosts. And in fact, he's been also retweeting some of these screenshots from customers who are booking homes in Ukraine, of course, not with any intention of going there, but just to help out local hosts. Now, it's interesting because we saw at the beginning of this week, we saw it first with the oil companies, which were pulling, the multinational oil companies, which were pulling out some of their investments or stakes in Russia. And then you saw it with other companies. Now we're seeing it more and more at the end of this week with tech companies that are pulling out their operations from Russia. You've got Apple, you've got Microsoft that also said that they will not be selling their products, their services in Russia. Dan Ives wrote an interesting note saying that the U.S. tech, if it pulls out of Russia, would be about 1% to 2% revenue impact in a worst case scenario for these companies.
All right. Thank you for that. Yahoo Finance's Ines Ferre. I got breaking news here that's affecting the oil market. Crude oil, WTI, shooting higher here on news that President Biden is considering a ban on Russian oil imports. This is a Bloomberg report sourcing unknown or unnamed people, And this is a measure that apparently has bipartisan support. It's gaining bipartisan support, and a White House spokesperson has said no decision has been made yet. But I just want to show you a chart here of crude oil spiking higher. Now, the high that we saw the other day was 116 and change. We can see that on this 6-day chart here. Haven't eclipsed that just yet, but you can see that crude oil indeed spiking higher. All right, we're going to be back right there. We're going to be back right after this. Welcome back. Crippling economic sanctions against Russia are taking their toll on both the government and ordinary citizens. The Russian central bank recently doubled short-term interest rates and imposed capital controls. And here to break down all of the fallout and potential adverse reprisals is Karsten Brzezinski, ING Research Global Head of Macro. And Karsten, thank you for being here today. Can you just give us an overview? Because we get these reports piecemeal. FedEx is blocking their operations or not serving the area, Microsoft today as well, but kind of paint a broad picture for us of what's going on.
Yeah, quite a lot, to be honest, especially since last weekend. Well, I think we had the official sanctions, and the official sanctions were first, and that was very important, freezing of the Russian central bank's assets when it came to FX reserves. So all the FX reserves held in Western central banks were frozen. That is one. Then the next thing is that a couple of banks were excluded from the banking communication system SWIFT. So this clearly more or less has cut off these Russian banks from international payments. makes it extremely hard to actually to pay and to get revenues into the country. Now we have the longer term the longer term sanctions targeted at individuals. I'll call these the sanctions on the oligarchs. Then there is the longer term sanctions, the export ban on high-tech goods out of the EU and out of the US to Russia. So, for example, think of parts for aircrafts. So this should, in the longer run, undermine the Russian high-tech sector. And then on top of that, we have, let's say, without actually official sanctions, now that so many Western companies started to pull out of Russia, started to cut the ties with Russia. So the only thing actually that is still left is that we still have gas and oil flowing or being pumped from Russia to the US, to the EU, and both countries are also paying for that.
And I'm just wondering here, we got a bit of breaking news. I don't know if you heard it before the break, but Bloomberg is reporting that the White House is considering banning all imports of Russian oil. And we know that Russia is the third largest crude pumper and producer in the world. What kind of effect could this have on the global economy, and not just Russia, but also the United States?
Well, on the global economy, this clearly means, and you also showed it before, higher oil prices, and not only temporarily higher oil prices, but really sustainably higher oil prices. And what this means for the global economy is the global economy, depending on where you are, at least slowing down. For the US, I would argue there could be a bit of slowing down. For Europe, it's actually much more severe. In Europe, we would talk about a stagnation, and we even have a risk of a recession, because in Europe, the dependence on Russian oil and gas is much higher. So if here the imports would be stopped, this would put pressure on prices. Higher prices mean pressure on consumers, but also on companies. Don't forget that on the manufacturing sector, because there could be supply disruptions. So this is not only higher prices, but this could also lead to production disruptions.
And I want to take a different angle here. A couple of developments today. First, there is a Russian watchdog that blocked Facebook in the country. That's according to Interfax. And then a key provider of the internet backbone that serves them from the U.S. One of that is called Cogent Communications. They are blocking access. And I have to think, if I'm the average Russian citizen and suddenly I'm blocked from not only social media apps, but my internet is slowing down because companies are withdrawing support, at what point does the public potentially revolt against this?
I wouldn't dare speculating here, in all honesty, but I think what it means is that the public will start to wake up. The public will also start to realize that there is more going on that they have been told so far, because the narrative that is being told in Russia is clearly a different one from the narrative we hear in the US or in Europe.
Well, you can bet your bottom dollar on that. Really appreciate your insights and stopping over here. Karsten Brzezinski, ING Research Global Head of Macro. And Karina, now I turn it over to you.
Okay, I want to bring things back over to this part of the world. Tech companies are opening up their offices, but the nature of tech work has changed. Here with more, let's bring in Yahoo Finance's Dan Howley. Dan, Apple is the latest to mandate a return to office next month.
That's right, Karina. We're seeing that Apple is asking employees to begin returning to offices on April 11th. Now, that doesn't mean that every employee has to be back in the office on April 11th. It's going to be a phase-in, but they are starting to bring them back, and that's something that's important. Apple has been one of the companies that's really been kind of an outlier in Silicon Valley, where they've really wanted people to return to office in person, not necessarily doing a hybrid model. But then you have companies like Twitter, which have said, look, you can work wherever you want in the world as long as you're getting your work done. We don't care. Microsoft, by the way, they've also started to bring workers back already. That was February 28th when they began doing that in their headquarters at home. And then Google is asking people to return back to office on April 4th. That's beginning April 4th. And again, it's going to be a phase. And they're asking people to be in office at least 3 days a week. And now, one of the things that you may be wondering is, well, these are companies that are tech companies. why do they need people back in the office when they were just selling us during the pandemic this whole you can work from home and do it all with our tools kind of thing? Well, that's probably because companies like Apple really want people to collaborate, especially when they're making new products. As for Microsoft and Google, that's kind of up in the air. I mean, they are saying 3 days a week, at least with Google, but they also sold us during the pandemic their products to tell us you can work from anywhere. So it's kind of a catch-22, I think, in those situations. Twitter seems to be the only company that's really saying, look, we know that you can do this. You're connected to the internet. You've been doing this for 2 years. Just keep doing it. So it'll be interesting to see how the rest of the tech companies shake out, whether or not their employers will want them coming back. Obviously, part of it has to do with all the money they invested in those huge headquarters they have out there in California.
Yeah, it'll be interesting to wait and watch. All right, Dan Howley, thank you so much for that report. We are going to take a quick break, but on the other side of it, the CEO of Siemens joins us to talk about the company's push for Biden's Made in America plan. Stay with us. Welcome back. Siemens USA CEO Barbara Humpton joined President Biden today to announce the company has pushed to invest in U.S. manufacturing to support the president's Made in America initiative. Take a listen to what he had to say.
Siemens is announcing our plans to invest $54 million into these manufacturing facilities. Additionally, later this spring, we'll identify the location of a new EV charging manufacturing hub to support our goal to produce more than 1 million EV chargers over the next 4 years. All told, this footprint expansion, just this footprint expansion, it translates to nearly 300 new jobs.
And Barbara joins us now from the North Lawn of the White House. Barbara, congratulations. Thanks so much for being here with us. I know it's been a busy day today. Can you just give us some of the other takeaways that happened in that meeting, what President Biden had to say, and then tell us what your investment means for ramping up domestic production?
Yeah, thanks so much for the opportunity to share. This has been a remarkable day. In fact, there were 3 topics we covered. One is this fabulous jobs report that just came out. There were companies all across America are actually creating jobs. And so getting people back to work is really important for all of us in economic recovery overall. So we're celebrating that. We're also celebrating the fact that Siemens is making an investment. We're doing this. Today, Siemens is building the electrical infrastructure that is supporting everything from EV chargers to hospitals to data centers and even the new semiconductor operations that Intel will be putting up. We're thrilled to be announcing expansion in Grand Prairie, Texas, as well as a new greenfield operation in Pomona, California. And so together with the president, we had the opportunity to celebrate this important milestone. I had the chance to introduce the president to our employees, and truly today was a celebration.
Well, I heard you get a nice shout out from the president too in his opening remarks, so congratulations there. You just mentioned Texas, I believe, and California. I see in your press release, South Carolina, Wendell, North Carolina, Broken Arrow, Oklahoma. There's a lot going on here, but the bottom line is you're saying that you're going to build more than 1 million EV chargers for the U.S. over the next 4 years. What's the scope of this? Can you just give us a sense of that?
Yes, we know at Siemens that the future is electric and connected. And what we need to do is build the electric infrastructure that is going to make all of this possible. How do we get power to all of the new devices that are coming online? These are the hidden heroes of critical infrastructure these days. The people who are building the electrical infrastructure that will power all of this. Now, all of this really is made possible by the investments we as Americans are making. The Bipartisan Infrastructure Act allowed us to kick off investments that are going to be important to the country. And what we're also seeing then is private industry and investors coming in to actually lay their investments into this area as well, recognizing that now that the federal government has established policies and priorities, it's a sure bet to work in America for Americans.
Now, Barbara, when do you see your first investments come to life, and then what do you expect your return on that investment to be?
Yeah, the business case is really clear. When we look at business cases like this in the Siemens Corporation, what we're looking for is the base of business certainty that's there. Our operations in Grand Prairie and Pomona have been working overtime to try to meet the demands as American industry becomes more and more digital. So they've had to rise to the demand, and I would tell you the business case was already made. So we've begun already with the work that we're doing, and we'll continue to expand as we go. Today, Siemens has 40,000 employees in all 50 states. We're doing business with 100 cities across the United States, bringing together experts in electrification and digitalization so that we really can help in this transformation that's happening.
And when we talk about this transformation that's happening, what are some of the knock-on effects, the positive ones, of building these new hubs here, bringing jobs to the market? Because there are spillover and multiplier effects from everything that's being invested in now.
Yeah. Well, I mean, think about what we experienced over the last 2 years. We knew that supply chain disruptions had a true impact on how we live and work right here in the US. And so the idea of going global, the idea of taking advantage of innovation wherever it's happening in the world, but actually manufacturing close to the point of demand, not only at Siemens, but with companies in many, many industries, we're seeing this move. They might want an and. Yes, they have operations elsewhere in the world, but they also want to bring manufacturing into the US. So for my colleagues at Siemens who are busy supporting the automation and the digitalization of manufacturing, we're seeing a rise of companies like ours bringing more tools into their operations so that they can be more productive, more efficient, more energy efficient. So when we spend these dollars building up America's infrastructure, we really are laying the foundation for the next century of American leadership.
And Barbara, Biden is really pushing this Made in America plan right now to be considered a product that is made in America. It has to have 55% of its component parts made in the USA. President Biden's target is raising that to 75% in 7 years. How achievable do you think that is?
I think that's quite achievable. Of course, there are always going to be parts that are very specific. There will be items that are very difficult to source in the U.S. But just, I mean, we heard the president say in order to have a waiver, not to meet that threshold, he will be personally involved in those decisions. Think about that. So what this will do is motivate those who are designing new products, those who are building new goods, to find ways to source those products in America. Now, let me give you an example of the Amtrak trains that we produce. We build locomotives, and we've been awarded a contract that will activate a supply chain in 40 states across the U.S. This is what we're talking about, creating jobs all across America.
And it was about a month ago, I believe, that you announced a partnership with Ford to collaborate on their Ford Charge Station Pro. I'm just wondering what kind of conversations you have with other manufacturers in the industry, maybe dialing up Elon Musk from time to time. I don't know, just what kind of collaboration do you have with the major automakers?
Yeah, we're working with everyone, and I'll tell you why. One of the most important things we bring to the marketplace is our software. The software that allows designers and engineers to envision future products. And then, of course, that leads us into the manufacturing floor with automation controls that are beyond what so many others can provide. And so we have the ability to work closely with auto manufacturers. What a lot of people don't know is that all of those auto manufacturers in their facilities can look to us for bringing in the electricity that they need through our smart infrastructure team. So I would say we have a 360-degree relationship with auto manufacturers. And actually, this is a brilliant moment. Right now, what will happen is bringing electric vehicles onto the grid actually gives us the first kind of two-way flow that lets us manage power. And I don't know if you noticed the Ford announcement. They announced the Ford F-150 Lightning as a home energy resilience solution. Think about that.
Okay, thank you so much for that. Barbara Humpton, Siemens USA CEO, thanks so much for your time today.
Great to be with you.
And then we have thank you so much. And we've got much more coming up, including reports that the White House is considering a ban on Russian oil imports. Stay with us.
Oil close on there?
You're not going to have time. It's not out for 3 minutes.
Welcome back. Well, there are reports from Bloomberg that the White House is considering a ban on Russian crude oil that's causing oil prices to soar. Also, renewed tension in Ukraine over a nuclear facility overnight, the largest in Europe, also intensifying pressure on oil. With more on the energy sector, let's bring in our Yahoo Finance's Inez Ferre. A lot going on, Inez.
Yeah, that's right. And we did see oil tick higher off of that headline that you just mentioned, Karina. Also, I want to mention another headline that we're seeing, that the U.S. says that it has no interest in reducing global supply of energy. And White House spokesperson saying that no decision has been made on considering a ban on Russian oil imports. Now, just to give you a little bit of context here, Russian oil made up about 3% of all crude shipments that arrived into the U.S. Last year. You are still, though, seeing a rise in oil prices, and we've been seeing, really, if we just take a look at a 6-day chart, look, WTI up 20%, Brent crude up also 20% over the last 6 sessions. I just got off the phone also with Tom Kloza, who basically said to me, look, there's been a de facto ban on Russian oil happening in the markets. Naturally, we saw this especially earlier this week when we saw that big jump in oil prices. Vessel tankers, they don't want to get involved. Insurance companies don't want to get involved. Financial companies, refineries. So this has been isolating Russia. And by some estimates, there's some 3 million barrels a day of Russian oil that are not going into the world markets now. But he did say this weekend, as soon as tonight going into the weekend, he said you can expect to see gasoline prices increase. He's expecting anywhere between 10 to 20 cents a gallon. And just one other note, Goldman Sachs came out with a note saying that oil could reach $150 a barrel in the next 3 months. Karina, Jared?
Thank you for that report, Inez. And we want to stick with the markets and bring in Keith Fitzgerald of Fitzgerald Group. He is the Chief Investment Officer there. Keith, always great to see you. Just want to get your reaction to this breaking news that we're seeing about oil and its potential effects on the economy, all kinds of spillover effects for the consumer. And we can get to the jobs data a little bit later, but just want to get your reaction to the potential development here.
Well, unfortunately, I am not in the least surprised. I started calling for $100 oil last summer on your show, as a matter of fact, and we started talking about 125 somewhere in the neighborhood of, last November. So, the Ukraine intensifies the situation. Global supply CEOs are taking matters into their own hands, and this doesn't surprise me at all. I think 150 is probably in the cards now at this point.
And let me just ask you then about this morning's jobs numbers, because we got that big headline beat. I think it was 678,000. We got unemployment ticking down to 3.8%. That is a pandemic low as well. Wage growth, 0%, kind of an outlier there. But what are you making of this?
Well, those statistics are always debatable. I mean, many of the statistics we rely on or have relied on in the past are now more cooked than a Christmas goose because of the way the geopolitics is impacting everything. People have forgotten that we actually have a relatively strong economy underneath that. We just heard from the CEO of Siemens talking about all of these great things that their company is going to be doing. And that's just one of thousands of companies, big and small, that are going to work, returning to work, getting out to work. This is the kind of stuff that ultimately, when we get through Ukraine, we get through the Fed, is going to power our economy higher, farther, and faster than a lot of people who are betting on the end of the universe as we know about it are expecting.
And I'm wondering what you're looking at in terms of the market direction here, because there's a classic debate between active versus passive. With hindsight, 2021 is a much easier year than we're experiencing right now. This is arguably a stock picker's environment. I'm just wondering what you're looking at here.
Well, to me, this is like, if you're a golf player, for example, to me, this is not the time to be swinging all the way to the green. This is the time where you concentrate on keeping the ball on the fairway. If you're a boater, you keep it between the buoys. If you're driving, you keep it between the center lines. This isn't the time to take rash, big risks. This is the time to concentrate on knowing what you're going to do to survive, concentrating on those companies. They're going to produce profits. They're going to move forward practically no matter what happens. So it's a very different but very important nuance in how you should be approaching the markets right now, in my humble opinion.
And just looking at some company-specific names, I'm wondering what you like in this environment, because we've been talking to a number of analysts this year, and one thing that keeps coming up is quality balance sheets, having enough cash on hand, and being able to withstand generally a rising interest rate environment, which is what we're in. So just wondering what names fit in for you and your outlook here.
Well, we operate on something called the 5Ds. Now, this is just big trillion-dollar trends that are going to occur no matter who's in the White House, practically no matter what happens geopolitically, no matter what the growth scenario looks like. So to me, right now, in line with keeping it on the fairway, I'm looking at companies like Apple and Microsoft that are getting taken to the cleaners. CrowdStrike, for example, is another one. It is getting absolutely hammered today because people are talking about rates and inflation, all this. They're completely forgetting about the fact that Russia has got one of the leading cyber crime, cyber sophisticated warfare operations on the planet. So does China and North Korea. That's a company that's not going anywhere. So I'm looking for those kinds of names where I've got big survivability. I'm also looking at the Pfizers of the world. Again, people are forgetting that all of this stuff makes the world go around. What they lack is the patience to see through the short-term noise.
And just thinking about the commodities market and kind of how it's intertwined with a number of emerging markets, we think EM and most of the ETFs are just stuffed with Chinese names. But we had a guest on the other day who said if you want to participate in the commodities rally, you can do that through, for instance, South African stocks or investments in the company. Brazil's another one that's been attracting attention. Anything interesting you in the emerging market sphere?
Other than those two names, probably not. You know, again, it's to me, it's what makes the world go round. That's the stuff that is at the forefront of my thought right now, because most of this history shows very clearly that short-term noise passes. It may be ugly, it may be scary, it may be uncomfortable, but that does not change the fact that history shows this kind of stuff eventually fades to the rearview mirror, and more often than not, for those who have the guts, it's a great buying opportunity.
All right, and real quick, I just want to ask you here, what are your expectations for the Fed in mid-month here?
Oh, I'm not smart enough to figure that one out. You know, I wish that they would take a cue from everything happening around the world, but I think sadly they're going to raise rates because they want to prove a point. They got transitory wrong for so long that they can't back themselves out of a corner.
All right, we want to thank you for being here. Keith Fitzgerald of Fitzgerald Group, where he is the Chief Investment Officer. Always great to see you. And Karina, your turn.
Yeah, great discussion there, guys. Thank you so much. We're going to pivot now. It is tax season and tax time. And if you think you've got problems trying to get your documents ordered and filed, our next guest says the IRS is dealing with much larger long-term problems that could impact filers. Here to help us discuss, let's bring in Charles Rosati, former IRS commissioner. Charles, thanks so much for being with us today. But you say the IRS, thank you. You say the IRS is in crisis mode. Why do you say that? And how does it impact taxpayers?
Well, I think that millions of people probably could find that out just from their own dealings with the IRS. I mean, the way that many people are being impacted right now is just not being able to get a refund. Over 70% of the people do get refunds. Many businesses get refunds. And I'm sure that many of the people listening right now have been frustrated in not getting what they expected and not being able to find out why. In addition, millions of other people are probably getting or have gotten some sort of written notice or letter from the IRS saying that there was some sort of error, or maybe that they owe money and maybe they didn't owe money. To be honest, I actually got one of those myself. Of course, it was wrong. I paid, but they had an error in the way they process things. And this is all, being experienced right now, but it is something that has just been building up over years. The IRS has been cut year after year after year in terms of their staff, in terms of their investment for technology, really for almost 25 years, at the same time that the Congress has piled on more responsibilities. And, I know many of your listeners are in business. It's sort of like a business that every year they say, well, we can get by a little bit less, fewer people. We can defer, what we do for our computer upgrades. And, nothing really that bad will happen. And you just do that for 25 years. At the same time, you get more and more, in the case of businesses, customers, but in the case of the IRS, tax returns. Eventually, it's going to fall apart. And actually, that is really what is happening right now.
And Charles, just to help put it into perspective, the IRS budget is about 49% of what it was 2 decades ago. So how much do you think that contributes to long-term problems that the IRS is facing?
That is huge. I mean, it's not just that it's half in relation to GDP, but think about it. Everything's gotten bigger and more complicated. There's 84% more business returns. But on top of that, the IRS is not only a tax collection agency. Of course, that's what everybody thinks of. It's a huge payment industry agency. I mean, last year, the IRS actually sent out more money in the form of refunds and benefits than the Social Security Administration. I mean, think of that. And its budget was less than that of Social Security. That's before you get to collecting any taxes. So this has gotten completely out of balance over a very long period of time. And eventually you get what you have now. And taxpayers are feeling it. And that's, by the way, before you even get to the fact that they're supposed to actually collect taxes that people owe and don't pay, which is another huge amount, $600 billion a year. So we have a crisis. It's not only a short-term crisis, it's a long-term problem, and it's going to take some big changes to fix it.
So already such a backlog from last year that, the IRS is still working through. How much more challenging is this tax season going to be, though, with all these extra stimulus payments, child tax care payments, and then also now cryptocurrency needing to be, gains and losses needing to be reported? How does that all make this more challenging?
But you just said it yourself. I mean, these things one thing adds to another. I mean, certainly some of it was due to the pandemic and the additional things that were done. But here's a thing that you might be surprised. There are actually 129 individual and 179 business tax breaks or credits in the tax code. Each one of those is something that has to be evaluated and, usually results in the IRS paying out money. That's before you ever get to collecting anything. So these things all add up to a huge overcapacity for the IRS. They ended up with 24 million paper returns not processed at the end of the year. Those are still building up as the tax filings go. And then until recently, they were continuing to send out millions and millions of notices to people saying that they had an error in their return or they hadn't paid, even where that was really not accurate because it was caused by the backlog. So we have a mess. I mean, it's just got to be dealt with in the short term. But in the long term, it really takes 3 things to fix this. One is it has to get some funding restored on a long-term basis. It can't be done, in 3 months or 6 months. Think about it. You can't hire people and train them in the tax code, if you only have 3 months or 6 months left in the fiscal year. And the technology is essential. Every business, that's in almost any sphere is investing in technology in order to make themselves more efficient. The IRS is grossly deficient in how much funding it's had for technology. So it needs long-term funding, but it also needs the flexibility to hire people, and it needs to have Congress set some clear standards and goals for what it's expected to do.
All right. Thank you so much. Many challenges ahead, and tax filers wanting the best advice on how to move forward quickly and painlessly this season. We'll have to leave it there. Thank you so much for your time today, Charles Rossetti, former IRS commissioner. Have a great weekend. We're going to take a quick break, but on the other side of it, customers are finding liquor store shelves across the country bare when it comes to one product. Find out which one ahead.
Hey, Mr. Swanger, we're going to
Welcome back. Well, the ban on Russia is hitting products in every category, and alcohol is no exception. Russian vodka is being cleared off store shelves in a hurry. For more on the beverage ban, let's bring in our next guest. Chris Swanger is Distilled Spirits Council President and CEO. Chris, thanks so much for joining us. So just how much vodka do we actually import from Russia in this country? How much are we impacted?
Well, first and foremost, let me just say on behalf of our industry, our hearts pour out to Ukrainians and the freedom fighters. It's such a very anxious time. With that, in all actuality, the U.S. marketplace only consumes 1.3% of Russian vodka in the total vodka marketplace. And actually, since 2011, Russian vodka imports have declined by 79%. So in large part, there's just a small tad of Russian vodka in the U.S. marketplace. But we appreciate and recognize the sentiments by government stakeholders and all the concerns that are happening in the Ukraine at this time.
Isn't it true that a lot of the Russian vodka isn't even produced in Russia anymore? For example, Stoli is produced in Latvia, and you say Smirnoff is fully owned by Diageo, no ties to Russia, and Smirnoff is consumed in the U.S., is made in Illinois.
Yeah, exactly. I mean, sometimes consumers can get confused, with those great brand names and Smirnoff and Stoli and others. So when efforts came afoot over the weekend, obviously everybody is anxious and they want to contribute and do their part to help what's going on in Ukraine. We've worked very, very hard to make sure some of these great products that might be perceived to be made in Russia actually aren't. Again, Stoli is made in Latvia, which is a great country, already on public record being very, very concerned about what the Russians are doing in the Ukraine. And Smirnoff, for U.S. consumers, is actually made in Illinois. And these great brands, support and contribute to American jobs here.
Chris, I'm wondering if you're seeing, as people turn away from Russia vodka, do you see other marketers trying to come in with their brands and make a push? And what is the sort of market for vodka here in the U.S. and globally?
Well, vodka remains one of the top, it's the top spirits category in the U.S., accounting for 27% of all volumes. So in 2021, 1%, 9-liter cases of vodka were sold in the United States, generating $7.3 billion in revenues for distillers. So obviously, vodka is a very, very popular category in the United States, along with American whiskey and tequila and all of the above. So consumers have a lot of great choices, a lot of great brands. In terms of the top 10 vodka markets for the United States consumer, France leads, Netherlands, Sweden, Latvia, Poland. Russia comes in right behind Poland. And again, it represents 1.3% of the total vodka marketplace. So it's a relatively small number.
Ukraine is also involved in the vodka market. So what's happening to their sales amid all this conflict?
Well, of course, I can't speak on behalf of, the companies in the Ukraine, but there is a vodka from the Ukraine called Nemirov. And, we hope that they're safe. And I'm sure they're navigating, not only the human dynamics that's happening in the Ukraine, but the business dynamics as well. But Nemirov is a relatively small brand in the United States, but obviously we wish them well in full safety as well.
And Chris, just more broadly speaking, how challenged is the spirits industry right now? It was hit so hard at the beginning of the pandemic when restaurants and bars closed. Now a sort of recovery, we are seeing a rebound, but then how much of a challenge do you think this conflict has overall?
Well, it's an unsettling time for everybody, all Americans and everybody around the world. The anxiety levels are certainly high. The pandemic created all kinds of challenges, and our industry was caught up in some challenging trade disputes over the last couple of years where we're still hanging on to a 25% tariff by our friends with the UK on American whiskey, which we appreciate and hope that the UK and the US get that resolved. It's related to steel and aluminum trade dispute. But with that, the pandemic was very difficult for distillers in the United States. Many tasting rooms had to shut down. The on-premise markets with our bars and restaurant friends, they had to shut down. But I'm pleased to report 2021, supplier sales were up by 12% to a total of $35.8 billion, and volumes rose 9.3%. So we're seeing consumers trade up. Consumers are really gravitating to distilled spirits. I'm pleased to report that we have captured market share over the last 12 years against beer and wine. So in large part, the spirits industry is pretty healthy. But as we live in these anxious times, you don't know what's going to happen to the marketplace. And we want to make sure that our consumers enjoy the product, trade up to premium distilled spirits, and drink better, not more. And obviously, responsibility is always an important guide for our industry. So our consumers enjoy the product, but in moderation.
All right. Thank you so much for that perspective. Chris Swanger, Distilled Spirits Council President and CEO. Have a great weekend to you. We're going to take a quick break, but heading into the weekend and gas prices pushing higher as oil soars, we'll break it all down for you. Slack.
Yeah.
Welcome back. U.S. gas prices are surging at a pace drivers haven't seen since Hurricane Katrina in 2005. The national price for a gallon of regular gas is now $3.84 a gallon, according to AAA. Jared, and experts say it is only going to climb higher as oil surges.
That's right. And we saw crude oil surging today and getting another boost. And we can see this on the Wi-Fi Interactive because we got a report that the Biden administration is considering banning all U.S. imports of Russian crude oil. And you can see this was on that announcement. We are already up substantially on the day, but just adding to those gains. And by the way, testing those levels, $116.57 that we saw only earlier this week. So the ascent higher in crude oil simply continues. Also seeing Brent with a high of 117. We saw that with a little bit of a higher price the other day. And of course, we have to check in on the futures price of gasoline, which is $3.52. Of course, you're paying more at the pump probably because of advertising costs and taxes. Want to get a quick check of the rest of the market. We'll see how the indices are doing to close the week, and we're not going to do it that way, but I know how we can do it. And we're going to check out the Dow here. That is down 1%, 360 points. Also checking in on the Nasdaq, that is down 2%, and the S&P 500 down about 1.25%. And we're going to send it away for the next hour of trading into the close and beyond. For Yahoo Finance's Jared Blickery and Karina Mitchell, we wish you a great weekend.
Stocks are sliding as concerns over Russia's escalating attacks in Ukraine and reports that the White House is considering a ban on Russian oil outweigh optimism over another blowout monthly jobs report. The U.S. labor market is firing on all cylinders, with nearly 700,000 jobs returning in February alone as the unemployment rate improved to a fresh two-year low. We'll break down the details and explain what this all means for your portfolio with Michelle Girard, NatWest co-head of Global Economics. And Batman returns. Will the latest installment of the superhero superhero franchise help accelerate the return to in-person moviegoing? We'll discuss this, plus Disney's latest push to add a new ad-driven tier to its streaming service with Sean Robbins, Box Office Pro chief analyst. Plus, luxury accessories are making their way into the metaverse. For the Ethereum equivalent of a couple hundred to thousands of dollars, you can get your digital hands on an NFT watch in cyberspace. We'll talk about it with Jesus Calderon, who's behind what he's calling generative watches. We have 1 hour to go in this trading day and week. I'm Emily McCormick, here with Brad Smith and Rochelle Akufo.
That's right, Emily. As you mentioned there, good news from that jobs report seemingly brushed aside by markets as risks tied to the Russia-Ukraine fallout persist. For more on this, let's bring in Yahoo Finance's Ines Ferrer.
Rochelle, and just taking a look at the markets right now, we are seeing the Dow in the final hour of trading down 420 points. The Nasdaq is down more than 2%. The S&P 500 also lower. I do want to check out the bond market because we have seen the 10-year Treasury going lower, down 12 basis points at 1.72%. Of course, this is also having an effect on financials, which have been the laggard for the day, with energy stocks being the winners for the day. And if you just take a look at a 5-day chart, you can see here financials lagging for the week, energy in the green for the week. Looking at the travel sector, we are seeing quite a bit of red in the travel sector. In fact, the airlines are set for their first week since mid-2020. I'm just going to pull up a 5-day chart. Some of these airlines you can see down double-digit percentages. Oil prices are marching higher, and this is having an effect on these airlines. Also, the bans, the air bans in Europe, in Russia. Let's take a look also at what's happening with defense stocks, because some of these defense names have been seeing they are near or at record highs. You're looking at Lockheed Martin up more than 2%. We're watching Northrop Grumman, that's up more than 4%. And also General Dynamics today touching new highs. Finally, I want to mention what's happening with the commodities market, because so much has been going on in this market today, with WTI today settling at above $115 a barrel. The White House considering a ban on Russian oil imports. That sent WTI higher in the final minutes of trading before settling. Also, Brent crude up more than 6%. And Goldman Sachs saying that oil is headed for $150 a barrel in the next 3 months if Russian crude continues to be shunned.
Yahoo Finance's own Ines Ferrer. We're going to talk further about that consideration from the White House just a little bit later on in the show to ban Russian oil imports. But joining us now to further dive in on today's market activity as we close out another volatile week, we've got Michelle Girard, who is the NatWest's co-head of global economics. And Michelle, the big economic data point of the day, the jobs report, as we've been discussing. Also want to play a quick clip for you as we begin this conversation from President Biden's remarks, and then get your reaction on the other side.
I understand our top priority must be getting prices under control. Look, our economy roared back faster than most predicted. But the pandemic meant that businesses had a hard time hiring enough workers to keep up and production in their factories. The pandemic also disrupted the global supply chains. When factories close, it takes longer to make goods and to get them to the warehouse and get them to the store, and prices go up.
And so the president clearly acknowledging the reading from today's jobs report, and particularly, where do you believe some of the momentum on the employment situation front can maintain itself, as the president did give a nod to the labor shortage, but also the ability for the economy to start to recover and continue to move in the right direction?
Well, I think what we heard from the president was the explanation about why prices were moving higher, this imbalance between supply and demand. And higher inflation is a negative for the growth prospects. It acts like a tax on the consumer. If consumers are having to pay more for energy and food, they have less to spend elsewhere. And so when you talk about the momentum in terms of employment, we've had very good momentum. Clearly that today's numbers were a strong beat to the upside. We saw nice gains, not only in the leisure and hospitality sector, which of course was hard hit by the pandemic, but also construction and manufacturing. So it was very broad based. Now the question is, can that momentum continue if the economy is going to face economic headwinds as a result of higher inflation. And if we see businesses and consumers pull back a bit, then some of the strong momentum that we've enjoyed the last several months may start to ease a bit.
What do you believe that means for some of the current quarter performance that we're seeing, or at least going to get future earnings reports from companies for, and for people who are trying to kind of position their portfolio respective of that? You know, this still seems like a time that can be extremely volatile, even going into the upcoming Fed meeting, because we've already heard that Fed Chair Jerome Powell is going to support likely 25 basis points in terms of an increase.
Yeah, no, it's going to continue to be an incredibly volatile period. There is just so much uncertainty with a war being raged, and I just think
Michelle, do we have you? Okay, we're going to try and get Michelle's feedback. We're going to try and get to that back for you. And as we're just taking a look at the Fed funds rate and where that sits, as well as where the major averages are with just about 54 minutes left in today's trading activity, we'll get back to some of the conversation around what's moving the markets as you're taking a look at the Dow, the S&P 500, and the Nasdaq, all deep in declines. We're going to go to a quick break. We will be right back in just a quick moment. Welcome back to Yahoo Finance, everyone. They say the original's always better, but we're going to make a strong case for the sequel here with Michelle Girard, NatWest co-head of Global Economics. Okay, we've got you back, Michelle. I just want to pick up where we left off particularly, and you were answering the question around how the volatility might continue to go forward from here, and particularly on the inflation front, what you are expecting the Fed to do to curb it in the near future.
Yeah, well, that's, we're talking about the fact that because of higher inflation, the Fed, I think, has no choice but to continue to push forward with the rate hikes that have been planned. The Fed chair this week was pretty clear that 25 basis points increase in interest rates was the outcome that we should expect next week when they meet. And even in the face of the weakness in the equity markets, the uncertainty, the volatility that we're seeing, normally you might think the Fed would hold off given all that's going on, but because of inflation, they simply can't. But of course, that is raising concerns over the longer term about the economic outlook. And this flattening of the yield curve I was referring to is a reflection of the fact that, investors are worried that the Fed will end up over tightening and throw us into a recession.
Michelle, in this morning's jobs report, we saw average hourly wages grow 5.1% on a year-over-year basis last month, well below expectations and the 5.5% rise we saw in January. What do you think was driving this deceleration? And is this an issue for growth going forward, considering wages have not been keeping pace with the rise that we've been seeing in consumer price, the CPI, the Consumer Price Index?
The numbers are so noisy. All of these monthly numbers, you need to take with a grain of salt. There's been a pretty steady march of it, in terms of earnings moving higher. This month, the numbers were for the first time surprising on the more moderate side. I don't know how much I think we should read into that, but some of the issues that create that, some of the fluky readings have to do with compositional shifts in the employment situation in terms of the share of lower paid workers versus higher paid workers. If you adjust for that, I've seen estimates that the earnings increase or growth rate is actually closer to 4.2%. So you make a really good point that whether it's 5% or perhaps even lower in terms of earnings growth, it is not keeping pace with higher prices, higher CPI inflation. And that's what we talk about, this tax that consumers are feeling, that real wages, that is wages adjusted for inflation, are actually going lower.
And we are going to be getting the next CPI print for February out next week. Consensus economists are looking for a 7.9% year-over-year increase on that headline number. Do you think February is going to mark the peak, or do you think we still have further to go?
We had thought that February was going to mark the peak. However, with this, the rise in energy prices that we're seeing, I don't think we can any longer assume that's going to be the case. Certainly with respect to the headline numbers, I think it's likely that we'll continue to see upward pressure. You had mentioned, I think before we started, to talk about forecasts for oil going to $150 a barrel. So certainly the headline numbers, I think, risk moving, continuing to move higher. And there is a risk that spills over more broadly, even into the so-called core rate when you strip out food and energy prices. So I think, unfortunately, recent developments are going to make it very challenging for our expectations that, the peak may be here.
And speaking of those headline numbers, we did hear from U.S. Labor Secretary Marty Walsh, who told Yahoo Finance, aside from inflation, we have a really strong economy, but you have a lot of populations that suffered disproportionately from COVID and the economic impacts, and we are still seeing this uneven recovery. As you look beyond the headline numbers, what are you watching for in the labor market that's giving you a really good idea of the health of it?
Well, we do look at digging a bit deeper into the unemployment situation, for example, and looking at unemployment rates, by ethnicity, by age group, of course, by gender, looking at, for example, participation rates and the recovery that we've seen, in the labor force. And you can see that there are disproportionate, impacts or recoveries. Everyone has improved, but some groups are back to pre-pandemic levels, and others are lagging a bit behind. And we've talked. It's been widely talked about that. For example, when we look at the labor force, you still have, which is still, despite the unemployment rate being kind of at very close to its pre-pandemic levels, the labor force is not, and women in particular are still not absent from the workforce, but have come back much, much more slowly than men, perhaps because of lingering childcare or other issues. And so, I do think that as you look, deeper, not everybody is back, or not all cohorts are back, have seen the full recovery in the wake of the pandemic yet.
And I want to go back to what you were saying about what we've seen with consumer spending versus consumer sentiment, because we saw that that's actually sank in February to its lowest level in a decade. Because obviously when you have high prices on gas and your food staples, it doesn't make you feel like you're doing well economically. So then as the inflation rate is outpacing wage increases, talk about the divergence between consumer sentiment and consumer spending and how that might affect the economy if this persists.
I think that's exactly, the concern that I have is that consumer spending has held up well, but as we move forward, there's a couple of things. First of all, savings have been coming down. Obviously, there was a lot of money saved in the wake of during the pandemic with a lot of the government programs giving people a lot of money they couldn't spend. The savings rate was high, and it has been fueling spending. That has been coming down. And now you have a situation where consumer sentiment, as you said, is becoming quite downbeat. Obviously, the concerns about Ukraine, the concerns about of inflation. And I'm afraid you're going to have a situation where you're going to see consumers wanting to increase savings again from a cautionary standpoint, becoming much more conservative. So I am very watchful that those weak sentiment numbers may translate into some softer spending numbers in the months ahead, and that the U.S. economy, even without yet the impacts of the Fed raising interest rates, is just set to slow as a result of the outbreak of war, essentially.
Certainly a lot to keep an eye on there. We do appreciate your insights. Michelle Girard there, NatWest's co-head of global economics. Thank you for your time. All right, let's get a quick check on how oil is performing today. We're seeing Brent crude is up about 6.69% and WTI crude up almost 7% as well. Those numbers, as we see them, over $115 a barrel, certainly being impacted by what we're seeing with the Russia-Ukraine crisis.
Well, oil has had a runaway week in an adverse way amid the Russian attacks on Ukraine. And as debates ensue on Capitol Hill, as House Speaker Nancy Pelosi backs banning Russian oil imports, we've got more on this with Yahoo Finance's Rick Newman. And Rick, perhaps we begin with D.C. in the debate about banning Russian oil imports. And it sounds like this is under consideration at the White House level now.
Right. It seems to have begun in Congress and perhaps the Biden administration. I mean, when Nancy Pelosi says she's in favor of something, she's a leader of the House and probably the second most important Democrat in Washington. So I guess that gets the White House's ear. I'm not sure how much it would do. Russian imports of oil and oil products to the United States, only about 2.5% of everything we consume. Some people were completely unaware we even get any oil from Russia. The reason we do is it comes in mostly on the West Coast because it's just more efficient to import oil from Russia there than to get it from elsewhere in the United States. We are a net importer of oil because we consume more oil than we produce. So if the United States were to stop buying Russian oil, that would still leave a lot of Russian oil on the market. The question is, would Europe follow? And that's a much harder problem because Europe is much more reliant on Russian oil than the United States is. So if the United States was the only country that stopped buying Russian oil, they probably would just be able to sell that elsewhere in the market, and it may not have that much of an effect. But if they could get Europe on board, that would actually start to cause some real problems for Europe. I think that's going to be very hard to do, however.
And Rick, on that point, what are potentially some of the other levers that European countries could pull to make up a deficit in energy if they were to stop Russian oil imports as well?
They have to get it from someplace else. And it's not just oil, it's also natural gas. I mean, Russia is the largest single supplier of natural gas to Europe, to Germany, and many other countries there. So you can get natural gas in a couple other ways. The most obvious is to get liquefied natural gas, which is transported not by pipeline, which that gas from Russia is, but by boat. But not all the countries in Europe have the facilities to handle LNG or liquefied natural gas. If Russian oil goes off the market, at least two countries could make up for that loss of supply quickly if they chose to do so. That's Saudi Arabia and the United Arab Emirates, because the governments there can crank up the oil supply. The government doesn't do that here in the United States, but we do know that simply because prices are higher. More companies in the United States say they are drilling more oil. But, oil producing firms in the United States have been through this many times with rising oil prices, and they've learned to be pretty careful about investing the money it takes to drill new wells and get new rigs operating, because a lot of times that just pushes the price back down, and then they are stuck operating at a loss. So whatever happens, it's not going to happen quickly. It's going to take some time for markets to digest all of these moves.
And Rick, as we look at what's really hitting home for consumers, we're seeing that despite this solid jobs number, people are more focused on the high inflation and the gas prices.
Yeah, ordinarily, I mean, we had a terrific jobs report for February. Ordinarily, this would be great news for the president. And you'd hear him crowing, and that would be the main thing we were talking about. But just as markets have kind of blown off this good jobs report, I think voters are going to blow it off too. I think Biden's going to get no bounce politically, even though the job market remains white hot, because nobody cares if the job market is white hot when inflation is at 7.5%. And honestly, probably going higher. We could see inflation at close to 10% within the next couple of months, mainly because of what's happening with energy. And it almost seems a foregone conclusion at this point that with oil prices at around $115, we are going to get to average pump prices here in the United States of $4 a gallon. Just to put a marker out there, the highest gas price we've had in recent memory was $4.11 per gallon on average in 2008. And there seems to be a good chance we could eclipse that in 2022.
All right, Yahoo Finance's own Rick Newman, thank you so much for that breakdown, and have a great weekend. Coming up, Duke coach Mike Krzyzewski's final game at Cameron Indoor Stadium is coming up Saturday against North Carolina, and ticket prices are through the roof. We'll bring you the details on the other side of this break. Welcome back to Yahoo Finance Live. We're seeing an acceleration to the downside this afternoon across the major stock indices. The S&P 500, Dow, and Nasdaq all moving sharply lower. Now, concerns over Russia and Ukraine and a potential U.S. ban on Russian oil imports are overshadowing this morning's stronger than expected February jobs report. But taking a look at the price action, we can see the Dow is off more than 350 points, or just over 1%. The Nasdaq Composite down more than 2%, building on losses from yesterday. And the S&P 500 also extending declines, now down 1.2%. And then taking a look at the sector action, we do have the energy sector in the S&P 500 in sharply positive territory, one of just three sectors in the green this afternoon, followed by utilities and healthcare. Whereas on the flip side, again, those tech-heavy sectors, information technology, consumer discretionary, as well as financials, actually also moving to the downside and the laggards during this afternoon session.
Now, what about investing in a piece of history? Well, what do you get when a Duke basketball coaching legend retires amid pent-up demand to go out and limited supply? You get eye-watering ticket prices. Let's bring in Yahoo Finance's David Briggs with more on that story. David.
Hey there, thanks. Yeah, you get really a perfect storm in the ticket market. Unlike anything I have ever seen before, the buy-in prices for the recent Super Bowl at SoFi Stadium in LA was $3,000. Well, to get in the Duke, North Carolina game tomorrow night, the cheapest ticket on StubHub right now is more than $4,200. That is the highest ticket prices in the history of college basketball. And yes, it is right now exceeding the Super Bowl prices, all for a 75-year-old man who will barely get off the bench. Mike Krzyzewski, the all-time greatest coach in college basketball history. Let's talk about it with Matt Marino. He is the VP of One of Sports. They have commemorated this game with an NFT. And Matt, good to see you. I wanted to get my hands on one of your tickets because I can't get to Duke NC tomorrow night, but I just jumped on your website and it appears you have sold out as well. How'd the sale go, and what drew you to Duke, North Carolina for your first college sports entrant?
Well, thanks, David. Absolutely. The sale went quick. So I think we were sold out of our platinum tier in under a minute. And then our gold tier was sold out a little bit, about an hour and a half, hour and 40 minutes after that. But obviously, what drew us to the game itself, Coach K is a legendary, obviously, college basketball coach, and Duke has a legendary program. And we wanted to, commemorate his final home game and obviously the history of Duke basketball. And, what a better way to do that, with the game Saturday night against Carolina, at Cameron Indoor, like you said, very expensive to go in, and it's, only 9,300, seats in there. So, it's a tough ticket to get, but we're glad we're able to, share the some of that wealth with the community around as well.
Yeah, the perfect storm for this ticket is what you just talked about. 9,300 seats in Cameron Indoor Stadium, 73,000 for the most recent Super Bowl. And you're talking about in the neighborhood of 100 former players who are taking up the biggest chunk of those tickets as well. So let's talk about what makes this such a unique piece of memorabilia. What is it that people who are still trying to grasp the NFT market, what will they get their hands on?
Sure. So they're essentially getting Duke's rookie card, right? So, think about it in that space. This is Duke's first NFT drop, right? So the creative NFTs, there are 3 tickets, and then also 5 championship rings to commemorate, Duke's 5 national championships. And I think that's what's really unique about this is that there's some utility, on the other end of that. So, what does that mean is that there's an experience with that. So, if you're one of the winners of those 5 national championships, you're getting a personalized basketball from Coach K signed to you, specifically dated, and then also a video of that personalization. So it's something that, it's an experience that money can't buy. It's something that a Duke fan, a loyalist will obviously treasure and keep within their family. And, that's a big part of it. And I think that's what really also, speaks to the Duke basketball program and Duke athletics is that, it's a very, interesting and loyal group of fans and followers as well.
I'm a lifelong Duke fan, the son of a Duke Blue Devil myself, so I will check those out. I can see the championship ring NFTs are still available on the site. The NFT market, though, overall has taken a hit in recent months. I see the average sales price for an NFT is at $2,000. That's down from $6,800 in January, and the cumulative market down to $26 million from $160 million earlier this year. What's going on?
Well, like a lot of things, right? There's a lot of volatility in it, and it's going to move around a little bit. And that's what, hopefully we can work on with our clients and partners, right? So, our goal, as a multi-chain NFT platform, we want to create, environmental, sustainable and, fan-friendly experiences, right? We're on a couple different blockchains, Tezos and Polygon, and something that we take pride in is that, when we mint an NFT, it takes about 2 million less, or I said 2 million times less energy than other proof of work networks, and that's something that we take pride in. That's something that we're looking to continue on and to do in the future. So I think those are some of the concerns that you're talking about. The entry point has been very high. It's not we want to democratize that and make the entry point much more reasonable for people to enjoy this community. We also want to be able to open it up to non-crypto native fans, right, and remove those kind of frictions that are always discussed. So you can buy with a credit card, a debit card. We want to make that process very seamless. And if you go on our site, you can sign up and register and start collecting probably within about 90 seconds.
Mm-hmm. You guys are also in the lifestyle and music space, but another sports entry is partnered with Sports Illustrated and some athletes like Muhammad Ali and Emmitt Smith and Jerry Rice. Tell me about that. Yeah, so I mean, obviously, as a sports fan, Sports Illustrated is such a nostalgic piece and such a big part of American sports history. So we wanted to memorialize that and partner with them, and then the iconic cover shots of these athletes, right? Jerry Rice, Emmitt Smith, Dick Butkus, they'll be the first three. It'll, continue on with, just as you mentioned, Muhammad Ali, Mia Hamm, Billie Jean King, Michael Phelps, Dick Butkus, Dale Earnhardt, Shaq, Wayne Gretzky. And those covers are such an iconic part of, American sports history. We wanted to demonstrate that with the NFT and the creative and, create a little bit of Americana with that. So, you'll see some really interesting 3D animations that are inspired by the covers, some artwork that was done by a studio, Seriously Fun, that really had a good time with this. They enjoy it, and the whole partnership with Sports Illustrated and bringing them and those covers into this this Web3 and this technology has been awesome for all of us. I'm old school, brother. I've got every cover dating back to 1984, but I'm coming around on the NFTs with Sports Illustrated. I'll check out those as well. Matt Marino is the vice president of One Of Sports. Good to see you, man. Enjoy Duke, North Carolina tomorrow night. Rochelle, back to you. Thank you.
Excellent stuff. Thank you so much. That's Yahoo Finance's David Briggs there. All right, on the other side of this break, our triple play. The three stocks that Brad, Emily, and myself are watching. Let's see how they're moving after this break.
Welcome back. And it's time now for our triple play. 3 stocks we're keeping an eye on this afternoon. And guys, I'll kick things off with Sweet Green. And Sweet Green is right when we take a look at that stock chart. Those shares are up more than 20% this afternoon. And that's after the company released its first quarterly results since going public back in November. Now, fourth quarter results were stronger than expected, and so was the outlook for the current quarter and the full year. Now, Sweet Green says it sees first quarter revenue coming in at as much as $102 million. It posted revenue of $96.4 million for the fourth quarter. And the company also benefited from a 4% menu pricing increase last quarter. So the salads got even pricier. But guys, Sweet Green really is a beneficiary of the reopening and the falling Omicron cases, which we've seen across the board for many restaurants. But Sweet Green is also really a very big beneficiary of the return to office movement that we're really seeing pick up in earnest here in New York. Sweet Green really is one of those fast casual restaurants people tend to go to on their lunch breaks in the cities. So I think this is going to be an interesting stock to watch here. And again, just coming off of these fourth quarter results, that stock really moving higher in the intraday trading.
Indeed. I mean, we saw that same-store sales for Sweet Green rose 36% in the quarter versus negative 28% in the previous year. As you mentioned, that return to work really starting to get people back to grabbing those lunches. And we also saw Morgan Stanley analyst John Glass saying it was driven largely by gains in suburban markets, which obviously as people sort of moved out to the suburbs and people sort of started to see those rates go down, we're also venturing in there. Plus, Sweet Green was really creative during the pandemic. They were good on social media, sharing things like recipes for some of their dressings, and even leaning into younger demographics by having tennis star Naomi Osaka as their first athlete ambassador and their youngest investor. So I'm going to shift gears and talk Alibaba stock now. Now, a tough day for Baba. It's right now at about $100. Now, it's interesting because around this time 5 years ago, Baba stock closed about $103 a share. So seeing it back in that range, just below that range, and obviously with also a much cheaper valuation. Now, a lot of the concerns have been swirling about what the SEC, based here in Washington, might do about expanding its list of Chinese companies that could get delisted by the year 2024 from U.S. exchanges. And the company was also facing pressure at home from some other domestic companies like Pinduoduo. But legendary investor and vice chairman of Berkshire Hathaway, Charlie Munger, doubled down on his Alibaba shares in the fourth quarter. So he's seeing this long-term look. And you also have Daniel O'Keefe, the portfolio manager at Artisan Partners, calling it one of the cheapest stocks I've ever seen, especially for a business of that quality with that financial strength. So it seems like financials over fear seems to be the narrative there.
Yeah, and it really does just come down to regulation, and with the techlash that we've seen in China, what that means for Alibaba particularly. And then on the front of how they break out their businesses, of course, the e-commerce side, huge, but also massive. And one of the areas that they hope creates even more margins in the future is that additional side that's more on the web services side of the business. And so with all of that intertwined, I think this could be a way to look at Alibaba as cheap as some analysts might put it. But I think longer down the line, they're also going to have to evaluate exactly what regulation could mean and how that may be a dampener on some of their revenue prospects and the marginers, a weight on the margins rather going forward. And that's something that still is the source of uncertainty at this point in time. So perhaps why we're seeing it slip yet again here. But another company that is budding in its e-commerce ambitions here is Walmart. We've seen them grow out even more ambitious in that e-commerce space, and they're moving higher on the day by about 2%. I want to get to the announcement here from Walmart because they've actually got one of the virtual fitting rooms that they have now enlisted in Zkit. They've created this dynamic virtual fitting room platform. Now, why this is so critical, you think back to all of the investments that Walmart has made into its e-commerce business as I led into this conversation with, and it really comes back to the growth that they've seen year over year, 11% over the past year. And then on a 2-year stack, as we had seen a lot of those year-over-2 comparisons, they'd actually grown 90% for U.S. e-commerce sales. And so within the departments that we've seen them do well in and some of their homegrown brands, it particularly points back to apparel. Of course, grocery just runs away with it, given the market share that they already have. But I think for apparel, this could be a key time for Walmart to be able to get this right, as people might be refreshing some of their closets, getting ready to re-enter into some of their social constructs, if you will.
Well, that's a good point, Brad. And the other thing about apparel, of course, is the fact that it is a higher margin business typically than grocery. And we know that Walmart already does have top market share. It is the biggest grocer in the US. But when we think about the market share that Walmart has commanded over the course of the past couple of years in e-commerce apparel sales, we actually saw that Amazon unseated Walmart in this area during the pandemic. And that's according to research from Wells Fargo. So clearly here with this new Choose My Model integration, this first implementation of the Z-Kit acquisition, clearly Walmart is trying to make strides in this area. As you mentioned, Brad, again, seeing that 90% two-year stack growth on the digital side of Walmart's business, really trying to get that built out even further, especially when it comes to the high margin side of apparel. So perhaps no surprise here to see this stock up about 2% on the heels of this news.
That's right. We're going to be tracking WMT into the close, everyone. And also some other stocks that we're going to be tracking into the close. Electric vehicle companies this week can't end quickly enough for shares of Rivian, while other EV makers and manufacturers, they skid into the weekend as well as international conflict. It pressures supply chains. The CEO of Stellantis joins us with his outlook next. Welcome back to Yahoo Finance, everyone. EV manufacturers hydroplaning into the weekend. Legacy automaker Ford served up business segmentation energy, while Rivian, they served up some pricing perplexion. Take a look at where we stand with just about 15-ish minutes left till the closing bell. The major averages, or well, excuse me, not the major averages, they're negative, but also the EV players are too. Tesla down by about 0.9% right now. Fisker, that's lower by about 3.5%. Rivian, you're seeing that continue its slide. That's down by about 7.7%, adding on to some of the declines we saw earlier this week. Lucid, flat just barely to the downside. And then additionally, we mentioned Ford. There you see ticker symbol F. It's down by about 4.6% right now.
As the race to capture the fast-growing electric vehicle market heats up, Stellantis, the owner of Fiat, Jeep, and Maserati, among others, is doubling down on plans to build out a suite of new EVs. Our own auto reporter and producer, Pras Subramanian, is here with the details. And Pras, you had a chance to speak with the company. What's the plan here on the EV expansion?
That's right, Emily. I spoke to Stellantis CEO Carlos Tavares about that Dare Forward 2030 plan to really supercharge their EV transformation. First off, we actually spoke about the situation in Russia and business concerns there with sanctions being placed. Carlos told me that every hour they have a team checking the new regulations to see how it would impact their business. And while the company is supportive of the Ukrainian people, Tavares was cautious about how far the global community could go with isolating Russia and the implications that come down the line. Here's what he had to say.
The more you fragment, the more you create inward-looking countries and regions. The more inward-looking you are, the more selfish you are, the more tension you create, and tensions may lead to war. So I'm concerned by the fact that it's very trendy to say that globalization is not good, etc. Well, the opposite of globalization is fragmentation. And if you fragment, you create tensions, right? If you create tensions, then you may end up in a war. So I'm concerned by that.
So the concern there, obviously, with a multinational company sourcing parts from the globe, serving their customers in numerous territories. Now, back to the Dare Forward 2030 plan to spend $35 billion on the transformation to an EV business, 100% of revenue coming from EVs in Europe, and 50% of revenues in the US coming from EVs as well, with 25 new EVs coming to the US by that time. Now, this transformation isn't just hardware, it's software too and tech. And again, it's all very aggressive with these changes coming by 2030. All the while having to do with how do you wind down those legacy ICE businesses or internal combustion engine businesses, and how fast, guys?
So, Pras, this is not the first time this week we've heard about targets by 2030. It was Ford that also wanted EVs to represent half of their global production volume by 2030. And they, too, cited some of the headwinds, particularly with regard to the supply chain and how international conflict was also impacting that as well.
Yeah, Brett, really interesting stuff with Jim Farley, Ford CEO, outlining that new co versus old co game plan, where they're going to put all the new EV exciting stuff in one business and put the legacy ICE stuff in another. I asked Carlos Tavares about this as well. He's one of these operators that's very much a realist, right? He says, where's the money going to come from to fund that $35 billion transformation in their business? It's coming pretty much from the ICE business. So with regards to what Ford's up to, I asked him about that and about that new co, old co plan. Here's what he had to say.
It was very well received by the market. Very well played. It was a good play. But you see, the point is, and that's why you may see from Stellantis at one point in time a little bit more surprising reactions. If what you call the legacy car makers have been creating wealth for the last century, and suddenly the fact that they are legacy is a penalty for them because they have more constraints to move than the other guys, then that's fine. We'll stop thinking about that and we'll start moving. But then the society in which we operate needs to accept the fact that when the car legacy starts to move fast, if there is some kind of collateral damage, then it's because we need to move.
So collateral damage here, this is suppliers, the dealer networks, even service centers. These are the messy things that the OEMs need to think about to deal with, Carlos says, as governments and industry watchers say, move fast, but don't, quote, break anything. Brett?
That's amazing. All right, a lot of transition taking place, and all of these companies looking to move really fast right now and prioritize production. Pras, great to see you. Great to have this discussion with you on Stellantis, an excellent interview with their CEO. Everyone, coming up, we've got just minutes remaining in today's trading session. We're going to sprint on over to the Wi-Fi Interactive with the key levels to watch going into today's close.
Welcome back to Yahoo Finance Live. We're just about 7 minutes away from the closing bell. Let's check in on how markets are doing as we head towards the close with our very own Jared Blickery.
That's right. And I'm looking at the Wi-Fi Interactive, not really finding a lot of positive action for the week, at least in the majors. The Dow is down about 1.7% over the last 5 days. That's good for 540 points. Not a disaster. You can see we're ending at least above the lows of the week. In the Nasdaq, not the case. We are ending at the lows, but not the lows of the year. You can see this on a year-to-date chart. We do have those lows from last week to get through. And then finally, the S&P 500 kind of looking like the Dow here. By the way, over the last 6 days, basically done absolutely nothing since last Friday, just tracing out a very small relative range here. So we'll have to see what comes of next week. And I'd be remiss without looking at the Russell 2000, the small caps as well, and very similar to the S&P 500. Well, let's take a look at the VIX next, and we can see that's a little bit elevated, holding over 30, still in its well-defined uptrend here. And then the bond market, wow, what a roiling it got this week. So not sideways actions for the bond market. You can see down 11 basis points for the 5-year today, off of those employment numbers, 12 for the 10-year, and also for the 30-year, we're seeing 8 basis points. So a little bit of flattening in the curve. Also want to check out the US dollar. I'm going to go to a 5-year chart, and you can see we're back up in 2020 territory from that pandemic sell-off. And the US dollar really going higher on those interest rate differentials and also a flight to quality status. So let's take a look. I want to get to our sector action here as we head into the close. Energy in the forefront, up another 3%. By the way, we are on the verge of hitting the highest prices since 2014, taking out those highs from earlier in the week on the news that the U.S. may halt all imports of Russian oil into the U.S. So that would be a pretty momentous move there. To the downside, financials flagging, not too surprising since we do have the yield curve flattening.
Jared, stock investors get a break from the volatility this weekend, but maybe not so for crypto traders with Bitcoin back below 40K. What are you tracking in that space?
Yeah, you know, I love to watch crypto over the weekend, especially when it's going down. I say that tongue in cheek. So it headed lower into the end of the day here. It's been correlated with stocks to the downside, sometimes to the upside. But let's get a year-to-date chart with some candlesticks so we can see the price action. So it looked like a couple weeks or a week ago, earlier in the week, we were tracing out a W bottom pattern, but now we're just simply heading lower again. And so this is looking more like a sideways consolidation. So we'll have to see what comes of Bitcoin. And we'll take a look at Ethereum as well. Fairly similar pattern here. So never fun to watch Bitcoin crash into the close on Friday, knowing that you might have to white knuckle it over the weekend. But that is my preferred status on a Sunday morning, guys.
All right, Yahoo Finance's Jared Blickery, thank you so much. And coming up, we'll take you to the closing bell and beyond. Stick with us.
Welcome back to Yahoo Finance Live, everyone. We are counting you down to the closing bell here this afternoon. Brad Smith here with Emily McCormick and Rochelle Akufo. And we also want to introduce our market panelist for after the closing bell. We've got Gitu Sharma, who is the Alpha's Future LLC founder and investment manager, and James Bruderman, who is the 1879 Advisors vice chairman. We're going to stick a pin in that for a hot second and come back to the discussion. But first, let's take a look at major averages going into the close here. We're just inside of a minute and taking a look at the Dow right now, down by 163 points, 0.5% in the red. Also set to end the week lower for the S&P 500. We are down right now by about 0.75% on that scale, 32 points to the downside there. And then additionally taking a look at the Nasdaq Composite, the tech-heavy average right now is down by about 1.6%, 221 points to the downside there, as we've just got seconds left in the last trading session of this week. Let's take a look at the closing bell.
And that is the closing bell this Friday, March 4th. We're closing out another volatile day and week on Wall Street, with all three major stock indices posting losses on the day and the week. The Dow Jones Industrial Average now down for a fourth consecutive week, and during today's session, down by nearly 180 points, or about 0.5%. Also seeing losses across the S&P 500, down 0.8%, and the Nasdaq Composite down nearly 1.7%. But for more on today and this week's trading action, let's head back over to our market panel. And Gitu, I'll start with you. We got a much better than expected jobs report out this morning. Payrolls up by 678,000 for February. Do you think this changes anything for the Federal Reserve?
I think the market is the strong jobs report shows that the U.S. economy is continuing to lift up from reopening. The consumer spending is good. The hiring is good. And the market wants to believe that the U.S. economy can sustain this crisis that is emerging in Eastern Europe.
And James, we're moving into the lull before the next quarter's earnings season picks up at this point. Does this leave markets even more vulnerable, in your opinion, to headline risks from Russia, Ukraine in the near term? Or are there other positive catalysts that might be able to outweigh this?
Well, I think the jobs report today is certainly a positive catalyst. Look, underpinning the economy right now, or underpinning the markets right now, we've got a very strong economy. Forward earnings are higher than they've ever been, certainly still in record territory. So I think there's a lot of underlying strength in the economy that provides a nice, that provides a nice bit of downside protection to the geopolitical challenges that we're seeing right now. So quite honestly, we feel that the markets are priced reasonably well. We've seen a compression in multiples a little bit. Underlying the markets, we've got we're in pretty good shape overall.
And a lot of investors wondering how to invest at this point. Now, Gitu, in your notes, you say that investors should focus on stocks that tend to do well at this time of the economic cycle. That includes companies with high pricing power, strong brands, strong current cash flows, and safe balance sheets. Using that criteria, what are your top picks at the moment?
So we're focused on, as I said, we're focused on companies that have strong balance sheets, strong cash flows, and tend to behave defensively in a volatile environment. To us, that's in the consumer staples space, healthcare, and also quality industrials and quality tech, as these companies will be more resilient if we continue in this volatile environment.
And James, you've said that the probability of a soft landing accompanied by more sustainable growth is more likely than a recession over the next 12 months. At a time when retail investors might be panicking with looking at all these wild swings, how are you advising them to take advantage of the opportunities now with that eye on that soft landing a year from now?
Well, look, at the end of the day, we're facing a little bit of geopolitical turmoil right now, but we've been here before. In the corner of my desk, I've got the slide rule that my dad used to do his daily valuations when Kennedy was shot. And my grandfather was, in fact, the family's been managing money since before the Berlin Wall came down and before it went up, and during World War II. Those were much bigger shocks, and the Cuban Missile Crisis, much bigger shocks than what we're experiencing today. So I think the market is maybe certainly when you have geopolitical problems like this, the natural tendency is to err on the side of what don't we know? How much worse can it get? But what I think investors need to focus on is it likely to really get a lot worse? Until the first bullets are fired by NATO soldiers, I don't think we've got a lot to worry about escalation. And people should be looking at the underlying value that's inherent in equities right now, especially given the underlying strength of the economy.
And so, James, what are investors to make of companies that are already saying that their supply chains are going to be facing headwinds, or they are already facing some sort of headwinds on the material front because of the international conflict right now?
Yeah, and not just the material front, but also, the risk of cyber war heating up as well is certainly having a short-term and may have a longer-term impact on supply chains. I think the assumption that we have to go forward with is that from a secular basis, we are back in a Cold War, and we need to think about what our Cold War footing is and how that does impact supply chains. Simply put, though, we do think there's still there's still a lot of strength in the consumer. Today's jobs report and low unemployment suggest that earnings, or suggest that a significant portion of the of employees are continuing to earn money. They should continue to spend money. We probably will see more bottlenecks for a little bit longer than we would have anticipated even a month ago. But from a supply side and from a goods side, we do expect those to kind of work themselves out. And we think as we get into the second quarter and into the third quarter, we'll probably see a lot more spending on the services side. And we do think that that the pent-up demand for services will be a nice boon, especially over the summer months.
And so, Guido, I want to swing that question your way, Guido, because if we think about where the first amount of spending is to get cut on a household basis, what are the sectors that would be most readily or most reactively impacted?
I think as of now, the view is that the U.S. consumer is inclined to spend because of the reopening. There has been a lot of pent-up demand. There has been travel has been locked in, and the consumer is doing well given again the jobs report. So there is good hiring. There is wage growth, and so at this moment, we think that the U.S. economy will continue to do well, and will continue to take inflation in its stride, enabling the Fed to start with its rate hike process, even if it wants to stay cautious and not speed up the rate hikes, because we know that inflation is much higher than Fed's 2% target, and the current monetary stance is not in line with those inflation numbers. So I think that we don't see the consumer constraining spending right now. But of course, if the inflation stays high for a very long time, given this Russian crisis and spike in commodity prices, we will have to see how that plays out, whether that will affect growth, whether we will continue to stay in this high growth, high inflation, heating up environment, or whether we will move towards a more stagflationary environment, which is high inflation but low growth.
James, how are you thinking about the energy sector? Crude is over $100 a barrel. The energy sector has outperformed again today after outperforming for the year to date. Do energy commodities and stocks continue to outperform and continue to have some room to run from here?
That's a really good question. And I think the answer is candidly no. I mean, we don't know, we can't predict exactly how supply and demand shake out, but we're certainly seeing a little bit of speculative froth in terms of the recent run-up of interest rates. Not interest rates, but in terms of the recent run-up in energy rates. I don't know that that's really sustainable at $120+ a barrel. And, we'll have to see what the OPEC countries do on the supply side. We'll have to see if Europe and U.S. start thinking about maybe energy independence again. And certainly I think that, in this Cold War environment, energy independence probably takes a front seat to clean energy or to really to clean energy. So, I think on the supply side, it's at these prices especially, it's certainly logical that we'll see more supply. Certainly at these prices, demand is also going to come down. So I don't see it sustainable at this level.
And Gitu, I'm wondering, for U.S. economic activity, where are you seeing the biggest soft patch at this point, aside, of course, from inflation, that you think may be underappreciated at this point by investors, thinking about where they should be investing and where potential pitfalls could be?
Yeah, I agree with the other guests that energy is people may believe that energy is the space to invest, but there could be pitfalls there, because if suddenly we have a resolution to this crisis, then both oil and energy stocks can pull back quite a bit. I also think that investing in right now we should be investing in companies that have current cash flows rather than investing in those that have high growth and high cash flows into the future with high valuations, because if we do see a rate rise, then long duration stocks with high valuations can suffer. If we are in an environment of rising rates and tighter financial conditions, then valuations will begin to matter. And in that regard, focusing on companies with high cash flows today and sustainable and stable will do well.
Gitu Sharma, Alpha's Future LLC founder and investment manager, and James Bruderman, 1879 Advisors Vice Chairman. Thank you both so much. Have great weekends. Let's head back over to Yahoo Finance's own Jared Blickery for one final thought on the market this final afternoon. And Jared, break it down for us.
That's right. I'm watching the energy market, and specifically crude oil, which spiked higher today on the news that President Biden may actually block all U.S. imports of crude oil from Russia. Now, you can see crude oil up 6.74% today with a high of around $115 per barrel. That is pretty significant there. But talking to a number of analysts today, they said it could go higher. Goldman came out with a number of $150 per barrel, and 120 just seems really close. But that was a target that seemed excessive only a few weeks ago. So pretty incredible to think about there. And by the way, that's not the worst that could come of these sanctions. If President Biden were to pass some kind of, or Congress were to pass some kind of order that blocks the Russian government from the payment system with regard to crude oil, oil's a fungible commodity. Okay, that would block millions of barrels of oil, of Russian oil, from coming to the market. So that's not what is being contemplated right now, but that is a possible next step, guys.
Certainly a dire one indeed. Thank you so much, Jared Blickery, there for us. All right, well, if you're watching all this market volatility with an eye on your 401k or retiring in the next 3 to 6 months, we've got you covered. Expert advice on retiring during volatility next.
All right, so we actually just hit.
Welcome back. If you're investing for the next several decades, you may just be grinning and bearing it through the market volatility of the past couple months. But what if you're retiring later this year? Here to give us some advice in this current market environment is Tracy Sherwood, Sherwood Financial Management founder and principal, who joins us as part of our retirement series brought to you by Fidelity Investments. Tracy, thanks for coming on with us this afternoon. So what are the biggest pieces of advice you have to those for those looking to retire in the next 6 months or so?
Sure, absolutely. Thank you for having me. I think that it's extremely important to recognize that as investors, we understand that there's market volatility and we face corrections. And it's just over the past few years, the Fed has intervened and stimulated the market. So it's time to reset expectations and take another look at asset allocation and remind ourselves that that's what works, that and diversification in this environment. From there, it's important to go back and revisit the planning that you've done. Most that are nearing retirement, they've been planning for the past 1, 3, 5 years. So go back and take a look at that. Ideally, you actually gave greater consideration to different market environments and the impact that that would have to help ease stress. And as you transition to retirement, I think remind yourself big picture of the reasons why you're retiring, the benefits that that's going to provide for you. In addition, go ahead and take the time to iron out the details so there aren't any hiccups. And what I mean by that is make sure that you have that scheduled income stream in place. Make sure that you have scheduled withholding to pay taxes. Have you taken the time to ensure that you'll have your health insurance all ready to go? Anything that you can do on your end is really going to help alleviate some stress and concern.
Right. And Tracy, for retirees or near retirees portfolios, let's say you didn't start rotating before January this year when we saw volatility really start to pick up, or you bought some of the dips earlier this year, but stocks then kept falling. How do you minimize the damage to your portfolio then from here?
Yeah, I think that's difficult because, again, hopefully you've listened to others, whether you're a financial advisor or media suggestions, to take a look at that beforehand and make sure that you have proper asset allocation, because that's going to be difficult for you to ride out the volatility. I would suggest that, you potentially reduce your exposure as the market starts to increase, but now certainly isn't the time with the market off, as much as it is currently. I would just sit tight, ride this out, and revisit it at a better time.
And how do you address the psychological aspect of having a shorter investing timeline and knowing when it is and perhaps isn't appropriate to make adjustments just simply based on jarring headlines?
I'm not entirely sure what you mean by a shorter investor timeline.
Yeah, I guess to expand on that a little bit, you see some of the headlines that we've been getting on the geopolitical front. Perhaps you get something about Fed Chair Jerome Powell that triggers, a short-term pullback in the markets. How do you, as a retiree or someone about to enter retirement, really process that and decide when it's the right time to move, or whether this is something that just is a knee-jerk reaction in the markets?
Oh, sure, absolutely. I mean, there is no certainty, of course. And again, for most, we're looking at retirement of 20 to 25 or more years. So this is not the first time that you're going to face these uncertainties. I think you really have to take a minute and address your fears and give greater consideration to the planning that you've done. And if you feel that this is still a good time, then that's appropriate if you've done proper planning. If, however, you feel that you'd like, I guess what I found over my career is clients, investors want to do whatever's in their control, whatever they can control. So whether that's revisiting how much they're spending and temporarily reducing it, or potentially working in some capacity a bit longer, that may be the solution.
All right, we'll leave it there for now. Tracy Sherwood, Sherwood Financial Management founder and principal, thank you again so much.
All right. Well, The Dark Knight might be a bright spot the box office needs to get people back in the theaters at pre-COVID levels. But seeing The Batman will be more expensive than you remember. AMC hopes will still go. That's next.
Continues, it won't be long before you've nothing left.
I don't care what happens to me.
It's only gonna get worse for you.
Whoa, take it easy, sweetheart.
Well, could Batman signal the beginning of a blockbuster season for the box office? Movie theaters and streaming services are banking on it. For more on that, let's bring in Yahoo Finance's Alexandra Canal with more.
Thanks, Rochelle. That's right. The Batman is expected to exceed $100 million in domestic ticket sales. Joining me now to discuss is Box Office Pro Chief Analyst Sean Robbins. Sean, thank you so much for joining us today. Now, you guys have a target between $130 million and $170 million when it comes to the film's domestic debut. Lay out the factors that are at play here, because theaters really want this movie to be a blockbuster success.
That's true. And thanks for having me back. This is a movie that's been a long time coming. Ever since Spider-Man came out, Hollywood and movie theaters have been waiting for the next big movie. And naturally, it's another comic book movie. The Batman has a lot going in its favor. Strong reviews came out earlier this week. There's an intense fan base. It's always driven this franchise with very, very few exceptions. It's always delivered very high box office benchmarks. This is also a reboot, though. So there's kind of this transition period where I think we're looking at the next generation, probably Gen Z's Batman in a way, I would say it, because it's been about 17 years since Christopher Nolan and Christian Bale obviously started their trilogy, and then we had Ben Affleck in between. So this is really going to be a test of where the future of Batman goes, and I think it's off to a very good start.
And it's interesting too, because this film is going to serve as an experiment of sorts. AMC charging a higher ticket price for the Batman compared to other releases out there. I know this is a pricing model that has been employed in some international markets, but do you think this could be a viable strategy here in the US as theaters look to redefine themselves in this post-pandemic era?
It's absolutely in a testing phase, and it's going to take some time, I think, to see how consumers react to it. There's this, I think the overarching question is, will people see it as an added charge for a premium viewing experience, or will it just essentially kind of maybe push them away from some of those peak show times? I think economic situations are really something to consider right now, given what's going on with the overall broader economy. But this is also an industry where movie theaters in particular have often seen the fact that they are still one of the cheapest forms of entertainment out there relative to some of the more expensive things that families go and do in particular. But it's also an industry moving more and more toward premium content, toward IMAX, toward Dolby Cinema, toward these big franchise movies. And I think we're going to have to pay attention to the long-term trends and see other distributors experiment with this model, because it's very much an unknown thing here in North America.
So if we do get to that point, if we get into that more premium experience moving forward, what does that mean for those smaller independent theater chains? Can they survive in that environment?
It's a challenge. I mean, it's still a challenge just from the pandemic itself, regardless of any other changes coming forward. That's an audience that is very geographically dependent. And by that, I mean, outside of New York and LA, where film circles are the strongest and tend to support art houses the most, it really depends on, other maybe mid-tier markets. What we're really seeing so far is the slowest recovery of moviegoing are for those theaters, are for those movies that wouldn't really be high profile anyway and need to build a kind of word of mouth. So in terms of how this might impact that sector of the industry, I think that's even further down the road. Right now, they're still trying to bring back the audience, and then they'll look at the long-term trends of what can we do to continue adapting to the economic needs of the industry right now.
And hopefully the Batman will help bring back some of that audience. But when you take a look back over the past several months, Spider-Man No Way Home was the last major box office success, but that was in December. It's now March. There seems to be a bit of a backlog in terms of content. What does that mean as we inch closer to the summer box office season, which has struggled in the past few years due to COVID?
Right. I think the Batman is a harbinger of very good things to come. Knock on wood, obviously, we've all grown used to things changing over the last couple of years, but studios really prepared for this. I think this is a two-pronged situation. It began with the fact that productions were delayed over the past 2 years. So that's caused some natural delay in movies even finishing being filmed and readied for release. But on top of that, studios also prepared for a winter that would eventually see a variant wave, which ended up happening with Omicron. And that's one reason we didn't see them plan a lot of releases months in advance for January and February. Batman changes that. March is still going to be a little slow. It's going to have some breathing room for the Batman, but once April rolls around, we have several high-profile movies that month. And by the time May rolls around, it's essentially an almost normal type of summer calendar.
I'm very excited and looking forward to that. Now, I do want to get your take on this. Disney Plus just confirmed that they'll be offering a new ad-supported subscription tier. Just another example of how these platforms are really working hard to attract paying users. We've talked a lot about the threat of streamers at the box office. What's your view on the streaming wars and how that could impact the future of the theatrical industry?
My view is still largely unchanged. I think the two can really coexist. Now, I do think that obviously we're seeing some waves and some changes in what types of content will be watched on what platform. That's going to continue evolving. It's very hard to compare it to the theatrical industry because it is so matured versus streaming, which is relatively nascent. But Marvel's a great example. It's delivered a number of hit shows on Disney Plus and still hit movies at the box office. Granted, not everything can be Marvel. There are going to be a lot more challenging situations, but I think ultimately they're two different types of content, two different platforms. And as much as people want to go out at times, people want to stay at home at times. What we often see is that the people who stream the most content tend to be the people that go to the movies most often as well.
Absolutely. There's a lot to keep track of in this industry, and I'm very grateful to have you to walk us all through it. Sean Robbins, the Chief Analyst at Box Office Pro. Thank you so much, and back to you, Emily.
All right, Yahoo Finance's own Alexandra Canal, thank you so much for bringing us that interview. And coming up, the Great Resignation is leading some workers to franchise. We'll break it down for you on the other side of this break. Welcome back to Yahoo Finance Live. And let's take a look at where the three major stock indices closed out today's session just about 32 minutes ago. And as we can see, a lot of red across the board here. The Dow Jones Industrial Average closing down for a fourth straight weekly loss. During today's session, down about 180 points, or about 0.5%. The biggest laggards in that index have been Boeing, American Express, and Visa. Then turning now to the S&P 500, that index down by about 0.8%. And taking a look at the sector action there, we did have financials, information technology, as well as consumer discretionary, the biggest laggards during today's session. Whereas on the flip side, we saw energy outperforming yet again alongside utilities and real estate. So overall, guys, definitely seeing a lot of selling action during this week, really adding to the volatility we've been seeing over the course of the year to date.
And that certainly comes amid a great jobs report, but the great resignation continues. Americans quit jobs at a record pace in mid-2021, and according to a ResumeBuilder.com poll, more will quit in 2022, but still at a slower pace. Now, for others, it was more about the great pivot and either starting a business or perhaps a franchise. So I'm joined by a guest who knows all about that. That's John Moore, the Patch Boys of Huntsville and Decatur owner and former airplane pilot. Thank you for joining me today. So clearly a very different pivot for you there. Walk us through the thought process that led you to leaving your career as a pilot and pivoting to franchising.
So I think a big part of it was wanting to be home more with my kids when they're out of school and, working while they're in school. And so that was a big part of it. I had a lot of fun flying, but this allows me more schedule flexibility. So this is much better for the family life.
So obviously a lot of options out there in terms of franchises. So a lot of people might be wondering, why drywall?
Yeah, why drywall? So, I think COVID has caused an increase in home services. So it's just a great time to get into home services. And, a lot of people are wanting to renovate their houses and fix the problems that they're staring at since they're at home all the time. So that and the Patch Boys are just they're a great franchise. So after getting to know them, they've been very helpful, and it's a great team to be with.
So then to that point then, for people who are sitting at home wondering how they can go from perhaps sitting at a job that they don't love to perhaps doing something that you're doing, what did the early days of starting this career shift look like in terms of the costs, the support, and the revenue that was starting at the beginning?
Yeah. So a lot of research, right? A lot of research trying to figure out which franchise is going to provide the support you need, and having your savings built up, looking at the finances, knowing that you're going to be able to, run that business and have the money you need to run it in the beginning.
And so how is business now, especially as you look at things like supply chain issues? You're seeing the cost of a lot of materials, including those that go into drywall, really going up. How is business now for you?
Business is great. I mean, yeah, things are getting a little more expensive. Customers understand that, and but you gotta takes maybe a little longer to find the right technicians, but they're out there, and it's business. So you get out there and you find them and you get to work.
And as you said, you picked drywall, you're seeing what was happening with COVID, a lot of people looking around their homes and wondering what to do. And house prices are still expected to climb another 10% this year, making it even more, difficult for people to go out and buy new houses. So what does that mean in terms of how you plan on getting more customers, or perhaps marketing to new customers who are still stuck in their homes?
People that are trying to get out of their homes, they want to fix up the home so that they can sell it and get the fair market value out of it. And some people are still buying those used homes, and they buy them, they see the repairs that need to be done. So there's plenty of drywall work out there. Everybody's wanting to get it fixed. So it's not an issue.
And just quickly, obviously, you've left your career as a pilot. Knowing what you know now in terms of whether you would have started sooner or any advice for other people, what do you think is most important to think about when considering leaving your job and pivoting to something else? Oh, we appear to have lost them, their technical difficulties. Well, we do thank our guest there, John Moore, the Patch Boys of Huntsville and Decatur owner and former airline pilot. We do thank him for his time.
All right, guys, my friends, if you hear the age-old question of what time is it, and you think to yourself it's NFT watch time, then have we got a conversation for you on the other side of this quick break of heavenly proportions. That is coming up with 3D Jesus.
Welcome back to Yahoo Finance Live. Markets closed out the day and the week about 40 minutes ago, and let's take a look at where the dust settled. The Dow Jones Industrial Average down about 180 points, the S&P 500 down about 0.8%. And as you can see here, or as you could just see there on the sector action, we did have the financials, the information technology, and the consumer discretionary sectors, the laggards during today's session. Whereas on the flip side, we did have energy, utilities, and real estate, the outperformer. And of course, with energy, we did have crude oil prices, WTI crude oil prices bouncing above $100 a barrel this week. Now, I also want to pivot over to what we've been seeing in the crypto market, because Bitcoin prices coming under renewed pressure this afternoon, tracking the declines that we saw across big tech stocks as well. Those prices down by about 6% this afternoon and trading below that $40,000 level. And Ethereum, the second largest cryptocurrency by market cap, down by about 6.9%. Then finally, do you want to get a check of the CBOE Volatility Index, or VIX, really pointing to this increased volatility we've been seeing across U.S. equity markets. That's still holding above the 30 level, now closer to 32 as we speak, and up about 5% during today's session.
Well, Em, you mentioned crypto a moment ago. People are paying as much for NFT watches as they are for actual luxury watches. Let's not delay on this one. Joining us now is Jesus Calderon, who is the owner of 3D Jesus. Okay, first there was Rolex, now there's Rodex. We're going to get back to that. But first on the price, we got to talk about that. How much are the NFT watches selling for?
So as far as how much they're selling for, I'm more in tune with the Ethereum pricing. So as an example, my last drop was at 0.175 ETH, which I believe at the time was about $700 each. But they have gone as high as $20,000. And that specific watch was actually given to the individual that sold it, which is amazing.
Yeah, what a gift. So why are intangible watches selling for these prices right now? I mean, I can't wear it. I don't know, and you can correct me if I'm wrong, if there is going to be a replica of what you are getting on the NFT version of it that is actually actually able to be created, excuse me, and slow down here, in a physical version.
Right. So it comes down to the way that the blockchain works. And I'm probably not the best person to explain that technology, but in essence, if anyone were to replicate what I'm doing, you can always go back to the creator, being me, and understand that I was the one that, at the very least, started this concept of very detailed, very high quality watches as NFTs. So in terms of creating real life counterparts, it's something that I've been in talks with people about. And we might see that in the future in tandem with, if you buy one of these beautiful watches, you might be able to get a real one down the road.
What is the anatomy or the design of an NFT watch that becomes a bestseller for you?
Honestly, I love every single one that I've made. But when it comes down to the people, everyone has their individual tastes. I try to get as much variety as I could to appeal to almost everyone. There's a variety of tattoos, skin tones, even different, like there's an ape arm, an alien arm, and all these different colors, as you can see here on the screen. And really the attention to detail is what I think drives not only an NFT collector, but also the real life counterpart. So a real watch collector will always have a very keen eye for detail. And I think that's at the core of what makes these, awesome.
Okay, and so we mentioned this at the top. There's Rolex, the original one, or Roly, if you're calling it that, or you've got the Rodex. I don't know if they're going to be calling it Rody or Roddy or anything like that, but how do NFT watches avert breach of intellectual property?
Yeah, so what's very clear here is that this is strictly digital. There is no affiliation with any of the brands that you might find similarities with. I've been very tactful in taking that type of approach because I want this to be long-term. And actually, with the origin of generative watches, there was a previous version about a year ago, which treaded the line a little bit closer. So I decided to change the branding completely and be very diligent with, these are strictly only digital as of right now. Anything that becomes real life would be in partnership with an authorized dealer or even a completely unique design, let's say.
Now, some resale markets have started to dabble more into NFTs and even directly annexed some physical products to perhaps a vault like we've seen StockX do in the past and most recently. With regard to watches and what we may see in the future there and how that actually gets into an NFT landscape, whether it's physical one that has an NFT peg to it or whether it's just an image that is an NFT in itself, how do these amass value in the resale market? Is it purely how much the people are willing to pay, how much a different seller is willing to kind of, or a buyer, I guess, is willing to spend on it at the end of the day? What is it that adds to the value over time?
Yeah, so with that, I would say there's a number of different things. I personally don't like to focus on the monetary value of the pieces that I make. I think that's just sort of a thing the market can work out on its own. I don't really have any particular goals with making each watch worth something. I just want to keep producing the best and be at the forefront of what anybody else is doing in the landscape. If you see anybody else's NFT watches, there's no easy way to put it, but I'm very far ahead in terms of quality. So as far as what the market dictates these watches should be worth, that is up to them. But that being said, with all of this talk of the metaverse and what's coming next for blockchain and Web3, I am in the process of making these actually functional and not just like videos of a digital watch. So what I mean by functional is you would have a digital watch that you can actually tell the time with, right? You'd be able to interact with sort of like a video game. And I think that by itself is going to add a tremendous value to the owners of these pieces.
Certainly. Okay, so the existing pieces that are already out there, they would then have that added element just layered on top of it then.
Exactly, yeah. The current owners would just be able to get that new version that is actually functional. Maybe they can equip it with their other characters, you know, like the Bored Apes. Maybe they can equip one of my watches if they own one, as well as, you know, maybe the punks. There's a punk version of one of these watches. There's a lot of interactivity that can happen, and I'm just barely scratching the surface.
It's really interesting because it's not just the development of your own watch, it's also developing it for a different landscape or a different reality in the metaverse. And so how far along rather are developers on getting into what the practicality of some of their existing NFTs would be in existence in the metaverse?
Right. So I think that's a little bit difficult to predict, but if I were to give a sort of timeline, I feel like we are maybe in the late 90s, early 2000s of the internet. So if you look at how long it took for the internet to really take off and apps to happen all over the world and all of these wonderful services that we enjoy now, I think where we are with blockchain and crypto and NFTs is at around that point. It's that inflection point of maybe it could be 5 years, could be 10 years, but you know, it's coming and there's no stopping it. That's for sure.
Jesus Calderon, who is the 3D Jesus owner, joining us here today. Appreciate the time and the conversation, Jesus.
And coming up, we'll break down what you should be watching in markets next week. I'll give you one hint. Inflation is going to be in focus. Stick with us.
Welcome back to Yahoo Finance Live. We're going to stop and take a look at what we're watching next week in these final weeks of Q1 and, of course, as earnings season wraps up. Now, I'm going to start with what we're looking for in terms of bracing for a potential ban on Russian crude oil. We know that it's being considered by the Biden administration, and we're already seeing where oil prices are at today, over $114 for WTI, and Brent crude also up over $116 at the moment. And so we're wondering what sort of fallout there's going to be as the president tries to protect the economy back home while still wanting to show a strong hand against President Putin and the invasion on Ukraine. Now, that also ties into what we might see from the European Central Bank, who are also meeting next week. We're going to look at some of their direct economic risks and some of the fallout from Russia-Ukraine and seeing how that will guide their decisions as a lot of central banks weigh how to manage this with trying to come out of a COVID recovery that they were already struggling with. So that's what I'll be keeping an eye on. What about you guys?
Yeah, and just to add on to that, and I think for the ECB side, even the council members that we had heard from earlier this week signaling that they weren't ready to take some of the stimulus off the table, considering the international conflict. I think that gives us a little bit of the inclination as to where they're leaning. But as you mentioned, Rochelle, it's going to come down to their meeting, what they ultimately decide and how they move forward and counter their own inflation that they're seeing as well. And then additionally, one of the other major things that we're also going to be tracking, of course, is the JOLTS next week. That coming out, and when we think about over the course of even this past year and change, the record highs that we had seen in the number of job openings and even the quits rate that we had been tracking as well, but the job openings particularly, I think that's in focus for a few sectors here, and especially in manufacturing, where we've already had conversations with some of the automotive manufacturers talking about where they're bringing in, and even logistics players, where they're bringing in more robotics to try and counter for some of the risks and headwinds that they are seeing amid a labor shortage. However, there is another good side of some of the JOLTS and jobs openings. That also means that there may be more people that are taking their job ownership into their own hands as well, starting up their own businesses. And I think that is something that is positive to see, is people being able to tap into building up their own business, leveraging this opportunity to kind of turn into a new position and perhaps find something that they're extremely passionate about as well. But at the same time, some of the jobs openings that we see persist, I know and across all the automotive and manufacturing industry roles, where either some of the production has been put on hold for supply chain constraints, or for some of the heavily competitive retail sector jobs, they're looking to welcome those people back in, especially once those supply chain constraints get sorted out.
Absolutely, Brad. And I think one thing we do have to keep in mind, of course, with the JOLTS job openings, labor turnover reports, is that they are reported on a 1-month lag. This latest data is going to be for January, but nevertheless, it is going to give us the most up-to-date picture that we can in terms of what the job vacancy, the labor shortage situation really is across the economy. And just to put the specific numbers that consensus economists are looking for, about 10.9 million, that's about the number of job openings that people are looking for across across the U.S. economy. And we did get a better than expected jobs report for January. We just today got a better than expected one for February. So certainly a lot of tightness when we think about the U.S. job market as a whole. But on a similar tone, I am also taking a look at some inflation data that we'll be getting next week. And to that point, the Consumer Price Index, the CPI, is going to be coming out Thursday at 8:30 a.m. Eastern. This is really going to be a closely watched report here. We are looking to see an acceleration compared to what we saw in January. The CPI on a year-over-year basis is expected to rise by 7.9%. That'd be the fastest increase we've seen since 1982, taking out the 40-year high we already saw in January. There had been some thinking that perhaps we had seen the peak or that we would be seeing the peak in February in terms of inflation. But now, of course, with the Russia-Ukraine crisis and the rise in energy prices we've seen come as a result of that, it looks like it may not actually be the case here. So really going to be something to keep in mind. Whether or not this actually moves the needle here for the Federal Reserve is also a question, since Fed Chair Jerome Powell did already say he'd be backing a 25 basis point interest rate hike in a couple of weeks at the Fed's next meeting, even before seeing this data and before seeing the jobs report earlier today. So again, a lot to really be watching here on the economic data front this week or next week.
And we certainly saw that the markets were laser focused on inflation and other concerns out of Ukraine, rather than this bumper jobs report, which obviously would have been a real feather in President Biden's cap. But one of the things that we also talked about with the guest earlier today was looking at this divergence between what we're seeing with these high prices and also what we're seeing with consumer sentiment. So it'll be interesting when we see that CPI data, if it does continue to be strong, how people are going to feel in the long run if they have to keep paying these high prices. That might wear off. We're going to have to see if people are still willing to put up with that if this inflation does persist for several months.
That's right. Well, we've certainly seen how the market volatility has played out on all of these different headlines, and we're going to continue to track going into next week exactly where this momentum takes us. Take a look at the major averages. We ended the week lower across the board, and that does it for us this week. But we'll pick things back up 9 a.m. Monday morning, and we will see you back here at 3 p.m. on Monday afternoon. From myself, Emily McCormick, and Rochelle Akufo, and the rest of our amazing production team, have a great weekend. See you.